Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now let's get started with a brand new chapter called as security valuation. Now guys, as you guys know, now I had segregated this entire subject in my own sequence. In this, we have already covered the first part of the subject, portfolio management, mutual funds, and risk management. Now we are entering into the second part of this particular subject, advanced financial management, and this second part predominantly deals with valuation, and this involves concepts relating to time value of money, and hence we actually did the concept of time value of money for about 2.5 hours in the previous session. We did it fully with numerical problems and everything we have seen. Is that clear, guys? That is actually a perfect way to get started with the second part of the syllabus, which deals with valuation. Is that clear, guys? Is that clear? Now, for those online folks, if you have not seen time value of money, I humbly request you to right away watch time value of money and then continue watching this session, because whatever we are going to do here from now on over the next at least 4 chapters, predominantly it dwells around time value of money concept, right? That's the reason I told you time value of money is like oxygen. It cannot be seen, but its presence can be felt everywhere, right? And whatever we are going to see here, the underlying logics and derivations are purely out of your time value of money area. So in this subject, advanced financial management, this subject is built around 2 pillars. One is your stock market knowledge, and the other one is your time value of money. And this particular segment that we are going to do right now purely deals with both your stock markets and your time value of money area. So I humbly request you to first watch time value of money before you enter here. Now on that note, guys, shall we get started? Yes, let's get started. Now guys, I'll give you guys an overview. So now in this particular chapter, what's the name of this chapter? Security valuation, right? So basically what are we going to do here? We are going to value the security. Right? Now, what securities are? So, it could be any security like equity, bonds, or certain other instruments like preference shares and all. I will give you the structuring. But before that, first, sir, why do we need this chapter? That is the first question. Why do we need this chapter? Right? Now, guys, now, before this, first, let's position this particular chapter. Now, I told you our subject finance in the first session, I told you, can be looked at from 3 different perspectives. One is from investor's perspective, IAPM, investment analysis, portfolio management. Then company's perspective called as corporate finance, and then you have something called as risk management. And guys, this chapter is predominantly from an investor's perspective once again. Is that clear? So this chapter is predominantly from an investor's perspective. Now, sir, what are we going to do here? Security valuation. We are going to value securities. Let's say, for example, equity share. I'm not even getting into this chapter, but why are we seeing this? This background is very important. Now, let's say, guys, you are going to buy a particular share today, right? You're opening your Demat account, and let's say you're going to buy a particular share. Let's say, for example, Tata Motors, just a random example. Let's say Tata Motors today, the current market price, CMP, the current market price is, example, I'm telling you, rupees 250. Just a random example. It's not an actual price. Is that clear? Now, you want to buy the share of Tata Motors. Now, the first thing is, this 250 is called the price. Price is something that you pay. Now, the first question that you will have is this particular stock worth this 250? Is this stock, I'm going to pay 250, only if I pay 250, I'll get the share. But is this share actually worth 250 or not? You need to know, right? That is called value. So you arrive at the value of the share, and then having arrived at the value, you compare it with the actual market price. If the market price is more than the value, the correct value, true value, intrinsic value, we have seen this before, right? Now, intrinsic value means the fair value, the correct value for the stock. Now, once you arrive at the value, now you can take a decision. If the actual price is more than the correct value, then you will say it is overpriced. In case you have the share, you will sell it. Is that clear? Now, if not, also you can do short selling. We have seen this before. Suppose if the actual price is less than the correct value, now you say it is undervalued, you're getting it at a lower price discount, you will go and buy it. So now basically guys, before you actually hit that buy or sell button on your demat account, first something has to actually trigger you to take that decision. So this actual price needs to be compared with a correct value of the stock. And in this particular chapter, we are going to see how do you value securities, not just equities. We'll be seeing how to value bonds, preference shares, and other things as well. Is this clear, guys? Because for you to take any decision, you should know how much a stock or any particular security is actually worth and compare that with the actual price at which it is trading. Is everybody able to understand this? Is everybody able to understand? So always remember, price is what you pay. Value is what you get. Is that clear, guys? And based on the value and the price is what I will actually take a decision. Based on this only I will take a decision. Is that clear, guys? And when you arrive at the value, we saw this in time value of money. How do you arrive at the value of something? It is the present value of all the future benefits that I'm going to get out of this particular security. This is the reason why we are linking time value of money with valuation. Is that clear, guys? That's why we spent 2.5 hours just actually learning the concepts of time value of money. Is that clear, guys? Everybody? Perfect. Now, on that note, quickly, let's get started here. Right? So when an investor makes an investment in any security, guys, please start underlining. Right? When he makes any investment in any security, the primary objective is to obtain a return that compensates them for time and their money is logged and the risk involved. So for the time and money that I spend and the risk that I take, right, I will have to take any proper investment decisions. Knowing what a security is truly worth and understanding the factors that determine its value is a fundamental prerequisite for making intelligent investment decisions. Now guys, in portfolio management, we were looking at an investment decision from the perspective of risk and return. Is that clear? Yes, that is also required. That's where we saw that in detail. Threadbare analysis, we literally broke down every single concept there and logically we understood everything. Not even a single formula we mugged up. Is that clear? Markowitz portfolio theory we did, William Sharp's, your CAPM, single index model, everything we did. Now, keep that aside. I'm not asking you to forget it. Keep it aside. Now, there is also another perspective while making an investment decision. What is that? The valuation. Am I paying the correct price to actually buy a particular security? This is what we are bothered about right now, more than the risk and return, which is already taken care of in portfolio management. Here we are much more bothered about the valuation part of it. Is that clear, guys? So I want you all to transition your thought process and get into the valuation mode right now. Is that clear, guys? Is that clear? Perfect. Now, whether you are selecting investments for a personal portfolio or deciding on a fair price for a business takeover or making critical financial choices for a company, the core principles of valuation will always remain the same. So whether you're building your own personal portfolio or a company wants to take over another company, in that case you need to value the business itself, right? That is the name of the next chapter, business valuation. Now, having valued another business, I want to take over mergers and acquisitions. That is the name of the next chapter. Is this clear, guys? So basically here, first we do securities valuation. Analysis will come to that, then business itself you value, and then you go for mergers and acquisition. That is the reason why I've sequenced it like this. Is that clear, guys? Hence, in this entire segment, the core of valuation is something that is very important. Is everybody able to get this? Yes, so switch from that risk return concept and come to your valuation game. Is that clear, guys? Yes. While some assets may be easier to value than other assets due to certainty of their future cash flows, this chapter explores the foundational concepts and practical models used to determine what? Intrinsic value of various financial instruments. Intrinsic means what? The true, correct, fair value of various financial instruments. Is that clear, guys? Now, to provide a clear and structured understanding, we bifurcate this chapter into 3 main sections. So this is something that I have done just so that you get a very, very good logical understanding to this subject. And guys, as I told you, this is one of the big 4 chapters in our syllabus. Out of that, one is already done, portfolio management. This is actually quite a big chapter. Is that clear? Now I have bifurcated this chapter into 3 different sections. Ideally, guys, now each of these 3, ideally speaking, are different chapters altogether. But ICAI has merged it and given it under a single chapter name called as securities valuation or valuation of securities. Is that clear, guys? Now, in the first part of the chapter, we are going to deal with equity valuation. We will be looking at how to value your equity shares. Is that clear? Right? And in the first part of the chapter, a lot of references to your CA intermediate will come. Is that clear? A lot of references to your CA intermediate will come. Do not worry. I promised you guys I will start from the scratch. So yes, I will give you guys the background and only then we will move forward. Is that clear, guys? Next, we will be going on to bond valuation, the most important part of this chapter. Right? This is something that you will be studying for the very first time. Of course, this is also based on time value of money concepts only. But here it's a beautiful area. This is where the peak of valuation, the valuation area peaks in this particular concept. Is that clear, guys? And then we will go on to see valuation of other securities. Right? Under other securities, you have preference shares. You guys know rights shares? Hello? Rights issue. Then you have something called as buyback of shares. In that case, how do you value? Warrants. Warrants means it's like a coupon. Coupon means not a coupon rate. No. Let us say you are holding 1 share. I'm telling you, against 1 share, I will be giving you a debenture worth ₹10 free of cost. That's called a warrant. It comes with a tag. So if you have this warrant with you, so you can get it converted into, let us say, a debenture or a preference share. It's an entitlement. Is that clear, guys? We will be seeing it later. And then you have something called as money market instruments. Is that clear? Money market instruments are nothing but short-term debt instruments. Short-term means less than 1 year. Is that clear, guys? So this is going to be the overview of this entire chapter. Are you guys able to understand? And now, as usual, we will build this chapter brick by brick, concept by concept, formula by formula. We will decode everything logically. Not a single formula needs to be mucked up. And of course, you will be seeing that how your stock markets and your time value of money put together right now, how it works in your real life scenario. And that is exactly what this entire chapter is being made up of. Is that clear, guys? So on that note, we will first get started with what? Equity valuation. Is that clear, guys? We will first do this, complete it, and then we will move on to bond valuation. Are you clear with this, guys? Yes. Shall we begin? Yes. Yes. Now, guys, what do you mean by equity? You guys know what is an equity? Yes. So equity, if you are purchasing an equity shareholder, ideally speaking, you become the owner of the company. Am I right, guys? So you get voting rights and all. How many of you have subscribed to equity shares? At least 1 equity share of any company? Huh? Okay, fine. Others? See, if you're buying even 1 equity share, you can call yourself an owner of the company. Is that clear? Proportionately, it will be fractional, but still, you are an owner of a company. And you are entitled to what? Your voting rights, you are entitled to receive dividends and all of that. You guys are aware? Now, you guys tell me one thing. Now, is there any concept of redemption when it comes to equity shares? No. Will the company say, I am raising so and so amount from equity share capital and after so many years I will repay? There is no concept called repayment. And one more thing, guys. Is it mandatory that the company has to pay dividend every year? No. There is no contractual obligation on the part of the company to pay any dividend. Am I right, guys? Now, if the company wants, they can pay dividend. Else, they need not pay dividend. Am I right, guys? Yes. So, the board will recommend the dividend and it gets approved by the shareholders. The shareholders cannot go and ask, pay me dividend and all. No, it doesn't work that way. Is that clear, guys? Yes, anyways, if it does not pay dividend, this amount gets plowed back into the business and that also belongs to you. Retained earnings belongs to you only. Is that clear, guys? Right? Now, these are some basics of equity. Is that clear? Now, equity represents residual ownership of the business. Why residual? In case the company is getting wound up, I will first pay all the outsiders, debt holders, people from whom I've borrowed and all. I will also pay preference shareholders, and whatever balance is left out, that only belongs to me. That's why we call it as residual ownership. So the claim on all assets and cash flows only after every other obligation has been fulfilled, fully satisfied. Is that clear, guys? Guys, literally I'm starting from the scratch, right? Even intermediate area I'm going to do, so that I'm setting the ground for everyone. Now, because this residual claim has no fixed maturity date, no guaranteed coupon payments, valuing equity is inherently more complex and subjective than valuing debt. Is that clear? There is no contractual obligation, which means you need to use some assumptions and all these things, right? One of the assumptions is Gordon model, which you've seen at the intermediate level, but anyways, we will be doing it here. In this section, we will cover in detail the various methods of valuing an equity share. So now, guys, we are entering into valuation. I told you, please keep that in your mind. Now we are going to see what are the different ways and methods using which I can value an equity share. Is that clear? Now, guys, here, this entire section of your equity valuation, I have actually bifurcated like this. You can't actually find this exact bifurcation in your study material, but based on going through every single page and every single line of your study material, basically I have bifurcated it like this. Is that clear? Now, equity valuation, right, can be done based on three models. One is based on your dividend discount model, dividend based model, that is discounting your dividends and arriving at the value of equity share. This is one way of valuing your equity share. Is that clear, guys? Now, dividend based model, further there are bifurcations. One is a zero growth model. What do you mean by zero growth model? I will assume that I will receive the same amount of dividend for the rest of my life. Perpetual. Same amount of dividend. Equal cash flows received up to perpetuity. Is that clear? Time value of money. Next, constant growth model means what? I will receive a dividend in year one, and every year it grows by a same amount, same percentage. The growth rate is constant. Gordon's model. Is that clear, guys? Now there is something called variable growth rate model. What it is, we will see. Ideally, this is also a part of your CA intermediate only, right? A very, very, very important model. Based on this only the upcoming chapters are built. Business valuation and other things. Very, very important model we will be seeing. And there is something called as H model, right? I can see that smile. So this model, actually, ICAI has given one formula in one corner of your study material. There is not even a single illustration, single example, no question at all. But they framed a numerical problem out of this, and they asked in the toughest attempt, May 26 exam. So do not worry, we will be learning this also. Basically, guys, ideally speaking, it's not a very separate model. It is an offroot of variable growth model. What it is, we will see later. Is that clear? And once again, we will be doing it with a numerical problem. Any kind of difficult attempt also you will be able to crack. Now, guys, in your portfolio management, mutual funds, risk management, all other chapters, I actually proved it in the classroom that with our explanation and with whatever you're learning in the classroom, you were able to handle those questions. And it's going to be exactly the same for this chapter also. H model, and all the problem is, there was no numerical problem. I felt, at least in an RTP, they could have given one numerical problem, and then it would have landed in an exam. Else, students found it very difficult. Directly H model, people thought it was theory. Right? One formula is given, who is going to test? But they didn't give even a single illustration. Directly it landed in an exam. But anyways, guys, we will be prepared for anything. Is that clear, guys? So we'll be doing all of that. So this is dividend based models. Then you have something called as cash flow based models. Under that, you have something called as free cash flow to the firm and free cash flow to equity. What is what we'll be seeing at the later point of time. I'm just giving you guys a perspective right now. And then you have other alternative models like earnings growth model. You have something called as PE multiplier. You guys know PE? What does PE stands for? Price earnings ratio. Once again, intermediate area. Yield approach and Walters model. You guys have seen Walters model where CA intermediate. Yes, dividend policy. Your dividend policy chapter, ideally speaking, the first three. This is also part of your dividend decisions. This is also a part of your dividend decisions. But do not worry. Do not worry. As I promised you, I will give you guys a background and only then we will proceed. Do not worry about it. Is that clear, guys? Hence, if you notice, equity valuation has a lot of references to your CA intermediate. I will give you guys a background wherever required and we will get into it. Is that clear, guys? Is that clear? This is the bird's eye view of this particular area section called as what? Equity valuation. Is that clear? Now, first, let's get into the first part of this section, which is what? Dividend-based valuation models. Shall we get started, guys? Shall we get started? Yes. Now, guys, let me give you an example. As usual, in our signature style, we will learn it with the help of examples and we will transition into the subject. Now, guys, let us say, I'm going to invest in a particular stock. Okay, I'm going to invest in a particular stock and I'm planning to hold it for 1 year. Okay, I'm planning to hold it for 1 year. Now, after 1 year, I'm expecting to receive a dividend of, let us say, 10 rupees. Right? And after 1 year, I feel that I can sell it in the market, sell it in the secondary market for, let us say, 150 rupees. Is that clear, guys? Is that clear, guys? And let us say my rate of return expectation, my R, the discount rate for me is example, let us say 10%. Let us say is 10%. So what did I tell you? If I invest in a share, I am planning to hold it for 1 year. And at the end of first year, I will be receiving a dividend of 10 rupees. And I can sell this share for 150 rupees. And my rate of return is how much? R is how much? 10%. And period of holding N is how much? 1 year. Now, can you tell me what is the present value? The present value of this equity share. Can I say it is nothing but 10 divided by 1 plus R, 1.1 to the power 1 plus 150 divided by 1 plus 0.1 to the power 1. Am I right, guys? Am I right in saying this? What did I do? Simple. Present value of all the future benefits I'm going to receive. The value of anything is nothing but the present value of all the future benefits. Am I right, guys? This is what we saw in time value of money. Hello, guys? Yes. So whatever this is worth, how much is it? Can anyone help me out with the figures? 10 by 1.1 is 9.09. Plus 150 by 1.1 is how much? 136, 136.36 roughly. Okay, so it's going to be how much? So roughly it comes to around 145.45 rupees. So can I say this is the intrinsic value, the fair value, the correct value of what? Of this particular share. Am I right, guys? Am I right, guys? 145.45 rupees, the correct value. If in the market it is quoting at 150 rupees, I'll say it's overvalued. If I have the stock, I will sell it. Or if I don't have the stock also, what will I do? I can do a short selling, sell first and then buy later. Now suppose if in the market price, actual market price is only 120. I know it is worth 145, but it's actually quoting at a discount right now. The market is quoting less, so I will go buy it, guys. And I know eventually it will come back to this price and then I can sell it later. I can book a profit. Is that clear? So first for me to arrive at this decision, I arrive at the intrinsic value. Am I right, guys? Am I right, guys? Is that clear? Now, perfect. This is all it is. This is how you need to value a stock. But the issue here is, in this case, I was very clear. I told you I'm going to hold this share for 1 year. But you guys tell me, if I'm a long-term investor, can I exactly tell you the period of holding at the time when I'm purchasing the share? No. I told the example of my grandmother. She bought it in 1950s, 1960s, around that time she purchased, and she still holds it. She still holds it. So here, basically, long-term investors, the people who stay in the game for a long period of time, that's when money compounds, money multiplies. Is that clear? Now, you don't have a definite period when it comes to equity. Is that clear, guys? That is one uniqueness of this instrument. Whereas if I'm investing in a bond, I know bond comes with a maturity. 10-year bond, 8-year bond. After that, the company will repay back the money to me. Is that clear? But there is no concept of repayment in case of equity. And at the time of purchase, I cannot, if I'm a long-term investor, I cannot come with what? An exact period of holding. Is this clear, guys? And hence, we are forced to use Gordon's model. What is Gordon's model? We saw that, right? So up to perpetuity. So how do you use all those things is what we are going to see here. Is that clear, guys? Is that clear? Not exactly Gordon's model alone. So based on your, if the dividend is going to be constant throughout, zero growth rate, constant growth rate, or variable growth rate, or it could even be a H model, whatever it is. In this case, basically, guys, the life is going to be perpetual. And when the life is perpetual, how do you value your equity is predominant portion of discussion in this particular chapter. Is everybody able to understand? Is everybody able to understand? Perfect. Now, based on this, let's get started. So this is exactly what I've said. P0 is equal to D1 divided by 1 plus KE to the power 1 plus P1 divided by 1 plus KE to the power 1. Is that clear? Or in other words, I can say D1 plus P1 divided by 1 plus KE to the power 1, assuming I'm going to hold it only for 1 year. But however, in most of the cases, equity shares are held for an indefinite period, not infinite, indefinite. I do not know till when I'm going to hold it. Is that clear? Which means multi-holding period. In such cases, equity valuations will be done based on the Gordon's model, right? About which we'll study in detail. Is everybody able to get this? Is everybody able to get this? Now, guys, in time value of money, we saw R, right? R is the rate of return, discount rate. Now, guys, when I'm talking about an equity share, R is nothing but KE. What do you mean by KE? Cost of equity. Now, it is cost from the perspective of the company. From the perspective of the investor, in this case, an equity shareholder, what is it? It's a expectation of return. So, I am expecting so much. Is that clear? Hence, the appropriate discount rate in case of equity, can I say it's nothing but KE? Guys, is everybody able to understand? And I told you earlier itself, one person's cost is another person's return. So every financial transaction has two sides to it. You go buy a packet of biscuit. For you, you pay 10 rupees. For you, that 10 rupees is a cost. For the shopkeeper, it's a return. It's a revenue for him. So here, cost is from the perspective of company. No doubt. That's why you call it as KE. But ideally, this is nothing but an expected return from the perspective of an investor. Is that clear? It need not be the actual return. It's expectation, because our entire subject revolves around the concept of opportunity cost. What do you expect? Not actuals. So actuals, you record it in financial reporting. Here we are taking decisions before a transaction happens. So which means you can't work with actuals. You are taking decision. This subject dwells around decision making. We are not doing a post-mortem work here. Is everyone able to understand? Hence, for the purpose of equity, R, the appropriate discount rate is what? KE. Is everybody able to understand this? Right. Now, before we move into the components of Gordon's formula. Now guys, I told you, there could be different models under your dividend models. I told you one is called as a zero growth model. What do you mean by a zero growth model? Let us say a company is going to ITC Limited. For every share they are going to pay me a dividend of 8 rupees, right? For how many years? Up to perpetuity. So will it change? I'm saying no. There is going to be zero growth, which means, can I say I'm going to receive a constant cash flow up to perpetuity? Am I right on this? Guys, am I right? In this case, sum of, now how do I arrive at the intrinsic value, the present value of the share? Sum total of all the cash flows received up to perpetuity. And in this case, the cash flow is going to be equal. Am I right, guys? Am I right, guys? Now, in this case, how do I do it? Now we saw, if you are going to have an equal cash flow up to perpetuity, what is the formula? Annual cash flow divided by discount rate. Guys, in this case, annual cash flow is dividend. Discount rate is KE. Hello, guys, come on, answer back. Yes, this is exactly what we saw in time value of money. Now, we are just giving it a different name for this instrument, equity. Hence, can I say, in case of a zero growth model, which means I'm going to receive a constant dividend up to perpetuity, can I say the formula to calculate the present value of equity share is going to be annual dividend divided by KE, and this is exactly what the formula says. P0. P0 means what? The price as on today, 0. P0 is equal to D. D stands for annual dividend divided by KE. That is nothing but the rate of return or your discount rate. Is everyone able to understand? That's about it. Now you are able to connect the dots, guys. Are you able to get this? This is the reason I started off with your time value of money area. Is everybody able to get this? Yes. Next. Now, no sir. Practically saying, will I receive the same amount without any growth every year? No. Hence, you have the second model. Under this dividend discount model, you have a second model. It is called as a constant growth rate model. Now, what is the meaning of this constant growth rate model? Here, I am not going to receive the same amount of dividend. Every year, the dividend amount will increase by a constant growth rate. Am I right, guys? Guys, yes. Every year, I will be receiving. Let us say, for example, the first year, the dividend was 10 rupees. They are saying every year the dividend amount will increase by 5%. The second year's dividend will be 10 into 1.05. Am I right? The third year's dividend will be 5% more as compared to the second year. So second year was 10 into 1.05. Third year will be into one more 1.05. I will say 1.05 square. Guys, getting it? And it keeps on going like this for. Hello? So here I'm not receiving equal amount up to perpetuity, whereas I'm going to actually receive what? A dividend amount that grows every year at a constant rate. That's why you call it as a constant growth model. Don't say constant dividend. It's constant growth rate, which means every year the cash flow changes, yes, but it's going to increase at a constant rate. In this case, we have seen any formula to calculate this in time value of money? Yes. Now there, what did we see? There we saw the concept of what? Growing cash flows up to perpetuity. There we saw what your geometric progression series. Based on that, I derived what was the formula to calculate that? Come on. Cash flow at the end of year 1 divided by discount rate minus growth rate. Guys, everyone, this is exactly what we saw. I proved it also. Hello? Yes, we saw this, right? And I proved with the derivation. Now, in case of an equity share, cash flow at the end of year 1, can I say it is D1? Hello? Divided by, what is the discount rate here? KE minus growth rate. And this is exactly the formula which Mr. Gordon has mentioned. P0 is equal to D1. It is not D to the power 1. Change it. It is D1 divided by KE minus G. Is everybody able to understand? We have derived this. And this is exactly what this guy has put it. 8th standard mathematics. Is that clear, guys? D1 divided by KE plus G. Is everybody able to get this, guys? Guys, come on, please answer back. You are all able to understand this? We have seen the derivation in detail. Online folks, if you have not watched time value of money, right away pause the video now, go back, watch time value of money and come back. Without that, you cannot understand. Please, I humbly request you, go back, watch time value of money. That's the core here. That's the reason we spend so much time, right? Now coming back here, you guys are able to get this, right? D1 by KE minus D. And guys, recall. I told you, Gordon ideally gave the formula to calculate P0. But this formula we reverse work and we arrive at KE. And we say Gordon's formula to calculate KE. Ideally speaking, Gordon didn't give any formula to calculate KE. Is that clear? So generally, we don't use Gordon's formula for KE calculation. There in portfolio management, we've seen. But here, suppose if the data relating to Gordon is only given, where they had given P0, they have given all of the data, KE alone is missing, then as a missing figure, you can calculate KE. Am I right, guys? Yes, that is possible. But remember, ideally, KE, there are different ways to calculate KE. I will come back to that once again at your intermediate level we have done. But one of the most popular models to calculate KE is what? CAPM method. We have seen that, right? Your Williams-Shapps CAPM, RF plus beta times RM minus RF. That's the best method to calculate KE, but any which ways, we'll be seeing all of that. Guys, are you all able to understand? So now tell me, what is the formula under Gordon's model? P1 divided by KE minus D. So what is this? P0 is equal to D1 by KE minus G. So basically Gordon has given the model to calculate what? The intrinsic value, the correct value, the fair value of a stock. Is everyone able to understand? And guys, one of the fundamental assumptions, when can you use this formula? Only when your dividend is going to grow at a constant rate up to perpetuity. Is that clear? Is that clear, everyone? When, guys, one second. The previous one we saw, no? Zero growth rate model. Zero growth rate model. There, ideally speaking, now I can apply this formula once again there also. Basically, what will happen? D1, there is no D1, there is only D. D is equal to D1 is equal to D2 is equal to D3 because it is going to be constant. Divided by KE minus D is how much? There is no growth, 0. Hence, ideally, that formula is also based on Gordon only, where G is equal to 0. That's about it. Is everybody able to understand? That's why I commonly called it as Gordon's model. Is that clear, guys? If you want, you can apply this formula. Take G as 0. That's about it. And there is nothing called D1 there. D is equal to D1 is equal to D. Every year it's going to be the constant amount. Zero growth model. So ideally, you can use the same formula there also. Is everybody able to get this? Guys, everyone getting it? Now, guys, our entire subject predominantly from now on revolves around Gordon's model. Is that clear? And hence, we have to break down the ingredients of Gordon's model. D1, how do you compute D1? How do you compute KE? And of course, G, how do you compute G? Literally right now what we are going to do is, we are going to break down the ingredients of this Gordon's model. We are going to be seeing this in length and breadth. And guys, predominantly this is where your CA intermediate area comes into play. But as I promised, I'll be actually giving you guys a background there as well. I request you all to please catch up running notes. It's very, very important, because from now on we are going to see this core of valuation using what? Gordon's formula. Shall we get started, guys? Yes, let's get started. Now, the first thing that I want to share with you all is something relating to your intermediate level. You guys know the format of income statement? Hello? You guys know the format of income statement? Yes. Now, I'll tell you. Sales minus. Now, all your operating costs. Operating cost means whatever is the cost you consider in your costing area. Right? Basically, it could be your any cost relating to your operations, be it your cost incurred in the factory, cost incurred in your corporate office, administration overheads and all, cost incurred in your sales area, your selling and distribution overheads and all these things. All these things are hidden inside operating costs. If you subtract that, you get something called as EBIT. This is also known as operating profit. You guys are aware of this? Guys, everyone, this is your intermediate. Right? Now this can also be presented in marginal costing income statement. Sales minus variable cost is equal to contribution minus fixed cost is equal to EBIT. But I'm not getting into all those things. I'm only focused more about right now at the final level. I'm focused about the financial aspect of it. Right? Now from EBIT, what will you subtract, guys? All these things you should know. You will subtract first interest. Right? Now if you subtract interest, what do you get? You get EBT. Am I right? Now from this EBT, you will subtract what? Yes, you will subtract your tax. Now you arrive at what? EAT, earnings after tax, or PAT, profit after tax. Everything is same. From this, what will you subtract? Yes, you will have to subtract preference dividend. Correct? It is not a tax allowable expense. Alright? Now, whatever you get here, can I say this is the earnings available to equity shareholders? Now, classroom discussion, I call it as EFE. EFE stands for earnings for equity shareholders. Is that clear, guys? Is that clear? Everyone? Guys, getting this, all these are very basic things at your intermediate level you should be knowing. Now, this divided by number of equity shares, if I do, I get something called as EPS. You guys are aware of this? Earnings per share. You guys are aware of this, guys? Everyone? Right? And one more thing, guys, this EFE is what? Earnings available for equity shareholders. Am I right? Now, out of this, the company can pay one portion and call it as dividend, and the balance amount they can keep it with themselves. This is called as retained earnings. Is this clear, guys? Yes, everybody able to understand? These are some basics that you guys should already be knowing, and I hope you guys are aware of this. Is that clear, guys? Fine. Now, guys, there are some basic aspects that I want to cover. Quickly, we will cover all of this, and then we will move into some numerical problems. Shall we get started? Yes. Now, guys, let us say, for example, EPS is equal to 10 rupees. Okay. Now, out of this 10 rupees, let us say the company paid a dividend per share. Can I call it as DPS? DPS means dividend per share. Let us say the company paid a DPS of 2 rupees. Hello? Which means, can I say the retained earnings per share, REPS, retained earnings per share is 8 rupees. Hello? Guys, getting it? Everyone. Are you all able to understand? Now, guys, how much the company earn per share? 10. Out of this, they paid only 2 rupees. Now, can I say the dividend payout ratio is going to be DPS upon EPS? That's nothing but 2 by 10 is going to be 20%. Hello? Or I can say 0.2. What do you mean by dividend payout ratio? Out of my total earnings, how much has been paid out as dividend is called as dividend payout ratio. Hello, everyone. Guys, getting it? Now, in this case, balance 8 rupees is actually retained by the company. Now, this is called as retention ratio. Retention ratio is what? Here it's 8 by 10. I'll say it's 80%. Am I right, guys? Guys, come on, everyone. All these are very basics. You guys are able to understand this? Yes. So, retention ratio means what? Out of the total earnings, how much have I retained? Payout ratio means, dividend payout ratio means out of the total earnings, how much have I paid out? Is this clear, guys? Is everybody able to understand? Any issue here? No. Now, guys, can I say the dividend payout ratio plus my retention ratio is equal to 100%? Ratio, it's not equal to EPS. Is equal to 100%, or I can say 1. Hello? Guys, getting it? Is everybody able to understand? So, which means in the question they have given, dividend payout ratio is 30%, which means retention ratio is 70%. Guys, are you all able to understand? Anyone, everybody? Yes. And guys, remember, this retention ratio is there, no? Retention ratio, it's a very useful ratio for calculations. We'll see further calculations. Generally, this retention ratio is denoted using an alphabet called B. You guys know that? G is equal to BR and all. You guys should have actually studied. B stands for retention ratio. So, the retention ratio has an alphabet. Payout ratio, no alphabet. Payout ratio, you call it as 1 minus B. Is that clear? Guys, are you all able to understand? Guys, whatever I'm telling you, you will be seeing in all numerical problems. That's why I'm starting it from the scratch. Is this clear, guys? Everyone? Perfect. Next. Now, guys, let's say a company has a share has a face value of 100 rupees. All right. Let us say the dividend rate is going to be 10%. Can you tell me how much the dividend per share? How much the dividend per share? Come on, everyone. It might be silly, but I have a reason. How much is this? 10 rupees. Always remember, dividend rate is different from dividend payout ratio. Students, they will say yes sir. They will commit this mistake in exam. Rate means dividend declared on a percentage of face value. Is that clear? Whereas dividend payout ratio, what is that? Out of my earnings, how much am I paying out? So clearly these two are different. That's the reason I actually wanted to mention this. Dividend rate, if it is given, it is what? A percentage on the face value, and the payout ratio is actually a percentage on the EPS or on the earnings. Is that clear, everyone? Guys, getting this? Any issues, any problem here? No. Guys, yes, are we down here? Great. Now, guys, tell me, in this case, okay, so what is going to be my formula for Gordon's model? P0 is equal to, come on everyone, D1 divided by KE minus G. Am I right, guys? Now, let me show you the different variants with which I can write this formula. Different variants with which I can write this formula. Now, can I say this is one variant of writing this formula? P0 is equal to D1 divided by KE minus D. This is one variant. Or can I say this is nothing but instead of writing D1, can I say it is D0 into 1 plus G? Guys, D1 is the dividend at the end of first year. And every year it's going to grow. Suppose I have the previous last paid dividend, I can say the next year dividend is going to be D0 into 1 plus D. I get D1. So D1 can be rewritten as what? D0 into 1 plus D divided by KE minus D. Am I right, guys? Guys, everybody understanding this? Now, another way of writing it. Now, can I say, guys, D1? I need D1 in my numerator. Can I say it is nothing but E1 into 1 minus B? What are you thinking? 1 minus B. B stands for retention ratio. Right? 1 minus B is payout ratio. E1 is earnings at the end of year 1. So EPS into dividend payout ratio gives me my dividend value. Are you guys able to understand? Guys, they could actually twist the question like anything. And you must be able to answer it all. When students mug this up as different formulas, they are not different formulas. Base is only one. Is everyone able to understand? Is everyone able to understand? So divided by what? KE minus D. This is another way of writing. Now, furthermore, can I do one more thing? If E1 is not given, instead E0 is given, can I say E0 into 1 plus D? If you do this, you get what? E1. Further into 1 minus B, you get D1 divided by KE minus D. Guys, are you all able to understand this? Now, this might look like a big formula, but actually this is nothing but logic. Is everyone able to understand? I have the past earnings. If you adjust it for growth, you get E1. But I am not discounting E1. I want D1. So, into 1 minus B. B stands for retention ratio. 1 minus B, payout ratio. So, E1 into what? Payout ratio, dividend payout ratio gives you D1. And then use this. Is this clear, guys? Now, depending on the data available, you can do it. Should you mug this up, you tell me. No. Depending on the data given in the question, you can approach it. Simple, isn't it so? Perfect. That's about it. Now, guys, in this we have seen different ways in which you can arrive at what D1. Now, let's move on to the next one. It is KE. Now, what do you mean by KE? Investors' expectation of return. Am I right, guys? Now, at the CA intermediate level, in a chapter called Cost of Capital, you would have seen there are different ways in which you can calculate KE. Guys, correct? Right? Now, I have mentioned a brief about this in our doubt busters. One second. Yes, I have mentioned a brief about this in our doubt busters. Now, what am I going to do is, I'm going to just open our CA Inter FM book and quickly just walk you through this. Okay, sir, this book, sir, where is it? Okay, I'll just quickly show that also. So you can just go to the website, Costfin.in. You can go here, and guys, on the top, can you see this free resources? Hello? You can just click on the free resources, CA Intermediate, and you can see all these things. So FM ebooks, and here if you go, you can download our concept decoder. Alright, I think the internet is slow here. But anyways, guys, so you get an idea. So this is, you can download it in case you need to take some reference, because guys, at the final level, this cost of capital chapter, references will be there, and even your ratio analysis. Lot of ratios will be coming. Lot of ratios. Your stock turnover ratio, asset turnover ratio, all these things will come into picture. So that's not a part of your CA final. It's a part of CA Inter, and institute expects you to know all that. It's better. You can have download the soft copy and keep. Right? Whenever you want to take a reference, you can take, especially ratio analysis. We've taken a lot of time at the intermediate level in decoding every single formula. Right? So everything is logical. Nothing needs to be mugged up. That's how we actually do it. Right? So in case you want, you can have a look at it there. Fine, guys. So now quickly, I'm just going to walk you through regarding the different ways in which you can arrive at KE. So in exam, which method should I follow? Simple. Depending on the data available, you follow the method. Is that clear, guys? There is no hard and fast rule. I am telling you the best method is CAPM. We've already seen that in portfolio. Don't say, sir, I will only follow CAPM, sir. You give me that data. No, whatever data is available, even if Gordon data is available, do it. Is that clear, guys? Right? Now, first one, there's something called as dividend price model. Now, what do you mean by dividend price model? Guys, we know if dividend, the assumption here is dividend is going to be constant. When dividend is constant, now we say P0 is equal to annual cash flow divided by discount rate, D divided by KE. Now, swap the values here. So, KE is equal to D divided by P0. Is that clear, guys? So, this is one way of arriving at KE. When will you use this formula? Assumption dividend is actually going to be constant throughout. Is that clear? I'm talking about KE value. We are not talking about valuation P0. I'm just trying to calculate KE. These are different methods. Is that clear? Sir, is there a quick way to remember? Yes. Numerator is what I receive. Denominator is what I pay. Guys, from an investor's perspective, every year I'll be receiving dividend. So what I receive upon what I pay. Is that clear, guys? This is one way of calculating. This is called dividend price model. Assumption, no growth. Now, sir, why am I taking dividend, sir? I can take entire earning, it belongs to me. Yes, that is called as earnings price model. Here, instead of D, you put it as E. So it's going to be EPS divided by what? Your price, P0. Is that clear? Are you all able to understand? Guys, getting this, all these things I've mentioned here, ma. All these things I've just mentioned here quickly. Look at this. I mentioned earnings yield approaches, EPS by MPS. MPS nothing but P. Is that clear, guys? I've mentioned it here quickly, but anyways, I just wanted to walk you through this. Is that clear? Now, in case of Gordon's model, I told you Gordon didn't give the formula to calculate KE. What formula he gave? This formula, P0 is equal to D1 by KE minus D. Am I right, guys? So now, Gordon gave this formula, P0 is equal to D1 divided by KE minus D. Suppose in a question, all other ingredients are given except KE. Can you calculate? Yes. How do you do it? I'll put this here. KE minus D is equal to D1 by P0. Guys, I'm taking this here and bringing this down here. Guys, and now what will I do? KE is equal to D1 divided by P0 plus G. Is that clear? Are you all able to understand? Yes. And I told you this is one of the worst formulas to calculate KE. And Gordon has a beautiful formula to calculate P0. For this, it is good. That's why in portfolio management, we never used Gordon to actually calculate KE, but we use Gordon for valuation purpose. Is that clear, guys? Why logic also I told you. When a company is growing, the risk is lesser because they are diversified. I told you the risk is lesser. When the risk is lesser, my expectation of return should also be lesser. But here, what is this guy doing? He's adding the growth. Growth has nothing to do with the return. I told you the logic also. Growth has nothing to do with the return. Return is driven only based on risk. Growth has everything to do with the valuation. That's why we say this is a good formula. Now, in this formula, if you want KE, arrive at this KE using CAPM is what we do generally. Is that clear? But here for academic purposes, examination purposes, suppose they are asking you to calculate KE and all in the absence of information, you can also use Gordon. Is that clear, guys? I'm setting the ground very clear here. Is everybody able to understand? Perfect. Next. Yes, so this is the formula that we're saying, D1 by P0 plus D, that's KE formula. Then guys, realize yields is fine. CAPM, you guys know CAPM? Yes, what is it? RF plus beta times RM minus RF. Here RM minus RF stands for market risk premium. Beta times RM minus RF stands for asset or security risk premium. Is this clear? Suppose if this value is given directly, don't once again multiply it with beta. All these things we have seen in portfolio management. Is everybody able to understand? That's about it. Is this clear, guys? This is exactly what I've mentioned here. Decoding KE. KE is one of the ingredients in Gordon. We are actually breaking Gordon's formula one by one. Is that clear, guys? Which formula to use? KE is almost always derived using CAPM formula. That is the best formula in the market. We saw that. Is that clear? Even though Stephen Ross developed and said multi-factor model, arbitrage, we saw it has some issues and all. Hence, the best formula today. I told you more than 90% of this finance world follows only CAPM. Is that clear, guys? Now, in case CAPM data is not available in exam, you can use what? Gordon's formula. Remember, Gordon never gave KE formula. He gave only P0 formula. It's a reverse work. That's why this also I've carefully mentioned it here. Is that clear? Or earnings yield approach, dividend yield approach, or opportunity cost of available alternate investment. Suppose in the question they have given. Now, if he's not investing in this equity, otherwise, if he's putting his money elsewhere, he can earn so much, which means that will be the expected return on this equity instrument. If that is given, take that itself as KE. Or if any other rate is specifically given, take it. Is that clear, guys? Now, guys, in all these cases, in the denominator, we take what? The price, right? Hello? Now, suppose they are saying in all the above formula, if the flotation costs are given, flotation cost means what? The cost that is incurred by the company to raise the money, right? Then the denominator should be the net proceeds. Net proceeds means what? Basically the amount that flows to the company. They are just switching the perspective from a company's perspective. Is that clear, guys? If flotation cost is given, since it is an outflow, reduce that also. Is everybody able to understand? Is there any issue here? Guys, getting this? Hello? Yes, that's about it. I think that's about this particular area as well. Now, let's go on to the other part, which is G. What is G? Growth rate. Now, growth rate generally will be given in the question. If it is not given in the question, once again, there is a way to calculate, right? But before that, first, let me teach you one small thing, again, your CA intermediate area only. Now, guys, have you heard of this word called ROE? What is ROE? Return on equity. Can you tell me the formula? Logically tell me. EB80, who is that? So simple, ma. What is return on investment? You know, guys know return on investment? Return upon investment. Here we are talking return for whom? Equity. So what is the amount that is available for them? EFE. So can I say EFE divided by, in the denominator, what is the amount that belongs to, what is the amount of their capital? Equity shareholders funds. Guys, correct. Equity shareholders funds. Am I right? And equity shareholder funds means what? Your equity share capital plus your reserves and surplus and all. Is this clear, guys? Is everybody able to understand? Hence, return on equity, don't mug it up. I'm an equity shareholder, right? So what is my net return? What I receive upon what is the amount that is actually my fund belongs to me. Is that clear, guys? Is everybody able to understand? Don't put it only as equity share capital. It is equity shareholders funds. Is everybody able to understand? Is everybody able to understand? Come on, guys. Is everyone able to understand? Perfect. Now, this ROE is there. No? We call it as R. And I will tell you what this is. Now, guys, there is a formula which again you would have seen in your intermediate. Growth rate G is equal to B into R. Right? You guys have seen that? Yes. But you guys know the reason why it is B into R? Okay. Fine. Now, let me tell you this. B stands for, guys, retention ratio. B stands for retention ratio. And R, just now I told you, stands for return on equity. So basically, what they are trying to say here is, the growth rate depends on two factors. Number one, how much you are retaining it. Retaining means what? Not distributing, and you're keeping it with yourself. With this money, what are you going to do? What is the company going to do? They are going to reinvest it back, and every time they invest, they are going to generate a return of how much? R percentage. So here, this is a multiple of how much you retain, and with this retained earnings, how much you generate again. That's why they are saying your growth rate is G is equal to B into R. Is that clear, guys? Is everybody able to understand? Now, guys, this G is equal to B into R. I will prove it. I will prove the derivation also, right? And this concept is called as sustainable growth rate. What is it called as? Sustainable growth rate. This word SGR, the sustainable growth rate concept, is actually mentioned in a chapter called Financial Policy and Corporate Strategy. Right? You have one theory chapter. In that theory chapter, there are two concepts that revolve around numerical problem. One is something called as sustainable growth rate, SGR. That is nothing but growth rate. Is that clear? The other one, there is something called external fund requirements. What it is, we will see later on. But guys, remember, this is exactly this G calculation. G is equal to BR. They have given one fancy word called sustainable growth rate. In exam, if they ask sustainable growth rate stands for G is equal to BR. Are you all able to understand? Are you all able to understand? No. Sir, can you prove that G is equal to BR? Guys, quickly I will do. All these things are 100% required for your exam. For that purpose only I'm going to do it. Now, guys, please catch up running notes. Please catch up running notes. Now, I'll give you guys an example. Now let's say guys, my equity share capital, example, my equity share capital is 50 lakh rupees. My equity share capital is how much? 50 lakh rupees. I'm talking about year 1. Okay. Now, retained earnings, I don't have any retained earnings with me. Is that clear? Yes. So now, my equity shareholders funds, how much is it? 50 lakh rupees. Guys, getting it? Getting it? Yes. Now, let us say, okay, how much is my earnings? How much is my earnings? Let us say EFE after paying everyone. Let us say my earnings is, okay, our return on equity was, let us say guys, 20%. Example, return on equity was 20%. So can I say my EFE is going to be, so when R is equal to 20%, earnings for equity will be how much? 50 lakh into 20%. I'm earning 20% on my equity shareholders funds. So how much is my earnings? Guys, it's going to be 10 lakhs. Am I right, guys? Hello? So I'm just taking an assumption here. R is equal to 20%. Is that clear? There's nothing but return on equity. Is this clear, guys? Now, let us say, guys, I'm paying out a dividend. Let us say my dividend payout ratio is 50%. Is 50%, which means totally what is the amount of dividend I would have paid? Hello? Dividend payout ratio is 50%. How much the total amount of dividend I would have paid? Guys, what are you thinking? I have earned 10 lakh rupees. On a per share level, you said EPS into this, into payout ratio. Now, in total, I'm mentioning this is nothing but your earning per share into number of shares. Overall value is given. Same only, no? Hello? You guys tell me, no? So now, payout ratio is 50% means total dividend paid to all the shareholders put together is how much? 5 lakhs. Am I right, guys? Which means, can I say, the retained earnings, how much will it go, how much is it going to be? 5 lakh. I earned 10, I paid 5, I'm retaining 5. Am I right, guys? Hello, guys, please answer back. You guys are understanding? Yes. Let's say year 2. Now, year 2, you guys tell me. Now I'm starting off. What will be my equity share capital? Hello, equity share capital 50 lakh. Now, what is going to be my retained earnings? Now, 0 plus 5 lakhs. Last year I earned 5 lakh and that I'm going to keep with me. Is that clear? Now, at the end of year 2, what is my equity shareholders funds? Hello? It's going to be 55 lakhs. Am I right, guys? Now, assume R is not changing. R is what? Your return on equity. So now, can you guys tell me what is my EFE? What is my EFE? It's going to be 20% on 55 lakhs. How much is it? So I'm earning 11 lakh rupees. This amount belongs to equity shareholders, and assumption there is no change at all. Payout ratio continues to be what? 50%. So what is the dividend paid? It's going to be 50% on 11 lakhs. How much is that? 5.5 lakhs. How much is my retained earnings? This is year 2's retained earnings. How much is it? 5.5 lakhs. Is everybody able to understand? Now let us do one more year. Year 3. Now you guys tell me how much is the equity share capital? 50 lakhs. This is not going to change. What's going to be my retained earnings? Sir, opening balance I had 5 lakhs and previous year I had saved up 5.5 lakhs for myself. How much is it now? 10 lakh 50,000. 10.5 lakh. Now tell me, guys, what is my equity shareholders funds? It's going to be 60.5 lakhs. Am I right, guys? Am I right? Now, year 3, can you tell me what is the earnings? EFE 20% on 60.5 lakhs. How much is that? So 12.1 lakh. Yes. How much is going to be my dividend? I'm going to pay the same 50% payout only. Into 12.1 lakh. How much is that? 6.05 lakhs. And what is going to be my retained earnings? The balancing figure. This is year 3. How much is it? 6.05 lakhs. Guys, are we getting this? Are we getting this? No. Now, let me put it in a tabular format here. Let us say year 1, year 2, and year 3. I want the figures from you all. How much was my earnings? How much was my dividend year on year? Year 1, how much was my earnings? Guys. You guys have written down, right? How much was it? 10 lakh. Dividend was 5 lakhs. Huh? Can I say 10 lakh, 5 lakh? Year 2, what happened? Hello? 11 lakh, 5.5 lakhs. 11 lakh, 5.5 lakh. Year 3, 12.1 lakh and 6.05 lakh. Am I right, guys? Am I right, guys? Now, if you notice, guys, the final touch, that's all. Year 1 to year 2, based on the earnings, by how much has my earnings grown by? 1 lakh. As a percentage? Come on, guys. 1 lakh divided by 10 lakh into 100. Come on, tell me, guys, how much is it? It has increased by 10%. From year 2 to year 3, by how much has it increased? The difference is 12.1 minus 11 is 1.1. 1.1 divided by 11, how much is it? Same 10%. Now look at this. Earnings. 5 lakh increased by 50,000. So 50,000 by 5 lakh, 10%. Now here it has grown up by how much? 6 lakh 5,000 minus 5 lakh 50. How much is it? 65. Sorry, 55. 55,000 by 5 lakh 50,000. How much is it? 10%. Can you clearly see that the growth in earnings and the growth in dividend is how much? Guys, how much is it? 10%. Is that clear? Now, if at all I'm applying this formula, G is equal to, I said growth is equal to B into R. Now, shall we see if this matches with 10%? Now, what is my B here? Retention ratio. How much was my retention ratio? 50%. Can I say this is 0.5? Into what was my R? 10%. R was 20%. Please be awake. R was 20%. Alright? So, now it clearly proves that if you use G is equal to B into R, clearly you get your growth rate that matches with your annual year-on-year growth. Guys, are you all able to understand? Hence, you can definitely trust this formula. G is equal to B into R. Is everyone able to understand where B stands for retention ratio, R stands for return on equity? Everybody getting this? Guys, getting this? Now, remember one thing, guys. Remember one thing, very important thing. This will hold good based on the assumptions of Gordon. What does Gordon assume? Now, my growth rate is going to be constant up to perpetuity. Now, for that growth rate to be constant up to perpetuity, ingredients of growth rate is what? B and R. So, retention ratio has to be constant up to perpetuity. Even the return on equity has to be constant up to perpetuity. Sir, if it is not constant, then you can't use Gordon's model. Is that clear, guys? Is that clear, guys? But when you're talking about perpetuity, there has to be some assumption based on which you should take. Else you should tell me year on year how much is the growth. If you're doing it year on year, then it is not called perpetual. Guys, are you getting it? Hence, these are the fundamental assumptions based on which we build the subject. Are you all able to understand? That's why I'm spending so much time at the, at the beginning level itself, because remember, we are sharpening the axe. Abraham Lincoln saying, if you give me 6 hours to chop down a tree, I will spend the first 4 sharpening the axe. And you guys will see the difference by yourself. That's all it is. Is that clear, guys? Is that clear? Now, fundamentals are clear with you. Now, going back to the formula here, what was it? P0 is equal to D1 by KE minus T. D1, I told you there are multiple ways in which you can write D1. Right? We saw all these things here. Right? KE, we saw there are multiple ways in which you can value KE. Right? Dividend price model, earning price model, your dividend growth, your Gordon's model. Then you have CAPM and so many methods. G is equal to B into R. This is another way of actually calculating it. Is that clear? Is that clear? If you want, this also you can expand. So in one of these formulas, you can say instead of G, you can write BR. Guys, that is also another formula. So some students even mug that also. Guys, don't mug it up. It's simple. Is this clear, guys? Everybody able to understand? That's about this area. Now, guys, our entire subject from now revolves around Gordon. That's why I'm spending so much time, so that we can actually be very clear about this area. Are we done? Are we done? Now, I told you, in real life, generally, what do? We use Gordon's model. Now, in Gordon's model, basically, why do we use Gordon's model? To calculate the intrinsic value, correct value of the share. Now, for me to do that, one of the ingredients is KE. And generally, this KE we calculate using CAPM. I told you. Is that clear, guys? Generally, this is how we do. And CAPM deals with what? Expected return, risk and return concept. That's why we did it there in your portfolio management area. Is that clear, guys? Are you all able to understand? This is where I told you Gordon meets William Sharp. Getting it? Getting it. Right, guys? Fine. Okay. So that's about the introduction. Now, can we just go and do some numerical problems? Yes, guys? Can we just go and do some numerical problems in this area? We'll do some numerical problems, and with that, the first session we will wind up, right? Because the first session I don't want to overload a lot, so we will do some numerical problems. Okay, so please take TYK question number 8. TYK question number 8, guys. I think it's on page number 121. Okay, please take it. Okay, guys, shall we do the sum? Hello, come on, guys, come on, guys. Guys, do it with lots of passion. Please do it with lots of passion. Don't have the feeling I have to do this. No, do it with passion automatically. I keep telling you this. Guys, 95% of your preparation gets over in the classroom. You are already preparing for your exam. Right? Just a little bit revision and homework sums and you're there. That's about it. So please make the best use of the classroom time. Now, can we do this first question, guys? No? Yes, let's do this. Question number 8. ABC Limited has been maintaining a growth rate of 10% in dividends, which means, what's your G? Perfect. Now, the company has paid a dividend of rupees 3. Now, guys, they have used the word paid, which means it is D0. Now, guys, one second, this is a controversial area. What ICA has been doing right from Inter as well as in final, ICA has not changed in this aspect. So what they have done is, even though at times they have given paid, they take this figure itself as D1. Suppose they have given expected dividend is so much, ideally that itself is D1, they take that as D0. Sir, what do we do, sir? Simple. Whenever you find dividend, always write a note. Okay, and we will take a policy. We will take a standard policy. What is it? If past tense has been used, paid, then we will take it as D0, which means it has to be adjusted for the growth rate to arrive at D1. If they have used a future tense, expected dividend or dividend expected to be received, we will take it as D1. But irrespective of that, we will write a note. Is that clear, guys? Why? What more can you do? Institute has been taking inconsistent stance. Suddenly they take it as D1, suddenly they take it as D0, we can't do anything. And in exam, I won't ask you to write, take one assumption as D0, solve the answer. One assumption as D1, solve the answer. As it is, we are not having time. Now, all these and all, we can't do this in exam. So, please watch out for this. Okay, always whenever dividend comes, write a note. Shall we do, let's continue reading this. Okay, the company has paid a dividend of what? 3 rupees. So, we'll take it as D0. The rate of return on the market portfolio is 12% and the risk-free rate of return on the market has been observed as 8%. The beta coefficient of the company's share is 1.5 and you are required to calculate the expected rate of return on the company's share as per CAPM model. And guys, what have they mentioned? Equilibrium price per share as per dividend growth model. Equilibrium means fair price, correct price, intrinsic price. Always remember the word equilibrium. Equilibrium means, guys, one second. I told you, right? Let us say the fair price is 100. As per our calculation, Gordon's model, market at present it is quoting at, let us say, 105. Undervalued or overvalued? Think overvalued. Now. What will you do? You will sell it. You think you are the only one who has spotted this? No. The market is very sharp. Your all investors are rational. Now I told you algo trading and all. Immediately it spots this opportunity. The selling pressure will kick in. Once selling is more, supply is more, automatically the price falls down and corrects to 100. It's called equilibrium. That's why another name for this is called equilibrium price, intrinsic price, fair price, correct price. These are different terminologies. Are you guys able to understand this? Yes, suppose it is undervalued. Obviously, you'll go and buy. Buying pressure. More people are showing interest. Demand is more. Price will increase and get back to the same equilibrium price. Always remember, this is how it works. And all these things will correct in fraction of seconds. I told you, fraction of seconds. Why? Because people keep this bots and all, robots, the bots they keep, right? It's all algo based trading. The moment in a stock, all these things comes into picture. So buying and selling pressure will automatically take care of itself and automatically the price will correct. Is that clear, guys? This is how it happens and I'm just giving you the logical explanation for the word equilibrium. Now, guys, now what do we need to do here? Calculate the P0, the fair price as per Gordon formula D1 divided by KE minus D. Now D1 is not given, D0 is given. So D0 into 1 plus G. G is given, yes. The only missing data is what? KE, which means how do you calculate KE? CAPM. Why? Because ingredients of calculating CAPM Is only given in the question. And in fact, that is only the correct way of doing. Is that clear, guys? Quickly, shall we do it? Simple now. Yes, this is the reason why we started from the scratch. So now TYK question number 8. Yes, write down TYK question number 8. TYK no nee sonna TVK da nyamad. What you watch Jananayagana? I'll leave in and seri okay. I agree. You are not well. Okay. Come back, guys. Come on, let's do this. Write down step number 1. Step number 1, guys, write down calculation of KE within bracket. What method? CAPM. There are different models to calculate KE, but yeah. In this question, the ingredients to calculate KE is only as per CAPM. Come on, guys. Formula first, write down. Tell and write KE is equal to RF plus beta times RM minus RF. Guys, always remember this. Don't get too excited when you see these kind of sums. Problem is, I'm telling you, many students commit a mistake here. In this question, have they given RM? Have they given RM? Huh? How much is RM? 12%. At times, they give market risk premium. That is RM minus RF. Now, out of excitement, students take this as RM and they will do it. That's why I'm telling you, the quality of your solution depends on the way you read the question. You spend more time here, lesser will be the time you spend on the answer. Is that clear? In this question, it's fine, but I'm telling you, this is how examiners will actually twist it. Now, at times, they even give security risk premium, which means beta times R minus R value itself. Don't once again multiply with beta. So, read the question carefully. One small observation lapse, the question is gone. Right? Now, write down, guys, what is RF? Come on, quick. It's going to be 8% plus what is beta? 1.5 times what is RM? 12%. RF? 8%. Come on, guys, give me the answer. So market risk premium is 4%, right? Market risk premium is nothing but the difference between the two. Okay, guys, final answer 14%. So now can you calculate this one? Yes, write down step 2. Calculation of, use the same language, equilibrium price per share. Equilibrium, EQUILIBRIUM. Price per share. Alright, within bracket, obviously Gordon's model. Okay, now guys, just like how Mr. William Sharp ruled our risk return area, valuation is the ballpark of Mr. Gordon. He will rule this place. Is that clear? Because the beautiful model based on what? Your geometric progression series A by 1 minus R, I proved and showed it, you know. That only, so this entire valuation. Here we are not trying to calculate a return. We are trying to calculate the value, correct value, P0. Tell yourself that. Don't look at the subject from that perspective. That perspective is done. We are now looking at it from a valuation perspective. We are valuing it. Is that clear? Come on, guys. Formula P0 is equal to D1 divided by KE minus G. Now I can rewrite this as D0 into 1 plus D divided by KE minus D. Guys, the rewriting part, you can do it depending on what is available in the question. I can also rewrite this as what? E1 into 1 minus B, and also I can do, but that is not required. Based on what is required in the question, you do it. Is that clear? Is that clear, guys? Yes. Come on. Now, what is D0? 3 here. So, write down 3 into 1 plus 0.1 divided by, what's my KE? Just now we got it. Guys, one second. Now, guys, I always suggest you, when you are writing this here in the denominator, now remember, guys, when we are doing portfolio management, I only told you, if it is 14%, keep the percentage as a unit of measure. Don't convert it into decimal. Why? Because the entire chapter revolved around what? Percentages. But here the entire chapter is about calculating value. Hence, now I am telling you, in valuation, convert it into decimals. Why? Because if you keep it as 14 and do, there are chances you might commit a mistake. Is that clear? You should know what to do and where to do it also. Is that clear? Hence, I'll put it as what? 0.14 minus what's my growth rate? 0.1%, 0.10. Is that clear, guys? Come on, calculate. So there's nothing but 3.1 now. Divided by 0.04. Sorry, 3.3. Sorry. 3.3. 3.3 divided by 0.04. How much does it come out to? Rupees 82.50. Now, this is the actual market price. No, the fair cut market price, intrinsic value. I go and compare this with the actual market price and take a decision. Is that clear, guys? Right? That's about this question. Can we just go and update our library of adjustment? Simple question. Write down. Calculation of P0 using Gordon's model. Calculation of P0 using Gordon's model. Within bracket, constant growth rate. Please write down constant growth rate. Reason is you have other models also, right? Variable growth rate and other things. So write down constant growth rate, semicolon, calculation of KE using dash CAPM. Calculation of KE using dash CAPM. Are we done here? Yes, guys? Now. Now, quickly, shall we go on to the next question? Yes, let's go on to the next question, guys. So, question number 8 is done. Now, let's go on to the next question, number 9. Shall we get started? Yes. A company pays a dividend of rupees 2 per share with a growth rate of how much? 7%. Now, one second, guys. What they are saying? A company pays a dividend. Now, this is a neutral language. Paid, payable, nothing is there. Pays, you have to take a stand. Okay? For your assumption, your answer is correct. That's about it. Is that clear, guys? Alright. Now the growth rate of 7%, this is G. Risk-free rate, RF 9%. RM only no? Yes, 13%. The company has a beta factor of 1.5. Is that clear? Based on this, you can calculate KE. Then D1 by KE minus G. Is that clear? All other ingredients are given. However, due to the decision of a finance manager, the beta is likely to increase to how much? 1.75. Calculate or find out the present as well as the likely value of the share after the decision, which means you need to calculate the beta before decision, beta after decision, and of course, if beta, you need to calculate K before the decision, K after the decision, and of course, based on this, when K changes, price will change. Hence, you need to calculate 2 sets of data. Is that clear, guys? Slowly we are adding one more complexity. It's not complexity, variant. That's all. Is that clear? Shall we get started? Once again, one more thing. Guys, in real life, you want to invest in a share. Now, you first, I told you, calculate the intrinsic value. D1 divided by KE minus G. Now, in this value you can find out dividend, past data you have, adjust for 1 plus G. KE also, you can find out RF, beta, RM, beta of every stocks. It is all mentioned here. Beta represents what? Co-movement between the stock with the market and all. G, how do you get it? How do you know what is a G? The growth rate of a stock. A growth rate, it's not of a stock. The growth rate in the earnings. How will you know it in real life? Have you ever wondered? Past data is not necessarily a representative of future data. What if the company is going for expansion? How do you project? Where do you get the data? No, that is all theoretical. Past data analyzing and all is all theoretical. I'm asking about practical. Now, quickly, I will just show something since just got my attention. Okay, let's take ITC. Just a minute, I'll show you. Now I'll tell you where to see this. This is something called fundamental analysis. But let me tell you, here there's a popular tool called Screener. Okay, so there you can literally find everything. The stocks. You guys know PE ratio. What is PE ratio? Price upon earnings. MPS by EPS. Right. So if I say PE ratio is 10 times. And EPS is, let us say, 2 rupees. So my market price is 20 rupees. That is nothing but my market price. The price is actually trading at 10 times the earnings. So which means people are willing to pay 10 times the earnings to own the share. Is that clear? That is what it is. Look, ROCE, ROE, all these data are available. Now, actually, I'm not sure if many of you will know this. Shareholding pattern. Where is this con call? Documents. Okay. Here, yes. You have something called con calls. Can you see this con calls, ma? Here there's something called con calls. Can you see this? This is, I told you, right, every listed company will have to publish quarterly results. You guys know that? After the result, they do something called as a con call. They have something called as a con call. The management will actually have a con call. Basically, in this con call, they will tell the investors, look, this is what we are expecting in future. Our company is growing at this rate, and in the future, this is our expected growth rate. Is that clear? This is how they do it. Are you all able to understand? And from this con call, you will actually know the growth rate that they are talking about. It is not from the past data. In real life, that's how we analyze. When we are analyzing stocks, that's how we do it. So there could be, look at this, the frequency here, Jan, May, October. So after the quarterly results, generally they do it. Is that clear, guys? Is that clear? Now, and even between also, they can have a con call. Generally, in this con call, you get, in real life, I'm telling you, the growth figure. That's when actually, that's how we use it. So in this con call, can you see this PPT and all? So in the screener app, if you click on that, it will clearly show the presentation they use for this con call, right? And with that, you can find out. Actually, you can take this PDF, and what I do generally is I put it on Notebook LM. You guys know Notebook LM? Yes. And there, if you upload this document, based on this, you can ask questions, it will answer. I'll ask how much is the growth rate. I need not go through some 20-30 pages. And based on this, I will not just stop there. What is the basis on which they have arrived at it? Is it really a very calculated growth, or randomly they have just said this to convince investors? So you can ask these kind of questions and get it. This is how you actually do in real life. This is called fundamental analysis. I'll come more about fundamental and technical analysis, but right now, you guys are getting an idea in real life how it happens. This is how we do it. Coming back, guys. So now, can we do the sum? Yes. Guys, when you're learning something, learn it with a class. Do it, know why you're doing it, whatever you're doing it. That gives you tremendous level of confidence. The kind of confidence that you get will be something else. And it's not just, exams will be automatically taken care of. Tomorrow, someone is asking you a question. I'm telling you guys, it's not easy. Qualifying, you're saying, is difficult. Yes, I'm not denying. Once you qualify, imagine someone is asking you a question on a subject which you have cleared. You're not able to answer. You will hang your head in shame. It's not easy, guys. It is not an insult just for you. It is an insult for our institute. That's one of the biggest reasons why actually I say is tightening all these things. And I'm not kidding, guys. I mean, I have a fair idea of how things are working in the industry. Why this number of attempts from 3 got reversed back to 2 and all. There's all reasoning for that. It's all in a year. No, we have 3 attempts, 2 attempts got reduced back. There is always, once again, here also we have law of demand and supply only. It's all based on that. So, guys, I'm telling you, when you're doing something, no, how long did it take for me to explain this? 2-3 minutes extra. And you guys knew this. That's all. That's what I'm telling you. That's what I'm telling you. Know what you're doing. You will thank yourself for a lifetime. Is that clear, guys? Growth rate, I'm saying it is given in the question. That is theoretically. In real life, how will you get it? This is how you get it. Is that clear? So now let's get started, guys. This is TYK question number 9. So TYK question number 9. So now, so let's do this. Okay. Guys, you want to take this 2 rupees as D0 or D1? Huh? You want to take it as D1? Yes, you can take it, but write a note in exam. Is that clear? So now, first, what do we need to do? First, we need to calculate what? The existing KE. Guys, can we do that? Yes, write down. Part 1. Part 1, what have they asked? Find out the present as well as the likely value of the share. Write down present scenario. Present scenario. Under that, write down step number 1. What is step number 1? Calculation of KE within bracket CAPM. Guys, make it fast. We know this already. Formula K is equal to RF plus beta times RM minus RF. Figures. RF 9%. Come on guys, tell and write. RF is 9%. What is beta? 1.5. 1.5 into what is RM? 13% minus RF is going to be 9%. Can you give me the final answer? Huh? Guys, answer no. How much is it coming out to? 15%, right? Now write down step 2. Calculation of what? P0 within bracket Gordon's model. Guys, when do we use this Gordon's model? When your dividend is going to grow at a constant rate forever. Suppose if the dividend growth rate changes, sir, for the first 5 years, 10%. After that, up to perpetuity, 5%. No, then you can't use this model. That's why we have something called as variable growth rate model. Varies. The growth rate varies. In that case, what do you do? 2-stage model, 3-stage model. One of that model is only H model. Okay, we will see that later on. We'll see that later on. Now, come on, guys. Here. So, what do you do? Come on, tell me what's the formula. P0 is equal to D1 divided by KE minus G. Now, guys, we are going to take an assumption. What? That D1 is directly 2 rupees. Guys, correct? So, come on, tell me what is D1 here? 2 upon, what's KE? Guys, always write it in decimals. Make it a habit. Muscle memory. Minus, what's my growth rate? Come on, 0.07. Come on, give me the answer. So, rupees 25. Is that clear? Is that clear? Yes. So, you can write down. Please take a note here. Note. It has been assumed that D1 is equal to rupees 2. It has been assumed that D1 is equal to rupees 2. Is an alternative assumption possible? Yes. So, it has been assumed that D1 is equal to rupees 2. Full stop. Alternative assumption is also possible. You also write like ICA only. Alternative assumption is also possible. So, for my assumption, the answer is correct. Is that clear, guys? No one can actually touch your marks here. It's all yours. Okay, fine. Are we done? Guys, that's about it. Now write down. What is it? Part 2. Write down part 2. What is part 2? Revised scenario. Okay. Revised scenario. Revised scenario. Once again, guys, 2-step model. What do you do? Step number 1. Calculation of KE within bracket CAPM. Everything is same, the figures alone have changed. Am I right? This is the beta value. So KE is equal to, directly do it, guys. RF is how much? 9% plus what is beta now? 1.75 times RM, 13% minus RF, 9%. Am I right? How much is this coming out to? 16, right? 16%. Next, write down step number 2. Calculation of P0 within bracket Gordon's model. Guys, it's easy, no? Yes. Write down formula. P0 is equal to, yes, D1 by KE minus G, where D1 is 2. Guys, correct, no? It's 2, right? Yes, so write down 2 divided by 0.16 minus 0.07. Huh? It's not 0.7 much, 0.07. How much is that? Rupees 22.22. Is this clear, guys? Is everybody able to understand? Is everybody able to understand? Is there any issue here? So earlier it was how much? 25. Now it's how much? 22.22. Is this clear, guys? Everybody getting it? Alright. Obviously, now KE has increased. Here earlier KE was 15, now it is 16. Obviously, when the denominator increases, your value decreases. Is that clear? Everyone getting it? Perfect. Right. Another way of looking at it, I'll tell you. Can this amount be changed? Dividend? No. And earlier the investor was expecting only 15%, which means you are ready to invest at 25. Right? Adjusting for the growth rate, this would give him 15% return. But now his expectation is 16%. But he can't change what? He can't change the dividend amount. Hence, what he is saying, make this equivalent to 16 rupees. How? The amount I will invest will be less. So return on investment is what? Return divided by investment. If you want to increase the return, if you want to increase your return, this is return in value, right? If you want to increase the return, there are two ways: either increase the numerator or decrease the denominator. So now here his expectation of return is increasing. Now he's saying, so the amount that I will be ready to invest is only 22.22. Is that clear, guys? If you didn't understand, it's okay, by just another way of looking at it. Is that clear, guys? Getting it? Fine. That's about it. Can we just go and update a library of adjustments? Write down. This is similar to TYK question number 8. Similar to TYK question number 8, semicolon. Similar to TYK question number 8, semicolon. Calculation of KE and P0 under revised scenario. Calculation of KE and P0 under revised scenario. Are we getting this? Is there any issue here? Guys, tell me, is there any issue? No. Please go to TYK question number 13. TYK question number 13. Now, can we quickly do this? Guys, come on, guys. Show some energy. Yes? Right. Now, Mrs. X Limited has paid a dividend of rupees 2.5 per share on a face value of rupees 10. And in the financial year ending 31st of March, it's given. Now, guys, what is this 2.5? Dividend paid. So, we'll take it as what? D1 or D0? D0. Right. Next one. The current market price of the share is what? 60. Okay. Now, the growth rate of earnings and dividend, G, is given. Beta of the share is given. Average market return, what is it? RM is given. RF is also given. Calculate the intrinsic value. Wait 1 second. Sir, they have given the 60, no? What is the 60? It is not intrinsic value, it is the actual price. So once you calculate the intrinsic value, compare it with the actual price and say whether it's undervalued or overvalued. Is that clear, guys? Is that clear, everyone? Right? That's about it. Can we quickly do this sum? Quickly, let's do this. Some different variety. All these are study material questions we are doing. Initially, all these are vanilla questions. We will do it quickly. Okay? Right now, this is question number TYK 30 now. TYK question number 30. Now, guys, the first thing we need to do is what? Right on two-step approach. Step number 1, calculation of KE within bracket CAPM. Now, KE is equal to RF plus beta times RM minus RF. Now, what is it? Hello, what's my RF? 9% plus what's my beta? 0.75 into RM minus RF. What's RM? 15%. RF? 9%. Now, guys, what is the beta of this stock? 0.75. So this is a cyclical stock or a defensive stock? Very good. Defensive stock, which means it's a less risky stock. Something like ITC. I gave an example. Remember? Cyclical stocks, slightly more risky. Example I gave, Thomas Cook. Excellent. Very good. We saw all these things in portfolio management. Okay, guys, come on. Tell me, what is the figure? 13.5%. Is this clear? Fine. Then go on to step number 2. Direct. Step number 2, what is it? Calculation of P0 within bracket Gordon's model. Guys, all the structuring, stepwise method, I am doing it. It is not as per ICA, but definitely follow this in exam. It enhances your level of presentation. Guys, can I do a different presentation in exam? Yes, we can. We are not talking about financial reporting. In financial reporting, can't change the format, sequence. Here in our subject, we can do. We are not dealing with the presentation. We are not presenting the results to the end users. All this is for internal decision making. Is that clear, guys? That's why we are not governed by any law. It's all decision making area. Come on, guys. It's going to be what? So P0 is equal to, okay, can I say instead of D1, can I put it as D0 into 1 plus D? Hello? Divided by KE minus G. Now what is my D0, guys? 2.5 into what is 1 G? So 1 plus 0.10 upon what's my KE? Just now we calculated 0.135 minus what's my growth rate? 0.10. Final answer. rupees 78.57. Is this clear, guys? Is this clear? Everybody, write an exam, please write an assumption. Note also. Always, whenever Gordon comes, write a note. Right? In this case, what note will you write? So, you will say it has been assumed that 2.5 rupees of dividend is considered as D0. Is that clear? Once I gave a note, follow that for all the follow that for all the questions. You just clearly mention it is taken as a past dividend. That's about it. Is that clear, guys? Right? Now, once again, they have not asked for it. Now, what is the correct price? 78.57. But actual price is 60 rupees only. Is the stock undervalued, overvalued? Overvalued, undervalued? It is undervalued. The correct price I'm ready to pay is how much? 78.57. But actually, it is quoting only at 60 rupees. It is an undervalued stock. Is that clear, guys? Is everyone able to understand? Right? That's about it. Need not be written, but I'm just telling this for your understanding. Go and update your library of adjustment. If you want, just write it once. No, please write it here itself. Continue writing. Since the current market price, of share, since the current, not here, not in library of adjustment, please. Okay. Since the current market price of the share is less than the intrinsic value of the share, comma, the share is said to be red ink and write undervalued. The share is said to be red ink and write undervalued. Is that clear, everyone? Is that clear, everyone? What will you do? Your action. Yes, if you want, you can pull an arrow and write action is equal to buy. Your action means what? What is the action you take there? You have three actions in market: buy, hold, and sell. Is that clear? So undervalued stocks you buy, overvalued stocks you sell, and if it's fairly valued, you just hold it. Don't take any action, just hold. If you have the stock, you hold it. Sir, if I don't have the stock, you hold your money. That's all. Don't buy or don't sell. That's about it. Is that clear, guys? Done? That's about this question number 13. Go and update your library of adjustments. Write down. Once again, write down. This is also similar to what? Original 8. Write down. Similar to TYK question number 8. Semicolon. One extra thing that we did here. Undervalued / overvalued. Basically, that means comparing your actual price with your intrinsic value. That's about it. Is this clear, everyone? Guys, are we done here? Now, please take TYK question number 15. Please take TYK question number 15. Shall we do it? Yes. Now, look at this. What have they mentioned? The risk-free rate of return of RF is how much, guys? 9%. So 9% is RF. The expected rate of return of the market portfolio is 13%. What is 13%? RF. The expected rate of growth for dividend of Platinum Limited is 7%. What is 7%? G. The last dividend paid on the equity stock of firm A was how much? 2. What is this? D0. The beta of this equity share is how much? 1.2 beta. Now, number 1, what is the equilibrium price? What is equilibrium price? Intrinsic value P0. So first use CAPM. Once you use CAPM, you calculate KE. With the KE calculated, plug it in your Gordon and arrive at P0. Am I right? Simple sum. Yes. Second part. How would your equilibrium price change when? Number 1, inflation premium increases by 3%. Expected growth rate increases by 3%. Beta of Platinum Limited rises to 1.3. Now, guys, they are asking you what will be your P0, revised P0, in case of each of these three changes. Is that clear? Now, can it be done? Yes. Now, what is inflation premium? No. Yes, you are right. Inflation premium stands for your RF. Guys, RF means what? Risk-free rate of return. Generally, guys, your risk-free rate of return generally should at least match with your inflation. Inflation means what? The rate at which your expenses increase. Hello? So basically, at least your RF covers that. Over and above this, whatever you want, that's called market risk premium. Guys, getting it? Suppose they are saying inflation premium increases, you should know that RF increases by 2%. That's an indirect way of telling that RF is increasing. Is that clear? Guys, so basically, first scenario, RF increase. Second scenario, G is increasing. Third scenario, beta is increasing. Now, 1 second. Sir, we have a doubt. Ideally, should be having, you didn't have. Let me create the doubt for you. Are these three changes happening simultaneously? Or, sir, these are three different scenarios. We should calculate three different P0s. How do you know? It's not given in the question. So you'll have to take a stand here. ICA has done it under both the methods. Is that clear? Alternatively, they have mentioned nothing great. But guys, you can take any one and you can do it. So we will take it as three different scenarios. Calculate three different prices. Quickly, let's wrap it up. Shall we, guys? And this inflation premium is nothing but RF. That's all. Clear with this, guys? Remember, logic also I told you. Your RF should actually be able to fund you for what? For your inflation. At least it takes care of your expenses. Is that clear? So it's TYK question number 15, huh? Yes, put it up. TYK question number 15. TYK question number 15. Now guys, part 1. What is part 1? Part 1, write down. Calculation of, same wordings, equilibrium price of equity share of this company, whatever it is, platinum. Okay, are we done here? Shall we get started, guys? Yes. Write down under the step 1. What is it? As usual, calculation of KE within bracket. Guys, CAPM. Now write down KE is equal to, directly plug and play. What is RF? 9, yes, it's going to be 9% plus what is beta? 1.2 times RM, 13% minus RF, 9%. So 9 minus 13 is 4 into 1.2 plus 9. How much is this? Guys, quick. 13.8%. Is that clear? Is that clear, guys? So now write down step 2. What is step 2? Calculation of SP0 within bracket Gordon's model. Now what do we do here? Write down P0 is equal to, now directly let's plug and play, guys. We have written the formulas again and again, but in exam please write it fully. Now what is D1 here? Guys, what's given? 2 was only D0. So can I say 2 into, what is 1 plus growth? I mean, growth is how much? 7, So can I say 1 plus 0.07 upon KE 0.138 minus D is 0.07. Am I right? Can anyone help me out with the calculation? Tell me how much is it? So it's 2.14 divided by 0.068. How much is this coming out to? 31.47. That's my equilibrium price. Is everybody getting it? Is everybody getting it? Yes. Yes, that's about it. 31.47. Now guys, now they have given us a question. What are they given? So now scenario 2, there are going to be changes, right? Hello. So write down part 2. We are going to assume it as independent cases. Is that clear? Write down part 2. Calculation of equilibrium price in 3 independent cases. In 3 independent cases. Are we clear with this? Write down. Case 1. What is case 1? Inflation premium increases by 2%. Write down RF increases by 2%. Correct? Guys, in this case, of course, what do we need to do? Once again, rework on your KE. Quickly we will do. Write down here itself. KE is equal to, what is RF? Now Earlier it was 9. Now it becomes how much, guys? 11%. Am I right? Yes. So now write down here. It's going to be how much? Take a rating and put it as 11% plus what is beta? 1.2. 1.2 times RM minus RF. What is RM? Hello? 13. Minus what is RF? 11%. How much is it coming out to? How much is it, guys? 13.4 percentage. Am I right? Yes. Write down 13.4%. Are we done? Yes. So now, what will you do here? So now write down P0 is equal to, yes. So D1 by KE minus D. Am I right, guys? So D1 is how much? 2 into 1.07. Huh? Guys, correct now, that will not change. Divided by KE alone now changes 0.134 minus D is going to be 0.07. Am I right, guys? Guys, everybody able to understand this? Here everything remains the same, only the KE value changes. Is that clear? How much is it? How much? 33.44. Am I right? So write down here, it's going to be 33.44 rupees. Are we done? Are we done? Yes, guys. Now shall we move on to the next one? Yes. Now, one second. Now what ICA has done here is, I told you, RF increases by 2%. Now I said it is 9 plus 2. What ICA has done is, they said 9 plus 2% on 9. Look at the lacunas here. If you do it like that, the answer will obviously change. This is exactly what ICA has done here. Right? Look at this. How many alternative? Alternative kulla one more alternative. Okay. So here, new equilibrium price. Okay. 9.18. How did they get this? It's 9 into 1.02. 9 plus 2%. So 9 plus 2% on 9. If you do, you get 9.18. Guys, are we getting it? And here, what have they mentioned? Alternatively, you can also take it as what? 11%. Is that clear? But guys, they have changed that beta value and all, because they're saying all the three are happening together. Guys, and once again they have mentioned alternatively, you can do separately also. Guys, let's not confuse. You can do it like this. What they have done is, the three changes mentioned in the question, they have taken all the three changes together and calculated new P0. While doing this, RF, they are saying can either be 11% or what? Or 9.18. Basically, guys, what we are doing is acceptable. I just wanted to tell this to you. That's all. Because I know some students might have this doubt later on. Sir, it is done like this. Is it acceptable? Yes, it is acceptable. If you have an issue, please write a note clearly mentioning this. Because it's a lacuna. They have not properly explained it. They should have mentioned it, right? Is that clear? So you write a note clearly saying, look, it has been assumed that it increases by 2%. The assumption is what? 9% plus 2%. Alternatively, RF can also be calculated as what? 9% plus 2% on 9%. RF value alone you compute and tell, and accordingly the sum can be solved and leave it there. Is that clear? Is that clear? You can also do this. That is also acceptable because they have not given. Is it a flat 2% addition or it is 2% on the existing? They have not given it. Is that clear, guys? Now coming back here, shall we do it? That's all. The first part is over. Huh? You can just write a note saying that an alternative solution is possible, whatever it is. A new RF alone you can calculate and say, had we calculated RF as 9% plus 2% on 9%, what will be the new RF? Based on that, it can be solved. Leave it there. If you want in your notebook, you do it fully. Okay, write on. The next one is case 2. What is case 2, guys? They are saying growth rate. Okay, so write down G increases by 3%. Guys, correct? Yes, 3%. Now come down and write revised G is equal to, what is existing G? 7% plus 3%. Here also once again that issue can come. 7 plus 3% on 7. Don't worry. Put it as 3. That's all. I didn't want to confuse. That's why I'm doing it clearly and I'm telling you an alternative solution is possible. Is that clear? Yes. How much is it? 10%. Now, based on this, you tell me, will your KE change? No. You know, this William Sharp is dead against using your growth rate for calculating KE. Is that clear? Hence, directly we can get into P0 formula. What is it? P0 is equal to D1. Wait, D1 is how much? 2 into 1 plus the new growth rate. Take a reading and put it here. 0.10. Is that clear? Guys, remember when your growth rate changes, and in the question they have given what? All this dividend and all. So your dividend value also changes. Is that clear, guys? Is that clear? Yes. Divided by what? Divided by what? KE. KE was how much? Original KE. 0.138. Yes. Minus what? 0.10. Am I right? 0.10. How much does it come out to? Final answer? 57.89. Is that clear? Guys, ICA has also done it exactly like this. Please make the correction in your book. They have made a mistake. This is as per ICA, they have made a mistake. They used the old value, but answer alone they got it correctly. Okay, so it's a typo error by ICA. So I've just kept the question, solution as per ICA only. Change this. It is 1.10 in the numerator and denominator. Is that clear? Is that clear? Is that clear? All right. Next. What is the next one? Case 3 here. Write down case 3. What is case 3? Beta increases to what? 1.3. Is that clear? Beta increases to 1.3. So when beta increases, what happens? KE also changes. KE changes. Yes. So write down revised KE. Revised KE is equal to, what is my revised KE? RF is what? 9% plus, now the beta alone changes. How much is it? 1.3 times 13% minus 9%. Earlier, how much was my beta? 1.2. Okay. Right. So now tell me, guys, how much is the KE value? 14.2%. So now tell me P0 is equal to D1. So it's 2 into 1.07. Growth rate is not changing. Divided by 0.142 minus 0.07. How much is this? 29.72. Is that clear? So guys, here we are taking an assumption that what each of the changes are happening independently. There is only one change at a time. Is that clear? If all the things are happening parallelly, first of all, I don't know how you can take that. Yeah, you can take. Yes. If all the changes are happening parallelly, then what happens? RF also increases by 11%. Increases to 11%. Beta also increases to 1.3, which means these two you will factor into account while calculating CAPM. And then growth also increases, which means every single component will change. Is that clear, guys? That way also you can do. Is that clear? Is that clear, guys? Can we do that also? Write on alternative solution. Please write down alternative solution. Within bracket, write down all the changes happening simultaneously. All the changes happening simultaneously. In this case, you tell me first KE is equal to, now RF plus beta times RM minus RF. Am I right, guys? Now what's my RF? New RF? 11%. Watch out. Plus new beta also is also there. 1.3 times. What is RM? RM is how much? 13, no? Okay. 13 minus RF? 11%. So how much is this? How much, guys? 13.6%. Am I right? Okay. So this is what? 13, is it? Okay. I think they have done a mistake here also. They have taken 15. I don't know how they got 15. Actually 13. They have taken 15 here. Okay. Anyways, guys. Okay. Now the correct answer is only this. Now based on this, calculate P0. What is P0? Now D1 or D0 into 1 plus D divided by KE minus D. Now everything changes. What is D0? 2 into what is 1 plus D? Now new growth rate you have. So 1 plus 0.10 divided by what is my new KE? 0.136 minus what's my new growth rate? 0.10. Is that clear? Is that clear? This is another interpretation of the question. I don't know whether we are studying law or FM. Okay, so here look, the question is so vague, it had to be interpreted. Okay, in exam you can do anyone. Come on, final answer, guys. Rupees 61.11 now. Okay, 61.11. Are we done here? Are we done here? And that's about this question. Any one you can do in exam. Alright, just go and update your library of adjustment. We'll put this as an exceptional question. Yes, we'll put this as an exceptional question. Nothing great for the wordings alone. And this inflation premium, some of you found it difficult, so I'll put it as exceptional. Why do you have to explain every scenario, ma? You can just write a note saying we are assuming all these are independent. What do you explain in every scenario? You have only done everything. You have done everything for every scenario. What do you want to explain further? Nothing. This alone, if you do, it's enough. That's all. Okay, please write down. Take down a library of adjustments. Write down. Write down. Calculation of KE within bracket CAPM and KO within bracket Gordon. Calculation of KE within bracket CAPM and KO within, not KO, sorry. P0 within bracket Gordon. Semicolon. Calculation of revised P0. Calculation of revised P0 upon change in RF, G, beta. RF, G, beta within bracket independently and simultaneously. Independently and simultaneously. Independently and simultaneously. Is that clear? Are we done? Guys, done? Good to go? Yes, that's about this particular question. Guys, mark it as exceptional question. Give an exceptional tag because the question has been not worded properly. So I think we've done about 4 sums till now. Yes, we've done about 4 sums. So in this session, we started off with this beautiful chapter, right? Valuation of securities. Under that, we took off with what? Equity valuation. And in this, we have seen up to Gordon's model, and we've also solved some 4 sums with your intermediate CA Inter background, and everything has been done here. Is this clear, guys? Right? So with this, I'm concluding this session. Please revise and practice all the sums we've covered till now, and I will see you all in the next one. Thank you all so much. Bye-bye. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now, let's continue our discussion in this chapter, equity valuation, right? So now guys, before we get started with today's session, so I would just like to share one small video, nothing related to academics, but this is something which I feel is a must watch for everyone, right? Shall we guys? Yes? Okay. Okay, so I'm just playing this video. First, I'm turning myself off. 1 second. Yep.
Right, everyone looking forward, please. Good morning, Year 11s. Today's assembly is about the start of the journey, the start of the rest of your lives. In 2 years' time, all of you will have been finishing your A-levels. In 3 years' time, you'll be studying across the world, studying at the university of your choice. In 5 years' time, you'll have started your careers. Many of you will be in this room working for the top institutions across the globe. You will then get married. You then may buy a house. In 10 years' time, your life will be set for you. In 15 years, you'll be 30. And from then on, your path in your life will be set.
I'm sorry, Mr. Headmaster. Let me tell you why that approach may fail you. I know people who graduated at 21 and didn't get a job till they were 27. I know people who graduated late at 25 and they found work immediately. I know people who never went to university but found what they love at 18. I know people who found a job straight out of college, making decent money, but hate what they do. I know people who took gap years and found their purpose. I know people who were so sure about what they were going to do at 16 and changed their mind at 26. I know people who have children but are single. And I know people who are married but have had to wait 8 to 10 years to have children. I know people in relationships who love someone else. I know people who love each other but aren't together. So my point is, everything in life happens according to our time, our clock. You may look at some of your friends and think that they're ahead of you, or maybe some of them you feel are behind. But everything happens at their own pace. They have their own time and clock, and so do you. Be patient. At age 25, Mark Cuban was a bartender in Dallas. It took till 32 for J.K. Rowling to be published for Harry Potter after being rejected by 12 publishers. Ortega launched Zara when he was 39. Jack Ma started Alibaba when he was 35. Morgan Freeman got his big break at 52. Steve Carell only got his break after 40 years old. Virgin was started by Richard Branson at 34. Getting your degree after 25 is still an achievement. Not being married at 30 but still happy is beautiful. Starting a family after 35 is still possible. And buying a house after 40 is still great. Don't let anyone rush you with their timelines. Because as Einstein said, not everything that counts can be counted, and not everything that's counted truly counts. And this is the most important thing. I want you to be able to create meaningful, purposeful, fulfilling lives for yourselves, and learn how to use that to make an impact and a difference in the lives of others. That will be true success.
Okay, so how was that? Hello? Yes. So guys, this is actually the real truth. This was one video which made a real impact to me when I was preparing for my finals. So somehow I got hold of this video, and it did make a lot of impact. Of course, I was already in a very, very bad state of mind when I was doing my finals. So anyways, more details about my, about what I went through, or more details about my story, I will share it at the last day. But, just a hindsight about it, just a overview about it. Guys, this is something that I think, how many of you could relate to whatever was said in this video? Almost every one of us. And that's the truth, and that's the absolute truth of life. Now guys, when you feel that you are ahead of someone, don't have that head weight. And at the same time, when you feel others are ahead of you, don't take it too much to your heart. Time, I'm telling you, can switch just like this. Your life can change in a moment. It can change in a moment, for the good or for the bad. And it depends on your perspective towards life. And that is all that matters. Right? I cleared my CA foundation. Back then it was CPT, and my intermediate in my first attempt. And I was a consistent top performer. And in intermediate level, I told you guys, I scored 94 in costing and all. And that IT paper was that. Because of that paper, actually I couldn't get a rank. I lost a rank in the margin of about 10 marks. Now you guys will not believe, after I finished my intermediate, that is on the last day of exam, CA intermediate, last day of exam, I directly went to, there's a bookshop called Sita Raman and Co. You guys are aware? Yes, it's a very popular bookshop for CA or all law related courses students, right? There I went, on the last day of my CA Inter exam, I was super confident I will finish my Inter. I bought my SFM book for final. I told myself I was waiting for this. So I bought Patabi Ram sir's SFM book. And I was just somehow fascinated. Patabi Ram sir, for those who do not know, he actually writes really well. He has also written some novels and all. So anyways, I got his book and all. I was so passionate about it. And 3 years, because that's the time gap it takes between your Inter and final, even right now. 3 years I was consistently preparing for all my papers because I wanted to get that rank which I missed at the intermediate level. But for some reason, I couldn't actually even have the guts to face the exam. I kept skipping attempts, thinking that next attempt if I write, I will have more time to prepare. Nonsense. That's absolute nonsense. That's the way of fooling yourself. I did that, I'm telling you. It's never the way to do that. The best way to overcome fear is to go bloody face it. So pushing an attempt, saying that I'll do it next time, never works out. Never ever works out. Because as you come closer to the exam date, once again that fear will creep in and you will say that I will push it to the next attempt. Guys, it never works that way, right? More details, I'll again get into it later on. In the last session, I generally keep a session called the finale, and that's where I share my entire story. But guys, one thing I went through, for me, it took about 3.5, 4 years to realize this. 3.5, 4 years of just my final time alone, CA final time, it took me to realize this. But actually, guys, I wanted to become an investment banker. That had always been my dream. I wanted to get into the corporate line, investment banking. That was always my dream. I decided to do CA when I was in my second standard, 7 years old. That was when I wanted to do CA because that was when my cousin had finished CA. And we had a huge age gap. But I didn't know what CA stood for. That guy finished CA. He was just another guy in our family. On the day when he finished CA, the entire family was celebrating. And as kids, we actually, are very observant, right? And everyone is talking about him. I asked my dad, why is everyone talking about this guy? And my dad said he finished a very difficult course called CA. And that's all. That was my first fascination towards the course. I said I wanted to do CA. Every year when we move to the next class, the class teacher will ask, what do you want to become? Some students will say doctor, some students will say teacher. I said I want to do CA. The teacher used to ask me, oh, you're such a grown-up boy. Is it, you know what CA means? I said, I don't know. That's all. But I want to do CA. So guys, that was how, and I'm still telling you, that kind of respect is still there for the course. No matter what you say, there are a lot of improvements that can still be done, but the respect is still intact. When you go around and say you are a CA, your society respects you because they know what it takes. And guys, I started this course so passionately. I was so obsessed for a rank and I didn't get that. I wanted to get into an investment banking career. I wanted to get into that because this was more like I was interested in finance and I was doing it passionately. It's not for the money or anything. I wanted to get in there because that was where my heart was. And I could literally see my dreams shatter away. That was my phase during my final time. I went into depression. I popped pills for that. I was diagnosed with clinical depression and all these taglines which people give. And guys, I'm not bothered about the moral judgment which people do also. But I'm sharing this. I generally share this only with my students. Even many of my relatives they don't know all these things. But guys, the reason why I'm saying this is because at that point of time, I started actually, the unofficial teaching started long back when I was in my final. I used to teach my friends and they used to clear before me. Now I'm telling you, every one of us is a human being. And though you're kind of happy that your friends have progressed, deep inside it hurts you when you see that you are falling behind. Am I right? Am I right? I don't want to say that I'm a saint. I'm very happy about others' success. Yes, okay, but I'm more focused about my failure. And that's human brain. That's how your human brain functions, right? And this is exactly what happened, not for 1 or 2 years. It happened for 3, 4 years. And I could literally see that my whatever I had planned for, got shattered away. Just like how this principal said, no, 2 years from now you'll be doing this, 3 years from now you'll be doing that. I had a plan in my mind, only to see that it all got shattered away. And that was the time where, I am telling you, this course, more than the core subjects, it taught me what is life. And I am telling you this because I have experienced it firsthand. It's much, much, much beyond all the materialistic things. This is what I personally told. I mean, I could experience it by myself. Before that phase, had someone told me whatever I'm telling you right now, I would have said this guy is a boomer. What he's advising and all these things. But guys, when I got the tight slap of reality, that was when things completely changed. My perspective towards life completely changed. And that was when I decided, let me follow my passion. And I made up my mind, I'm going to get into teaching. For a simple reason. I don't want my students to go through whatever I went through. Because number one, I could literally see the power of conceptual learning. I told you guys before, 10 months without touching the books. I went and I just wrote the exam. I scored whatever marks I told you and all in AFM paper. But guys, it is not about just 10 months. 4-5 years before that was when my preparation started, and I learned the subject conceptually. And back then, I mean, the resources that you guys are having right now is not what we had. I mean, even a few years pre-COVID, you take, no, it was not that much. Right? Why? I mean, by the way, guys, I'm not that old and all. One student, I was having an interesting conversation. He told me, sir, you must be what, 35, sir? I just hit 30, a few months back. So I'm just putting it on record. Don't think I'm a boomer uncle. So I'm just like an elder brother, maybe who's qualified a few years before you guys have done. That's all. So coming back here, guys. So that I couldn't get the concepts being explained in in a very easy to understand manner, and all these complicated formulas. It took a lot of time for me to figure things out. Yes, of course, some guidance was also there from my faculty and all these things, but somewhere I felt, I had to take some extra efforts. And guys, and that was one of the driving factors. And number two, I told you the phase that I went through. At that point of time, I felt I was the only one going through that. I was so lonely. Only to realize that almost 90% of the students community is actually going through this. This is not a lonely phase. I want you all to know that. It's absolutely fine. If you are not able to maybe achieve whatever you thought you were going to do it at that point of time, it's fine. Now be very clear, I am not asking you to be lethargic. No. Now this guy said, everything works in your time zone. My time will come, sir. Apna time aayega. My time will come, sir. And let me wait. It doesn't work that way. That's not what this message says. You keep working without expecting your results. You will get there. And it is the thought about the result that puts the pressure at this very moment. That is the learning that I got at that point of time. I was consistently bothered about the rank. Rank is an outcome. That is not in your control. That is never in your control. Your control is only for your actions. That's what the Bhagavad Gita says. It was this at this phase where, I read the Bhagavad Gita. I mean, it gave a lot of different perspective in my life. But I'm telling you guys, just focus on your process. Success will automatically follow. And the kind of humiliation which I had to go through at that point of time, I know it. Many of you must be going through something similar to that, right? People will ask you, how long are you doing CA? Oh, I thought you would have finished CA. See, your cousin has finished CA or your friend has finished CA. You still are in this. Little do they know what is the thing that you are going through right now. They don't know your progress. And I'm telling you guys, work hard in silence. Let your success make all the noise. You need not go around and tell them, look, I'm working so hard. Things are unfair. Nothing. You think people are ready to listen to you? No. When they will take a moment and listen you? Only when you get that qualification. That's the harsh reality of life. Now I'm telling you, you guys, I'm giving you guys an example. It is the same Ganesh Bharadwaj without that CA tag before me. Most of the knowledge that I have today, I already had before my qualification. Right? Of course, the practical insights, I got it much more. It evolved over time. But you tell me, had I not been a chartered accountant, would you come to my class and attend? You tell me that. Before we judge others, let's judge ourselves. Would you? First, sir, first you finish CA and then you can teach us. That will be everybody's mindset. Am I right, guys? Am I right, guys? No, I'm not saying it's unfair. I mean, it's fair enough in a certain way. Am I right, guys? And that's how everything functions here. So whether qualification is important or not, it gives you a good platform. But to get that platform, you need to get that qualification. But is that alone enough? No. No. So beyond that, you also need your own efforts. So this is something that I wanted to share with you all. And guys, one student asked me a few sessions back, I think in portfolio management when we are doing, I was telling you all about my, someone related to me, my cousin's friend, Sriram and all. I told you he is working in Goldman Sachs. He's sending his daughter to the same school where MS Dhoni sends his daughter. Crazy money. He's an actually investment banking chartered accountant. So one student asked me this doubt. Over Telegram, he just messaged me. He said, "Sir, you could have also done that, no, sir. You say, you have this knowledge in this field. Why can't you do that, sir? Big amount of money." Guys, had I not gone through that phase, I would have definitely been only in the investment banking line. But that phase, actually, I realized that beyond all these things, I give importance to 3 different kinds of freedom. One, without any doubt, financial freedom. Financial freedom is what? Not being dependent on anyone for money. You make your own money and you be self-reliant based on what you want. Right? Financial freedom. The other one is time freedom. And the last one is location freedom. Now, time freedom means you get to choose what you do with your time. So I can schedule my meetings, I can schedule my class. Once I schedule, I'll have to keep up to it. It's not like I can do whatever I want. No. You can fix your commitments at your convenience. And the location freedom. I need not be confined just to one place. I love to travel. So I can work crazily for about 8-9 months, take 2-3 months completely off. Or maybe I can, if there is some client meeting or anything at all that I want to do, I can maybe do that from a place of my choice. I can travel and do that. Now, for you to get all these 3 together, you will definitely not get it in a corporate line. And I made myself very clear. Instead of working for someone, if I work on myself, I think I get a lot of, satisfaction with the work I do. And guys, let me be honest. Initially, I was very clear because I didn't want to take any kind of pressure. Let me do things with pleasure. Let me do things with pleasure. Let me just love what I do. And automatically, whatever comes my way, I will take it. Because I started my practice from the scratch. And teaching, I didn't have a godfather, right? So, initially I started off with 3 students. In my office, we just have one room, studio room. I invite some 3-4 students. Then I just take the classes. That's how I used to do. And that's how it all started. Post-qualification, I took some time to qualify, I told you. Post-qualification, in the first about 1.5-2 years, I used to earn not more than 15,000 a month. 15,000 a month was my earnings post-qualification. That must be close to the stipend that you guys are making right now. But guys, this is where, this was a phase where, I used to read a lot about founders, people who have started up things on their own, like Jack Ma of Alibaba, your Jeff Bezos of Amazon, and most importantly, Steve Jobs of Apple. Steve Jobs started from a garage. He didn't even have money to actually buy full meals for a day. He used to say this. He used to go to this Hare Krishna temple in US, ISKCON temple. For meals, they provide free meals. He was dependent on that. He started off from a garage. And where they are today. Now, this was something that was common among all the people who have achieved a lot of things. Now, I'm not saying I've achieved. I'm telling you, if you are really passionate about what you do, I'm telling you, the universe will actually work in your favor. And don't have any kind of motives. Don't have anything at all. Just keep putting your efforts. And guys, that's how I started. Of course, my family was extremely cooperative. My dad he never used to say, come on, others are earning so much. My dad and my mom, they never used to say that. Right? And of course, my brother, my elder brother, these people were very supportive. My immediate family members were supportive. I was not bothered about the other relatives. I was just focused just on my work, and that's about it. And guys, I mean, just to tell you guys what it takes, I feel today I'm earning at least 2 or 3 times of how much I would be earning had I joined an investment banking line. And of course, it's huge risk. There was no guarantees initially. First 2 years post qualification, I'm telling you, with that kind of money. I mean, I used to be very, I mean, you feel ashamed to ask your parents for money at that age, right? 25, 26, 27. Asking parents for money is not, I mean, it's not, it's a very awkward thing to actually ask them for money and all that. So with whatever I used to make, I used to be happy with that, right? I used to take care of my expenses, but I used to have this guilt that I'm not giving back anything to my parents. Whatever little was possible, I used to do that. But now the game has completely changed. Now, why I'm telling you this? Simple. So practice plus teaching, sir, guaranteed. No, there are no guarantees in life. Follow your passion. Follow your passion. It could be cooking. So what? Do it with full passion. I'm telling you, you will create a history. It could be even a smallest thing that you are interested in. So what? Do it with passion. Show it all the love. And I'm telling you, you will create the history in your line. That's how things work. And never copy another person. If someone is doing something that is successful, more money, let me go there. You can never make money there. First, forget money. You will never be happy about what you do. Only if you are happy while you are in the process of doing it, things will automatically flow. And that's the reason why I keep telling you guys, do things with lots of passion. Do it with passion. I'm telling you, it will give you back. There is no other way, but truly love what you're doing. Is that clear, guys? Right? This is something that I want to share with you all. This is much more than books. Books won't teach you all these things. And I'm telling you, great people learn from their mistakes. Legends will learn from others' mistakes. And I want you guys to be legends. Learn from my mistake. And I'm just sharing it with you all. In the process, I called myself a great person because I learned from my mistake, no? But anyways, guys, but you guys get this? You guys get this, right? So this was the reason why I just wanted to share this with you all, especially this video and a little bit about what I went through. So do not worry, guys, if your friends are already ahead of you or behind of you. That is not your criteria at all. Who is setting the benchmark? You set your benchmark. Just keep working. You guys know the story of the great Chinese bamboo tree? You know, the great Chinese bamboo tree, it's extremely tall. It's extremely tall, about 30, 40 feet high. But you know what is the uniqueness of this? Now, when you sow the seed to actually grow this tree, in the first 3 or 4 years, not even a small leaf or a stem will come out of it. Right? Not even a small stem or a leaf will come out of it. But you know what happens? Once it crosses the 4th year, slowly one stem will come out. And within the next about 7 to 8 months, this grows on to become a 30-foot long tree. Now, what happened in the first 4 years? It was growing its roots deep within under the soil so that this will be able to withstand the 30-footer. And that's the phase you are in right now. You are growing your roots. Don't look at the immediate benefits, instant gratification. No, it doesn't work that way. It doesn't work that way. You guys are growing your roots right now. The benefit of it, you will know it post your qualification. And on your day of exam, why post qualification? You will know that, but don't think about that right now. Is that clear, guys? That's why, once again, the same rule comes here. If you give me 6 hours to chop down a tree, I'll spend the first 4 sharpening the axe. Predominant time went on in the preparation part. Execution just took about few months. Even nature says this message, guys. Is that clear? Is everybody able to understand this? And I want you all to have the right frame of mind and mindset towards whatever you do in life. Is that clear, guys? And the most important thing is, here and there you can watch some motivational videos. Don't watch motivational videos like binge watching web series, because I did this mistake. I used to watch motivational videos and I used to feel extremely motivated. It motivates me to watch the next motivation video. It doesn't work, guys. The best motivation is your self-motivation. Have a purpose and work towards it. Here and there, leaning back on a motivation video is fine. Just like how I showed you right now. You know, if you keep watching motivational video, you will feel extremely motivated, but you will not keep working. It becomes a different type of addiction that you're developing right now. Never do that. Is that clear, guys? Fine. I think I took some time, but I felt this was something that is really worth sharing to you all. Because if this is lost, nothing can be done. Keep this intact. Keep this in check. Never lose that. Is that clear, guys? All right. So, on that note, shall we begin with today's session? Guys, yes, let's get started. Let's get started. Now, guys, the previous session, we got started off with this chapter, right? Valuation of securities, and under that, right now, we are in equity valuation, right? And guys, we have seen as of now, the no growth model, right? And then the constant growth, Gordon's model, is what we have seen till now. Am I right, guys? What is the formula for Gordon's model? Hello? What is, one second, Gordon gives a formula to calculate what? Price. P0 is equal to D1 divided by KE minus G. So this is nothing but the derivation we have seen already in time value of money, sum of infinite geometric progression series. Now, before we proceed forward, there are a few things that I want to share about this Gordon's model. Now guys, what are the assumptions of Gordon's model? I've put it in a fun fact, but this is very much required. It's a part of your syllabus. G remains constant. Am I right, guys? Hello? Now I'm saying every year my dividend is going to grow at the rate of 10%. For how many years? Perpetuity. Is that clear? If I say, sir, first 2 years it is going to grow at 15%. From then onwards it is going to grow at 10%. No, you can't use this model. Which means here the fundamental assumption is the growth happens at a constant rate. There is no change in the growth rate. Is that clear? Number one. Number two, guys, what is the formula for Gordon's model? Come on, everyone, tell me once again. D1 divided by KE minus D. And he gives a formula to calculate what? P0, the intrinsic value of a share. Am I right, guys? Yes. Now, here, always remember, under Gordon's model, KE has to be greater than G. Why? If KE is less than G, the denominator becomes negative. Now, can a share price be negative? No. If a share price is becoming negative, what does it mean? It means you will buy the share and someone will pay you also. I mean, it is absurd. Basically, guys, here under Gordon's model, he says the expectation of return of the shareholder, KE stands for that, expectation of return, is always greater than the growth rate, right? If it is less, you cannot use Gordon's model. Is that clear, everyone? This is one of the most important assumptions under this model. Is everybody able to understand this? Hello? Guys, getting it? Getting it? Another thing, we use the formula to calculate G. G is equal to B into R. You guys remember where B stands for retention ratio, R stands for return on equity. I proved this also in the previous session. Now guys, here G, how is it calculated? They are saying retention ratio into your return on equity. Is that clear? So basically, how much ever amount I'm going to retain, right? On that, in future, how much ever I'm going to earn, multiply the two, you arrive at what? The growth rate. This is what they are saying. And this is also called as sustainable growth rate. I told you the word sustainable growth rate, and this formula is given in a separate theory chapter, financial policy and corporate strategy, right? I think I've mentioned it somewhere here. Look at this. Sustainable growth rate, refer financial policy, corporate strategy. We will do that. Do not worry, right? Along with valuation later on, we will do it. Is that clear, guys? Everyone? Now, why is it called sustainable growth rate? Now, for the purpose of growth, now guys, there are two ways to grow. One, use your own money and grow. Or number two, take external funding. Guys, correct? Huh? If I want to expand, I can take external funding. This external funding could be by way of issuing fresh equity shares or maybe debentures, preference and anything. Now here, for the purpose of Gordon, we are only dependent on internal retained earnings, and hence the word sustainable growth rate. For how long can I sustain this growth? without being dependent on external funding. Is everybody able to understand? Hence the word is sustainable growth rate, and only under sustainable growth rate you can say G is equal to B into R, because here we are fully bothered about the retention ratio and the return it makes. Is that clear? We are not bothered about external funding. Is everybody able to understand this? Guys, all these things could be your MCQs or anywhere they can actually twist and turn. That's the reason I'm sharing everything. Right? So additional funds required by the entity will be financed only through, please underline, retained earnings. This is one of the assumptions of Gordon's model. Is everybody able to understand? That's the reason I'm actually doing this. Is that clear, guys? Hello, please reciprocate, guys. Come on. Yes. Next. What are the limitations? Of course, this model has some limitations. For Gordon's model to function, KE must be strictly greater than G. This is because if a company's dividend grew faster than the investor's required rate of return, that is, if G is more than, if this is more than KE, then what happens? The formula would yield a negative stock price, which is impossible. Why is it impossible? Even in a worst case, Satyam scam also. What happened? Can the stock price become negative? No. Why? Why? Come on, the liability of the shareholders is limited. Guys, getting it? In case of a worst case scenario, they can't ask your personal assets and all. You guys are aware of that, right? This is not like a sole proprietorship or something like that. Your liability is limited. At the worst case scenario, it can go to zero. That's about it. Is that clear? It has never been to zero, but I'm telling you, theoretically, below this it cannot go. If the company retains all the earnings and pays zero dividend, the Gordon's model completely fails. Why? Now, what are we discounting here? D1. I mean, basically dividend is what we actually take the cash flow and do the discounting. Now, let's say a company is not paying any dividend. They are saying 100% we want to retain. Possible, right? Come on, there is no contractual obligation. Now, if you take under this model, what will be the dividend? Zero. Then the value of company is zero, is it? No. Apple doesn't pay dividend frequently, but it is one of the most valuable companies. Now, in that case, this model doesn't work out. Are you all able to understand? This is purely a dividend discount model. Are you getting it? Some people even apply this concept of Gordon's not on not on D. They apply it on E, earnings itself, because that amount itself belongs to the shareholders. Is that clear? Right? Some people also do that. But dividend discount, when you are actually using Gordon's model, if the company is not paying any dividend, you can't say the share price will be zero. Intrinsic value is zero. No. Is that clear? So in this case, we are only considering dividend. Right? So that is not necessarily the only parameter for a stock price. Exactly, these are the limitations. And any model, I'm telling you, will have its own share of limitations. So please know this. Is everybody able to get this? Is everybody able to get this? Please answer back, guys. You guys are able to understand this? All right. Now, before we move on to the next question, there is a couple of CA Inter concepts which I would like to touch upon, and then we will go on to the next question. Shall we, guys? Yes, and trust me. This session is going to be very interesting because we are going to see something called as a variable growth rate model. All this H model and all, which you guys might have heard of. May 26 attempt H model, talk of the nation. So much hype only was there, but let me tell you what that is. We'll be seeing it gradually in a very graded manner. Now first, guys, let us first brush upon a few CA Inter concepts which you guys should already know. I want an active participation. Will you guys? Yes. Now, guys, you guys know there's something called as PE ratio. Hello? You guys know something called as PE ratio? Now, what is the formula for this? As the name suggests, price by earnings. Or can I say this is nothing but price stands for MPS, market price, divided by earnings, EPS. Guys, getting it? Right? MPS upon EPS is called as what? PE ratio. Is this clear for everyone? Is this clear for everyone? Any issues, any problem here? No. Now, sir, what does it stand for, sir? Let us say the market price of a share is, let us say 20. Okay. Let us say the earnings per share of this particular stock was, let us say, 2 rupees. Now, what is my PE ratio? Hello? You call it as 10 times. Now, what is the meaning of this, sir? It means the market is willing to pay 10 times of the earnings as the market price. Is that clear? So an investor is willing to pay 10 times the earnings to buy the share today in the market. Is this clear, guys? Are you all able to understand this? Is there any issue here, guys? No? Is that clear, guys? Which means if the multiple is more, it means people are attaching more value to this company. Am I right, guys? They are willing to pay more times the earning to buy the stock. Buy the stock. Is that clear? Sir, is a high PE good or a low PE good? There is nothing as such. That's why whenever you have a PE of this company, let's say I'm talking about let's say ICICI Bank. Okay, if ICICI Bank's PE is, let us say, 10 times. Now for you to take a decision out of it, what will you do? Go look at the banking industry. On an average in banking industry, what is the PE multiple? Let us say the PE multiple is only 8 times, which means I will say, looking at the PE, this stock is overvalued because people are ready for this stock. It is currently quoting at what, 10 times the earnings, whereas generally for other stocks it's only 8 times the earning. Example I'm saying. So how will you judge whether this PE is a good PE or not? By comparing it with the industry average. This is what we do in real life. Is that clear, guys? So based on this, we arrive at a decision if it's an overvalued stock or undervalued stock. That is a practical side of it. Coming back here, you guys know what is a PE right now? What is it? So MPS upon EPS. It's a multiple. Is that clear, guys? Everybody able to understand this? Right. Now, you guys know return on equity. I think I already did this earlier. So what is the formula for return on equity? ROE. What is the formula for return on equity? The earnings available to equity shareholders, EFE, divided by equity shareholders funds. Guys, yes or no? Right? Simple. I am an equity shareholder. What amount belongs to me divided by what is my own funds. Is that clear, guys? Return on investment on the equity shareholders. It's called return on equity. Is that clear, guys? Is everybody able to understand? Any issues here? No. Now, there's something called BVPS. What do you mean by BVPS? Book value per share. You guys are aware of this? Book value per share? You guys are aware of this? Yes. Now, what do you mean by book value per share? It is nothing but equity shareholders funds divided by number of equity shares. Guys, you are aware of this? Hello, come on, answer back, guys. These are CA Inter topics. Basic things. This is a balance sheet of a company. You tell me, out of this balance sheet, what amount belongs to the equity shareholder? Equity share capital, reserves and surplus. Am I right, guys? Hello, guys, come on, tell me no. Yes. Now, this is the amount that belongs to the equity shareholders divided by the total number of equity shares. If you do, you get the book value per share. This is the amount that belongs to you on a per share level. Am I right, guys? Equity shareholder funds is the amount that belongs to you in total. Divided by number of shares, you will get the value in terms of a per share level. Is everybody able to understand? Hello? You guys are able to get this? All these things are something you should have studied in your intermediate level itself. Right? Now, there is one more formula. Ideally, I cover all these things at the intermediate level, but just to set the context, we are doing it here. EPS. What is EPS? Earnings per share is equal to, can I say, BVPS into ROE? Can I say BVPS into ROE? Yes, sir. Why? Now, what is book value per share? Formula? Hello, come on. Equity shareholders funds divided by number of equity shares. Guys, correct? Huh? What is ROE formula? Earnings available to equity shareholders divided by equity shareholders funds. Am I right, guys? Now, this and this gets knocked off. Ideally, what do you get? EFE, the amount that belongs to the equity shareholders, divided by number of equity shares. That is only EPS. Am I right, guys? Hello? So, suppose in a question, if these two data are given, multiply the two and directly arrive at EPS. Is this clear for everyone? Guys, are you getting it? I'm setting the context again. All these are CA intermediate level areas. And guys, ratio analysis chapter, I'm telling you, at the final level, institute takes it for granted that you know. Asset turnover ratio, stock turnover ratio, data turnover ratio, in a big sum, suddenly one adjustment they keep. Is that clear? So, you can go to my website, costfin.in, you can download the CA Inter concept, FM concept book there separately. There's a chapter ratio analysis. All the ratios have neatly put it there. Keep it as a reference, PDF. In case you want to know something, can just go and refer that. Is that clear, guys? Have it with you. It goes without saying. At the final level, it is important. Similarly, even cost of capital. That chapter also is quite important. KE, KD, and all these things we are seeing here. Is this clear, guys? Are we done here? Any issues? No. Now, guys, with this, shall we go to the next numerical problem? Hello, come on. I told you, do it with lots of passion. Come on, guys. Shall we? Kekkala sattama. Yes, let's do it. This one I want to see. Okay, so TYK question number 11. ஏதோ விஜயோட டைலாக்ல அது. விஜய் இல்ல, சிஎம் சாரா? Okay. Which question? Sorry, TYK 11 I told, no? Yes. Please take TYK question number 11, guys. Yeah. Okay, guys, shall we do this sum? Guys, come on. And I'm telling you guys, do it with lots of passion. And if you do it that way, in the classroom itself, you'll be covering 95% of your preparation. You're already preparing for the exam. Okay, shall we do it, guys? Come on, let's do it. Question number 11. Shares of Voyage Limited are being quoted at a PE ratio of 8 times. You guys know what is the PE ratio. That's why I started with this background. Next, the company retains 5 rupee per share, which is 45% of its EPS. Wait, what are they saying? What is 5 rupees? Read carefully. Read carefully. What is 5? What is 5? Retained earning per share. Next, what are they saying? Which is 45% of EPS. What is 45%? Huh? Tell no. Then what is 5 rupees? 5 rupees is retained earnings. 45% is? In percentage, what do you call that? Retention ratio. Guys, 5 rupees is retained. This is CA Inter concept. 5 rupees is retained earnings. 45% is what? Retention ratio. B. G is equal to B into R. That B. Retention ratio. What are you guys saying? Retained earnings, it's retention ratio. Is that clear? Right. Now you tell me, with this you can find EPS. What are you thinking? EPS, I don't know how much was this. Whatever is the amount that you have earned, it can be split into two. You can only do two things with it. What? You can pay dividend, DPS, or you can have a retained earnings per share. In this question they have said retained earnings is how much? 5 rupees, and this is equal to what? 45%, which means DPS will be how much? The balance 55%. Guys, all these things the previous session I told you. 1 minus retention ratio is payout ratio. I told you all these things. Now if 5 rupees is 45%, how much is the overall EPS? You can find out. 5 divided by 0.45, you get EPS. Hello, correct? And that multiplied by 55, you get DPS. So you get everything here. Hello, getting it? Now you get EPS. You have a PE ratio. Now what will you do? You can get the market price also. How will you get it? EPS into PE ratio. Guys, getting it? Yes. So MPS upon EPS is equal to PE ratio. Am I right? You have this. Now you have this. Multiply the two. You get this. Are you all able to understand? This is CA Inter concept. That certificate is there in your house. Huh? Watch it every day. Okay, coming back, guys, come on, these are basic things. Come on, coming back. Next, you are required to compute, number 1, the cost of equity to the company if the market expects a growth rate of 15%. 1 second. Now KE, I told you, KE is what? The expected return of the investor. There are multiple ways to calculate KE. I told you. Right? So dividend price model, earning price model, Gordon's model, CAPM model, multiple models are there. Now the ideal model is CAPM, right? But what did I tell you? In any case, solve or arrive at the KE value depending on the data available. In this question they have given what? Growth rate. Clearly what do they want you to calculate? Using Gordon's model. Right? Balancing figure. Is this clear, guys? Don't say, sir, sir said Gordon is not a correct way for calculating KE. I will not calculate. Look, I told you clearly, based on the data available, calculate. Yes, it is not a very good method. But what more can we do if this is the data available? Is that clear? Next one. This is part 2. If the anticipated growth rate is 16% per annum, calculate the indicative market price with the same cost of capital. G alone changes. What will you do? Similarly, if the cost of capital of the company is 20%, by cost of capital they refer to what? KE only. Capital in this case is equity capital. Is that clear? And the anticipated growth rate is 19%. Calculate the new market price. So once again, they are just changing the figures and asking you to use Gordon's model. Whenever growth rate comes, obviously it is only Gordon's model. CAPM, if you want, they need to give RF, beta, market risk premium, or they need to give you RM and all. All this data is not there. Guys, at the intermediate level itself, we've seen all these things. Now, shall we do this sum? Let's quickly do this. TYK question number 11. TYK, question number 11. Now, write down. First, before going to any parts, first we will calculate what the current EPS, the current market price, and all these things we should compute. Am I right, guys? So, write down. You can just put it as a working note. Calculation of EPS, DPS, and MPS. Everything has to be calculated. Am I right, guys? Hello, guys? Yes, shall we do it? Yes, let's do this. Write down A. Now, what is given, guys, in the question? Retained earnings. The first thing is given as retained earnings. Am I right? So, write down retained earnings per share. Within bracket, percentage you write. How much was that? Hello? 45%. Value, how much is it? Rupees 5. Is that clear? Guys, getting it? Next, write down B. EPS. Within bracket, how do you compute EPS? Yes, come on, tell me, guys. If 5 is 45, how much is 100? Or in other words, I will say there's nothing but rupees 5 divided by 45%. Guys, are you all able to understand? Logic, no formulas here. It's all logical. Is that clear? If 5 is 45%, how much was 100? Out of EPS only you would have paid retained earnings. So 5 divided by 0.45. How much is that? Yes, put it up here. Rupees 11.11. All these are on a per share level. Next, C. Write down DPS. Guys, in exam, you have to write it fully. Dividend per share. And within bracket, you put DPS. At least once you write it fully. Remaining number of times you can just put it as DPS, EPS and all that. At least once in a question you need to do it, right? Let's not take the chance. ICA might allow, but there is no specific rule that ICA has mentioned. There is no clarity on this. Let's not take the chance. Now, guys, tell me how much is it? Now, 1 second. Can I say it is going to be rupees 11.11? This is the EPS into. So now 45% was my DPS, I mean retained earnings per share, retention ratio, which means DPS has to be 1 minus 45%. Hello? So can I say it's going to be 1 minus 0.45? Something like 1 minus B. Am I right, guys? Guys, are you getting it? Please put all these steps. Don't directly put 55%. Put this here. Tell me how much was that? It's going to be rupees 6.11. Anyone has any issue till now? Hello? Getting it? Done? Next, write down A, B, C, D. PE ratio within bracket given figure 8 times the multiple E. What is E? MPS within bracket dash into dash. What into what? Yes, B into D. That is B stands for EPS, your D stands for PE ratio. Multiply. Tell me how much is it? Come on. 88.88 rupees. Is this clear, guys? Is this clear? Any problem, any issues till now? Right? Now we've got the base data. So now it's just a matter of plug and play. Now 1 second. Now what is the formula as per Gordon to calculate KE? I'm not asking P0, KE. So ideally speaking, 1 second, this need not be written, but Gordon originally gave the formula to calculate P0. P0 is equal to D1 divided by KE minus G. Am I right, guys? So now what do you do here? But I want what? KE. So what I do, I take this here and bring this down here. Can I say this is nothing but KE minus G is equal to D1 by P0? Or KE is equal to, we can put it here, this alone you write, KE is equal to D1 by P0 plus G. Remember, Gordon didn't give this formula. He gave only this formula. This is actually a reverse working way to calculate KE. He never gave the formula to calculate KE. He only gave valuation formula. Is that clear, guys? Is everyone able to understand? Right? Is this clear, everybody? So please write this formula. KE is equal to D1 by P0 plus G. Within bracket, Gordon's model. Why are we calculating it under Gordon's model? Because the data given in the question is actually such that you can only calculate KE using Gordon's model. Is everybody able to get this, guys? Hello, please reciprocate. Yes, that's about it. So now let's do this. Part 1 now. Yes, write on part 1 of the question. Just write part 1. That's all. Part 1. Now, under part 1, what are they saying? Calculate KE when the growth rate is what? 15%. Now tell me guys, KE, yes, KE is equal to, now D1, how much is it? 6.11, right? So nothing is given. Directly, you can assume this 6.11 itself as what? Hello? D1. No sir, I want to assume it as D0. Yes, you can do that. In that case, you should apply the growth rate as well. Is that clear? ICAI has assumed this to be D1. Logic, there is no logic for this. Institute is inconsistent. I told you, whenever you find Gordon's model, always write a note. Always write a note. We have assumed this itself is D1. Is that clear? So now write down guys. Alternative answer is possible. Yes, it is possible. Write down D1 is how much? 6.11 divided by P0 is how much? Yes, 88.88. We have calculated. Yes. Yes. Plus G. How much is G? 15%. I'll write it as 0.15. Is that clear guys? Hello? So now tell me how much is this? 21.87%. Yes, 87%. Is everybody able to get this? Any issues? Any problem here? Guys, please reciprocate guys. Come on, I told you, do it with lots of passion. Just fall in love with the subject or fall in love with whatever you're doing. Trust me, it will pay you off like anything. You need not expect. It will give. It will give. That's the way things work in life. Okay, guys, getting it? Done. Let's move on to the next part. Part 2. Part 2. Part 2. Now, once again, here what have they asked for? Now, it's the ulta. They have asked us to calculate the indicative market price. Means they have asked us to calculate P0. Now, be careful here. What have they asked us to calculate? P0. Calculate the indicative market price. If the growth rate now becomes how much? 16% with the same cost of capital. By cost of capital, they mean cost of equity capital. Is that clear? Don't think about KOs or KD. No. Here capital means equity capital. That's about it. Is that clear, guys? So now, same cost of capital means what? As per part 1, you calculated KE, retain that KE, but now I'm going to give you a new growth rate. Is that clear? Based on that, you calculate what? P0, intrinsic value. Shall we do that? Write down the formula. P0 is equal to D1 divided by KE minus G. Is that clear? Hello? Guys, getting it? Now, D1 was how much? 6.11. Alright? 6.11 divided by KE. Just now we did. Yes, I told you, write it in decimals. 0.2187. 21.87% minus what is the growth rate? Now they have given a growth rate. 16%. 0.16. How much does it come out to? Rupees 104.08 per share. Is everyone able to understand? Guys, is everyone able to understand? Please answer back, guys. Is everybody able to understand this? Yes. Correct? Right? This is as per ICAI, but this is not a correct answer. Can anyone tell me why? Growth? Yes. Very good. This 6.11, guys, here we took it as, sir, we assumed that itself as D1, no? Hello? This was D1, assuming a growth rate of how much in the first part of the question? 15%. Now you need to remove 15 and insert a new growth rate, ideally 16. So, no, this is not required, but I am telling you, how much was D1 that we took? 6.11, But 6.11 was considering how much growth rate? So, in this case, ideally speaking, guys, this would have been what? D0 into 1.15, 1 plus growth rate, 1.15. Am I right, guys? So, how much would have been my D0? My D0 would have been 6.11 divided by 1.15. Am I right? Hello, guys, are you getting this? Now, the new growth rate is how much in this case? 16%. So, what should I do? On this, I should apply what? On this. Now, the new D1 ideally should be what? 6.11 divided by 1.15 into 1.16. Am I right? 1 plus growth rate, new growth rate. Am I right, guys? Ideally speaking, this is what should have been done. But ICAI accepts this as the correct answer. This is as per ICAI. That's why I'm leaving it here. But remember, in the denominator, if you're considering a new growth, obviously the numerator, it has to match. It has to be corresponding. Am I right? Sir, last year D1, that D1 was based on a different growth rate. Change it, arrive at D0 and apply my new growth rate right now. Is that clear, guys? So this is not given, but I am telling you ideally. Sir, I want to do it like this. Can I do? Please. Yes, you are allowed. Write a note. There are a lot of controversies, with respect to the way in which ICAI has solved this area. Lot of inconsistencies, but this is what ICAI has done. this could be done in case you are following your solution. Is everyone able to understand that? Any issues here? Guys, getting it? You guys understood this? Guys, yes? Right. Next one. Next one. Let's move on to part 3 of the question. What is part 3 of the question? What are they asked? Yes, guys. What is part 3? If the company's cost of capital, what is cost of capital? KE basically. They have given KE is what? 20%. Anticipated growth rate is how much? 19% is G. Calculate the market price. Once again, this is a new market price. Hello? Guys, yes, simple. Let's do this. Write down P0 is equal to D1 divided by KE minus G. Now, what is my D1? So, here we are assuming it as same 6.11. ICA has done this, but ideally it should be what? This figure into what? 1 plus the new growth rate. The new growth rate is 20%, 19%. Yes, ideally that's what it should be. Ideally it should be 6.11 divided by 1.15 into 1.19. Ideally this should be your D1. But anyways, ICA has done it like this. They have taken D1 as D1 for all the 3 cases. Is that clear? Guys, everybody able to understand? Please reciprocate, guys. I know it's an afternoon session, but please focus here. Next, KE. How much is your KE? Now they have given it as 0.20 minus what's my growth rate? 0.19. Figure rupees 611 per share. Is everyone able to get this? Is everyone able to get this? And that's about this particular question. They are just tinkering with what? Your growth rate and KE and all. Right? Please go and update your library of adjustments. Write down. Write down. Write down. Calculation of EPS, DPS and MPS. Calculation of EPS, DPS and MPS. EPS, DPS and MPS when REPS, retained earning per share, when REPS, comma, B, what is B? Retention ratio. When REPS, comma, B, comma, PE ratio are given. When REPS, comma, B, comma, PE ratio are given, semicolon, calculation of P0 and KE, calculation of P0 and KE within bracket Gordon's model, in 3 scenarios. Are we done here? Guys, are we done? Any issues, any problem here? Please tell me. Done. Okay. So now shall we proceed forward to the next sum? Guys, yes, shall we proceed forward to the next sum? Yes, so please go to TYK question number 5. TYK question number 5. Can anyone help me out with the page number? 117, huh? Okay. Okay. Shall we get started? Guys, shall we get started? Yes. Now, question number 5. Question number 5. X Limited just declared a dividend of 14 rupees per share. Okay. So, 14 rupees is what? D0. Right? Just declared. It's a past tense given here. Right? Mr. B is planning to purchase a share of X Limited, anticipating increase in growth rate from 8 to 9%. Means what? Going forward, the growth rate is going to be what? 9%. Till now, whatever was the growth rate, I'm not bothered about. Now they are saying growth rate is going to become how much? 9%. Right? So, G is equal to 9%. Next. This will continue for 3 years. Okay. He also expects the market price of this share to be 360 rupees after 3 years. Which means what? He's planning to hold it only for 3 years. Finite life. Is that clear? Practical. Right? And he will sell it. What, can he sell it back? Yes. Where will he do it? Secondary market, NSE, BSE. Is that clear, guys? Alright. Now, you are required to determine, number 1, the maximum amount Mr. B should pay for the shares if he requires a rate of return of 13% per annum. What is 13%? KE, right? The discount rate. Am I right, guys? So now, what are they asking you to calculate? The maximum amount he should pay means what? intrinsic value P0. How will you do? Respective year cash flow discounted in present value, arrive at what? Arrive at P0, the fair value, the intrinsic value. Is this clear, guys? There is no Gordon here. When will Gordon be applied? Infinite period. Here it's a finite life is given. In TVM itself we did a couple of sums like this. Mr. Dhoni wants to purchase shares of India Cements. All these things we've done already. Is that clear, guys? Finite life, a value of any security or asset is what? The present value of all the future benefits. So arrive at the present value of 3-year dividend along with the value that you are going to, the sale price at the end of 3 years. Is this clear? Any issues, any problem? No. Next. The maximum price which Mr. V will be willing to pay for the share if he is of the opinion that 9% growth can be maintained indefinitely, and he is now requiring what? 13% rate of return per annum. Now, guys, this is the actual scenario in the markets. This guy initially said, I am going to hold only for 3 years. After 3 years, I know this is going to be my selling price. Finite life, I know the cash flows arrive with the present value. Now, generally a long-term investor, he will not know for how long he's going to hold. Sir, I want to travel along with the company and let my money compound along with it. Is that clear? Now, indefinite life, guys, getting it? Time value of money we have seen. There are two models. One, constant cash flow up to perpetuity. Means what? Constant dividend amount, not growth rate. Dividend itself, I will say every year I will receive only so much. No growth. The other one is what? Growth in dividend. We have seen that. Now, in this case, what are they saying? What are they saying? Look, last year dividend was how much? 14 rupees. And they are saying indefinitely it is going to grow at the rate of how much? 9%. That's my growth rate. So, which means can I use Gordon's model here? So, D1 by KE minus D. KE is how much? 13. G is how much? 9. And D1 can be arrived. D1 is 14 into 1 plus 9%. Are you guys able to understand? So, this is a finite life case. This is an infinite life case. Are you all able to understand? Getting it, guys? Yes. Next. The price of the share. Read the question carefully. What are they asking? The price of the shares? The price of the shares at the end of 3 years. They are not asking you to arrive at P0. They are asking for P3. After 3 years, what will be the price of the share? Now, if 9% growth rate is achieved and assuming other conditions remaining the same as in 2 above, right? We will see how to calculate what? How to calculate your, how to calculate the value as at the end of year 3. So now, guys, 3 different questions. Question number 1, they have asked you to calculate what? P0 for a finite life. Question number 2, P0, infinite life, growing cash flows up to perpetuity. Question number 3, they are asking you to calculate P3, the price of the shares at the end of year 3, assuming that it is going to grow constantly. Is this clear? Good sum, right? It has all the varieties. Shall we quickly do this? Right? A perfect way to actually wrap up the discussion on Gordon's, the basic Gordon's model and move to the next level, variable growth rate and all. A perfect way to do this. From here, I will take it forward. Is that clear? That's why I chose the sum right now. Study material question only. Shall we do this, guys? Now, yes, let's get started. Let's get started. This is question number 5. Why don't TYK question number 5? Now, write down part 1. Part 1. Now, guys, what do we need to do here? What do we need to do here? We need to arrive at the present value of all the cash flows happening for the next 3 years. Am I right, guys? Hello? Yes, that's what we need to do. Now, can we do it under a tabular approach? Right? If you want, you can do it directly. Or if you want, you can also do it under a tabular approach. Not a problem at all. Can we do this? Yes? Okay. But before that, can we first frame the cash flow equation? Can you first frame the cash flow equation? So, write down. Write down. Tell me, guys. I want you to tell me. P0 is equal to. P0 is equal to. Yes. Now, first year cash flow. How much is it going to be? I don't want the final answer. I just want you to give me the calculations. Yes, tell me. 14. Now, is it just 14? No. 14 was D0. Here I want D1 into 1.09. Can I say, guys? Hello? 9 is a growth rate. Am I right? Divided by 1 plus R the whole power. 1. What is R here? 13%. Am I right? Hello? Correct? Guys, correct? No? Getting it? So, can I say it is 1.13? R is 0.13. 1 plus 0.13 is 1.13. The power 1 plus. What is the second year cash flow? 14 into 1.09 into 1.09, another 9% growth. So can I put it as 1.09 square? Guys, divided by 1.13 to the power 2. Guys, getting it? Your cash flow equation, time value of money, plus next year. So previous year 14 into 1.09, actually it's to the power 2, into once again one more 1.09. So can I say it is to the power 3? Am I right, guys? Guys, please answer back. Yes. Divided by what? 1 plus r to the whole power n. Am I right? Is everybody understanding or not? Please reciprocate, only then I will know. Getting it? Perfect. Now that's all. That's all. No. Once again at the end, I will receive what? 360. So directly put this 360. What is this? Sale value at the end of third year divided by what? This is at the end of the third year. By the way, guys, all these are cash flows arising at different time horizons. Can we add these, all these four as such? No. That's why we bring everything to present value using what? All these factors, the discount factors. Am I right? 1 by 1 plus r the whole to the power 1, 1 by 1 plus r to the whole power 2, and so on. Is that clear? So here I'll put it as 1.13 to the power once again 3 only. Ideally these two cash flows can be added as such, because both of these are happening only at the end of year 3. Guys, getting this? Please tell me. Yes, you guys are getting this, right? I'm literally starting from the scratch, guys. Please reciprocate, right? That's about it. Now with this, can we just do this? Yep. Okay, so now write down here, please write down here your cash flows. Then you have present value factors. Present value factor, how much percent, guys? Yes, 13%. And then you can have PVCF, present value cash flows. Can we do this? Yes. So year 1, what is the cash flow? Come on, take your calculator, tell me. 14 into 1.09, how much is that? 15.26. Year 2, how much is it? 16.63. Is that clear? So 1.09. Yes. Then year 3, one more 1.09 is going to be 18.13. And once again year 3, it's going to be how much? 360. Am I right? No need of calculation here. It's directly given. Is this clear, guys? This is also year 3. Or sir, I want to put 1 year 3 and add the 2. That is also fine. Is that clear? Now what is PV factor? I told you use a calculator trick. 1 by 1.13 is equal to, hello? Yes, 0.885. Yes, one more is equal to 0.783. One more is equal to 0.693. Then one more is equal to, in a point you will not do. It's only for 3 years. So repeat this again. 0.693. Is that clear? That is why I'm just making sure you guys don't commit a mistake. If your hand went on to do the next calculation, take a red ink and correct. Now guys, marry the figures and tell me. Come on, how much is it? This into this. Guys, this is at the end of year 1. Bring it in today's value. That's why we have present value factor. Figure. How much? 13.5. Yes, then 50. Then 16.16 to 0.783. Come on, quick. 13.02. Third figure. 12.56. Fourth figure. 249.48. Yes, and one click of a button, MRC, you should get total. How much? 288.56. Is this clear, guys? Yes, you guys are getting it? Hello, are you all able to understand? Guys, these cash flows, are they addable as such? No, they are arising at different time horizons. Convert everything into today's value. That's why we call it as present value cash flows and make them addable and add it. In today's value, this is as good as receiving what? 288.56, which means this is the maximum price I will be willing to pay for the share. Am I right, guys? Guys, everybody able to understand what is the actual price given? What is the actual price given? It's given in the question. Oh, it's not given, huh? Sorry, that's 360 is after 3 years, huh? Oh, sorry, it's not given in this question. Okay, fine, then leave it. Okay, so if the actual price is more than this, it is overvalued. You will sell it. If it's less than this, undervalued, buy it. Is this clear, guys? This is how we take decisions here. Now, shall we move on to the second part of the question? Guys, shall we move on to the second part of the question? Yes, write on part 2. Part 2. Here you please write on P0 is equal to, this write on P0 is equal to rupees 288.56. That's all. Next one, guys, write on part 2. Ideally, this entire sum is CA intermediate concept only, no? Yeah. Quickly, guys, let's do this. Part 2. What are they saying? Assuming it's going to grow. So 3 years finite life is not there, sir. Infinite life, equal cash flow. No, sir. Constant growth. Every year cash flow will change, but it is going to grow at a constant rate. In this case, directly we can use Gordon's model. Come on, guys, write down. P0 is equal to, write down, tell and write the formula. D1 divided by KE minus G. So now tell me, guys, what is D1? We already calculated D1 here, 15.26, sir. It is not 14. 14 into 1.09. Am I right, guys? 15.26. We already got this here. Right? So 15.26 divided by, what's my KE? Guys, come on. 0.13 minus growth rate, 0.09. Figure. Figure. Rupees 381.50. Is that clear, guys? Is everybody able to understand? Any issues, any problem here? Any issues, any problem here? No. Now go to the third part of the question. Third part of the question. Now what have they mentioned here? Calculate the price of the shares at the end of 3 years. Right? If a 9% growth rate is achieved and assuming other conditions are same as in 2 above, which means your KE continues to be how much? 13%. Now wait. Sir, why are they asking us to calculate? Now, guys, let us say this investor has bought the shares. Okay, he has bought the shares. Okay, let's say in the first part they are saying no, he is going to hold the shares only for 3 years. Right? With that intention, he did some calculation, made a decision, bought the share. But let us say he is now standing. Let's say you bought the share at the end of 3rd year. I mean, you bought the share with an intention to hold it for 3 years. Now you're standing at the end of 3rd year. Now, at this point of time, let us say you want to know. Okay, at this point of time, what is the current market price? 360. Now you want to know whether it is fairly valued or not. Guys, getting it? So you are not selling it today, you are selling it after 3 years. But at this point of time, you want to value whether the share is actually having a correct value or not. Guys, getting it? Now you need to apply Gordon's model not at T0 but at T3. Am I right, guys? Is everybody able to understand? Now for this you should calculate the value as at the end of year 3. Am I right? Getting it? Now write down here part 3. Part 3. Now, what are they asking you to calculate? What are they asking you to calculate? Price at the end of 3rd year. So now, one second. Look at this. P3 they are asking. Now, 1 second, guys. Now, sum of infinite geometric progression series, growing cash flows. Now we saw, what was that? Cash flow at the end of year 1 divided by discount rate minus growth rate. Based on that only we have calculated D1 by KE minus G. Am I right? Now, if I want the value today, basically I take what? The next year's dividend. That is D1 divided by KE minus G. So if you want to calculate P0, you take the dividend pertaining to next year, D1. If I want to calculate P3, I take what value? D4. So I am already at the end of year 3. Now tell me the next year's cash flow is what? D4. Am I right? So can I say this is nothing but D4 divided by KE minus G? Is everyone able to understand this? Is everyone able to understand? Guys, this is a very, very important concept. Your entire variable growth rate model depends on this. Is this clear, guys? Right? Now, guys, how can I calculate D4? Can I say this is nothing but D3 into 1 plus G divided by KE minus G? Getting it? Now what was D3? We already calculated 18.13 here. So can I say 18.13? Am I right? Now into 1 plus growth rate is what? 1.09 now. Guys, getting it? You get what? D4? Do the normal thing. Divided by KE minus D. How much was it? KE 0.13 minus 0.09. Yes, guys, can anyone help me out with the figures? The numerator is 19.76, denominator is 0.04. Yes, how much is this coming out to? 494, right? Roughly about 494 rupees. Is that clear? So now what is 494? What is 494? The price of the share at the end of year 3. Now, at the end of year 3, it's not asked, I'm telling you. Actual market price was how much? 360. So the stock is undervalued or overvalued? The correct value is 494. It is quoting at 360. Overvalued. Huh? It is undervalued. Now you tell me, will you go and sell it? Will you go and sell it? No. So now you would know that the worth of the share that I hold is more than the current market price. Now at that point of time you might change your decision. No sir, from now I'm planning to hold it to perpetuity. But how will you be able to do that? Unless and until you value the share at that point of time. Is that clear, guys? Is that clear? Now, one more thing. 494 is the value of the share as at the end of year 3. Right? This is not the value as at P0. This is the value as at the end of year 3. Suppose if I want to arrive at the present value of this, once again I will do what? Divided by 1 plus KE the whole power 3. Guys, getting it? I'm not doing it in this sum. But remember this is the next model that we are talking about. Is that clear? The present, this is not in present value, this is still in future value. Guys, getting it? Because we are doing this calculation at the end of year 3. Now if you want to bring it to today's value, then further apply the discount rate. Is that clear, everyone? Right? It is not asked in this question, but I am telling you food for thought for the next concept. Is everybody able to understand? Please go and update your library of adjustments. That's about this question. That's about this question. Write down. Write down. Calculation of intrinsic value. Calculation of intrinsic value hyphen intrinsic value within bracket P0 and P3. Please write down P0 and P3 hyphen when period of holding is finite, semicolon, when period of holding can write as POH, when period of holding is infinite, when POH is infinite, semicolon, calculation of P3, within bracket Gordon's model. Is that clear, everyone? Hello? Yes, are we done with this? Any issues, any problem here? Please tell me, guys. Right? Done? So that's about the basic Gordon's model. Is that clear, everyone? Now, go to your concept book. Now, guys, now we all know what are the components of Gordon's formula, right? So quickly, first P0. So P0 is what? The intrinsic value, the correct value. Now why do we calculate this intrinsic value? Intrinsic value is the actual value the share yields based on the present value of its future cash flows. Am I right, guys? Hello, guys, please answer back. Right, I'm building the subject from the scratch. I know some of you might already know all these things, but for the sake of everyone, I have to do everything. So please reciprocate back. All right. So now, when I say future cash flows, it refers to what? The capital appreciation, not dividends and everything. Right. And the actual price is the price that is currently quoted in the exchange, in the market. Am I right, guys? And why do we calculate this intrinsic value? If intrinsic value is more than the actual value, then which means actually it is undervalued. Am I right? I'll go and buy. And if my actual is more than the intrinsic, or in other words, my intrinsic value is less than the actual value, it means the stock is overvalued, you will sell. Is this clear, guys? Hello? Yes? This is something that we've already done. Yes, expected dividend, all these things we have done. Guys, one very important thing. We've seen this concept somewhere, ex-dividend, cum dividend. Always remember, when I say price, I only refer to what? Ex-dividend price. Right? Cum dividend is temporary, between the record date, that time only, date of declaration, record date, during that time only I have this dividend and all extra. So always, if they have given cum dividend price, what will you do? subtract the dividend value, you get the ex-dividend price. This is something that goes without saying. We've already seen it in our portfolio management area itself. And KE calculation, we saw there are multiple ways in which you can calculate KE. And one more thing, G is equal to B into R, and I told you it's also called as sustainable growth rate. Right? So how long can I sustain depending on just my retained earnings without depending on the external funding? Guys, everyone clear with this? Yes? Now with this, guys, basically we have finished. I'll come back to this later. I mean, it's easier, but anyways, I'll come back to this later. So with this, we have finished the basic Gordon's model. So just go back here. Now, guys, you tell me, till now we have finished. Now we are in equity valuation. Am I right? Under equity valuation, we are trying to calculate the value of equity based on dividend by discounting dividends and all. Guys, getting it? Under that, zero growth means what? G is equal to 0, which means I receive the same amount of dividend perpetually. Annual cash flow divided by discount rate. KE. Guys, dividend D divided by KE. This is what we said. This is what we saw. Next, we saw a model called constant growth. This is nothing but Gordon's formula, direct application. Right? Sir, you will not receive the same dividend, sir, up to perpetuity. The growth rate will be constant. So what remains constant is not the dividend amount, the growth rate, which means every year my dividend amount will increase by a constant rate. Am I right, guys? If that is the case, we saw what is the formula to calculate P0 is equal to D1 by KE minus T. This is Gordon's formula. Is that clear, guys? Now, let's move to the most important aspect of this entire valuation game called as variable growth rate. Extremely important. This has its presence not only in this chapter, in the next chapter, business valuations also. Right? That is the reason I'm starting from the scratch. Without this in business valuation, you cannot understand anything. Right? That's why we are starting from the scratch, even though all these are intermediate level areas. Is that clear? So even if you find a little boring, bear with me on this, because no other option. The subject is built around this. Suddenly 1-2 points, it will be high level. So only if you are completely awake first and then focused, then you will be able to grab every single point. Else saying, sir, I missed out H model and all will not work out. Right? Now, guys, let's move on to the next area called as what? Variable growth rate model. Now, under constant growth model, what was the assumption? So starting today up to perpetuity, every single year the growth rate will be constant, not dividend amount. Growth rate will be constant. Is that clear? Is that clear? Sir, 10%, sir. From today for the next 100,000 infinite years, growth rate will always be the same. This was the assumption. Guys, getting it? Now, in reality, you guys tell me, will the growth rate be constant up to perpetuity? No. It varies. Sir, for first few years, the growth rate could be different. Then, sir, after a point, it could settle. Or maybe, sir, first 2 years, one growth rate. Next 3 years, another growth rate. And then on, it could settle back to a constant growth. Guys, here we have different growth rate, varied growth rates. Hence, it's called as what? Variable growth rate model. Is this clear? Is this clear? And in variable growth rate model, one of the models is H model. Right? What is H? I will tell you later. What is H model? We will see that. Do not worry. But don't think H model is something else. It is one of the ingredients of variable growth rate model. Is that clear, guys? Nothing great about this model, but since it came in exam, where ICAI had not even given a single example or illustration, they gave one formula. And the students thought, okay, some formula is there, but that's okay. It's not asked. No, ICAI itself did not give any sum. Why should we do? In May 26, they asked. Right? That was when this model picked up a lot of popularity, not globally among the CA students. Okay, so that is the reason I also made it separately as another model, just to make sure that you guys are not missing out on it. Is that clear? We will be doing numerical problems. Don't worry about it. Okay, very simple. But before that, first understand that H model is also one of the variants of your variable growth rate model. Is that clear? Have this mindset, have the perspective on the subject. Now, sir, what is this variable growth rate model? 1 second. Let me just give you a chart here. Okay, guys, come on. Please come back here. Now, guys, this was something that I generated using AI. Now, all these graphs and other things are not there in your study material. And to be very honest, guys, if you open the study material for this chapter, it's not very organized. It's quite haphazard. It's not that organized. They have just randomly they have done some topics. Everything is there, but if you learn it that way, it will be very confusing. That's why I'm bringing the structure. Structuring is very important, right? Now, what are the different types of dividend discount model? One is the constant growth model, which is your basic Gordon's model, which you have seen till now, which means not the dividend amount. Growth rate remains constant forever. So the graph looks like this. If I take growth rate on the x-axis and years, years on the x-axis and growth rate on the y-axis, what happens, guys? Your growth rate remains constant, not cash flow. Growth rate remains constant forever. Is that clear? Zero growth, I'm not putting it here. Zero growth means there is no growth. Is that clear, guys? Is everybody able to understand? Now, this is what we have seen till now. Hello? But now you guys tell me, will my growth rate remains constant forever? No. It can keep changing. Is that clear? Now, if it keeps changing, that is called as variable growth rate model. Now, from an academic perspective, there are three different types of variable growth rate model for your syllabus. Is that clear? Now, what are the three different types? One is called as a two-stage dividend discount model. Dividend discount or variable growth rate model. We call it as two-stage dividend discount model. The other one is called as three-stage dividend discount model. And finally, you have something called as H model. Is this clear, guys? What is what? I will give you a bird's eye view, and then I will explain the logic. We will be doing numerical problems. Is this clear? This is going to be the agenda for discussion here. Guys, now we are entering into the core of valuation area. This is how valuations will be. Now, what do you mean by a two-stage dividend discount model? In a two-stage dividend discount model, initially for the first few years, you will be having a high growth rate. Let's say 20%, right? Example. High growth rate for the initial, let's say 5 years or 2 years, 3 years, whatever it is. Let's say for the first 3 years, you have what? The growth rate is happening at what rate? 20%. Now, first 3 years, suddenly from the 4th year, the growth rate will be what? 8%. Example. Which means, so till now it was how much? 20%. Suddenly drops to what? 8%. All of a sudden in a single year, that's a sudden drop. Is that clear? This is called as a two-stage dividend discount model. Two-stage means what? There are only two stages here. One is a high growth stage. The other one is what? A constant growth rate. Is that clear, guys? Are you able to understand this? Guys, are you able to understand this? Is that clear? Now. Can you apply Gordon here in this model? Now, if I have to apply Gordon, one of the fundamental assumptions in this session only I told you, growth rate remains constant up to perpetuity. Now, here I have two growth rates. I cannot apply Gordon model right now. But can I apply Gordon model here? Yes. Why? From now on, my growth rate is going to be constant. Hence, I can apply Gordon's model only at a time when my growth rate crystallizes and becomes into a constant figure. Is that clear? So basically, this is also something that relies on Gordon's model, but we don't apply Gordon model today itself. We do it later on. Is that clear? Is everybody able to understand? Any issues here? Any issues here? No. Now, sir, what do you mean by a three-stage dividend discount model? Three-stage is actually an improvisation of two-stage model. In two-stage, what do we say? First initial few years. One second. Yes. First initial few years, you have a high growth rate. Suddenly there will be a drop overnight. And then for the remaining years, it will be a constant growth rate. Am I right? Now, three-stage model says, look, in real life, practically you tell me, all of a sudden my growth rate will drop, is it? No. 20 is a high growth rate. 8 is a normal growth rate. Sudden fall will not happen suddenly. So here they are saying, look, here you have a high growth rate. Now, from 20 to become 8, the fall will not happen overnight. The fall will happen over a few years. Is that clear? Which means this is a one stage, This is the second stage, declining stage, and then the third stage becomes constant. Are you getting this? Are you getting this? And guys, here the decline I'm saying, no, the decline will always be a linear decline. What do you mean by a linear decline? For example, 20%. Here becomes 8%. What is the total fall? What is the total reduction? Guys, 12%. This 12%, let us say it happens over the period of 4 years, which means every year there will be 3%. For 1 year, 3. And one more year, another 3. That's why here it's a straight line. If it is not linear, this becomes a curve. Is that clear? Are you all understanding? Hence, in a 3-stage model, a high growth rate, a decline growth rate, and then a constant growth rate. Is that clear, everyone? Is that clear, everyone? And once again, Gordon can be applied only here, because only after this the growth rate becomes into a single number. If we start here, there are 3 different growth rates. You can't apply. Are you getting this, guys? Is everybody able to understand this? Right? This is called as a 3-stage dividend discount model. Now you have finally something called as H model. Rarely, in fact, it was never tested till your May 26 attempt. That's why students also got panicked, not because of that reason alone, because there was no question also in the study material. But anyways, now guys, what is a H model? Very simple. H model says, now there is a 3-stage dividend discount model we saw. What happened initially? For the first few years, you're going to have a high growth rate, then you have a linear decline, and then it becomes constant. H model says you're starting from here. H model says the high growth rate period is already over. I'm starting today, I'm already at this point. From today onwards, I will start off with a linear decline, and then I will have a constant growth. So ideally, this is one more variant of what? It is actually merged, it's actually a mix of 3-stage and 2-stage. Here you have only 2-stage, but it starts from here. So you start with a decline and then things become crystallized. Is this clear? First, fundamental understanding of the different variable growth rate models. Are they clear here? Guys, at your intermediate level, you would have seen this 2-stage model. It is there in your intermediate level. The name you might not have seen. They call it as variable growth rate model in dividend decisions chapter. But at the final level, this and this are there. Out of this 4, actually, the most trickiest part is this, the 3-stage model. Why? With numerical problems, we will see this is nothing. Guys, there are a lot of hype about this because suddenly it came. I will tell you what it is. There is a formula. If you look at the formula also, it will be a little difficult. Nothing. We will decode everything and I will give you nothing to worry about that. But first, are you guys able to understand? These 3 come under what? Your variable growth rate model. All this explanation is not there in the study material, right? This H model and all, it's not at all there. One formula they have given and that's all. Derivation, logic, background, nothing is there. Not even a chart is there. Is that clear, guys? Right? That's why I had to take this from AI, and then I had to do this just so that you guys get a complete perspective of this. And guys, till now we have seen a constant growth rate model. Now we are going to see these 3 areas: 2-stage, 3-stage, and your H model. H model, one sum is there. We will do that. The recent your May 26 exam question, that itself. If you know the formula, guys, if you know the logic, that question is nothing. Direct formula application. In fact, there is some issue in the question also. There is a mistake. Okay. Anyways, forget that. I will do all of those things. Do not worry. Now, shall we get started here, guys? Shall we get started? Right. Now, first we'll get started with what? A 2-stage dividend discount model. Now, what happens here? Initially, for the first few years, you have a high growth rate, and then for the remaining part, you have a lower growth rate. Suddenly, it falls. That's all. So, which means you have only 2 different growth rates. In this case, what do you need to do? Arrive at P0. We are in valuation chapter. Is that clear? You need to arrive at P0. Shall we do this? Shall we do this? Perfect. Now, we will understand this concept with the help of one numerical problem. Shall we get started? Hello, guys. Come on. Shall we get started? Yes. So, please take TYK question number 3. Please take TYK question number 3. I think it's on page number 116. Huh? Yes. TYK question number 3. Shall we begin? Guys, shall we begin? Come on. Yes, let's do this. Guys, I want full focus. Please the remaining part of the valuation area depends on this model. So full-fledged focus, students take it for granted. They think they know it. The problem is you might be knowing it, but when you are solving, you might commit a mistake. And guys, you can't afford mistakes. This is the core of valuation. All right, let's get started. Shall we? Guys, come on. Yes. MNP Limited has declared and paid an annual dividend of 4 rupees per share. What is 4? Everybody, guys, participate. D0. Do it with passion, guys. Now, it is expected to grow at the rate of 20% for the next 2 years and 10% thereafter. Now, wait, you have two growth rates. 20% for how many years? 2 years, right? If I have to put it on a chart, 2 years, year 1, year 2, the growth rate is how much? 20%. After that, it becomes how much? Direct drop, 10% for up to perpetuity. Is that clear, guys? There is a sharp decline overnight. In single year, it fell down. Is that clear, guys? Two-stage model. Is that clear? Yes. Now, the required rate of return of equity investors is 15%. What is 15%? KE. Why do we use KE? Discount rate. How do you arrive at the present value of the cash flow? This is the bridging factor. Is that clear? Right. Next, compute the current price at which the equity shares should sell. Means what? Intrinsic value. The fair value, P0. Note, the present value interest factor at 18%, 1 year, 2 year given. Is this required? Is this actually required? You can use your calculator. Guys, getting it? But, generally we take 3 decimals. Here they have given 4 decimals. So don't use your creativity here. Follow what is given in the question. Is that clear, guys? That was also one of the reasons why I wanted to share this with you, right? When they have given 4 decimals, so then we should use 4 decimals. I see in its table itself, it is given only 3 values for Inter FM. Look, they only use 3 values everywhere. 3 decimals only they have used everywhere, right? So, guys, it's not like that. They are quite inconsistent, but never worry. If in a specific question they have given some values, let's use it. That's about it. Are we done? Are we clear with this? Guys, clear with this? Yes, yes, yes. Everybody? Now, write down question number, TYK question number 3. TYK question number 3. Now guys, please do not write anything. Do not write anything. I want your active participation. We will first frame the equation. Right? You guys are going to frame the equation. I am going to write. Okay, now you become the teacher, I become the student. Okay, for a change. Right? Now guys, now you are going to frame the equation. What do we need to calculate? The present value of all the future cash flow. That is called P0. Is that clear? Now, you guys tell me. Now, P0 is equal to. Now, for how many years the cash flows are equal? I mean, for how many years? Initial growth rate? 2 years. Can I apply Gordon today? No. Why? Sir, for the first 2 years, I have a different growth rate. After that, there is a growth rate different. So only when the growth rate remains constant up to perpetuity, at that point only I can use Gordon. In this case, at the end of 2 years only I can use Gordon. So today I can't use Gordon, which means first year cash flow, discount it. Second year cash flow, I'll discount it. Now I will try to find the value of this share at the end of second year using Gordon's. Now that value that I get is called as terminal value. What is it called as? Terminal value. A very, very important thing. Terminal value means what? The value at the end. Terminal means end. Termination. Terminal means end. At the end of your different growth rates. Beyond this, the growth rate will be constant because only then you can use Gordon's. Guys, getting it? Now that terminal value is not the value today. It is at the end of year 2 in this case, which means I need to arrive at the present value of the terminal value. Is that clear, guys? Which means in this case P0 is the present value of first year dividend plus present value of second year dividend plus the present value of terminal value. Is that clear? Is that clear? Suppose they had mentioned in the question, sir, after 5 years it is going to remain constant. For the first 5 years, take the respective cash flows and do the present value of that. And at the end of the 5th year, arrive at the terminal value and calculate the present value of the terminal value. Is everyone understanding this? What do you mean by terminal value? We saw in the previous sum, no, at the end of the particular period, whatever is the value, you apply Gordon's formula and you do it. Now you guys tell me P0 is equal to, first, can I say D1 divided by 1 plus KE to the power 1. Getting it? Correct? Guys, everyone? Yes. Plus. Yes, tell me. D2 divided by 1 plus KE to the power 2. Guys, getting it? Now that's all. Now this is only 2 years cash flow. Now after this, life becomes, my growth rate becomes constant. So I will have to calculate something called as terminal value. But this value is at the end of year 2. Which means once again here also I will do what? Divided by 1 plus KE to the power 2 only. Is this clear, guys? Now, how do you calculate terminal value? Can you tell me? Now I'm standing at the end of year 2. I'm standing at the end of year 2. I'm trying to value the share at the end of year 2. Now use Gordon's model. Gordon's model. Come on, tell me. Just now we calculated. Now next year dividend. What is it? D3 divided by. Yes, divided by KE minus G. Is this clear? Is this clear? The most important thing here. Now guys, D3 how will you calculate? D2 into 1 plus G divided by KE minus G. The most important thing here, G will be at the constant rate 10%. Till now it would have been 20%. Remember this, many students commit a mistake here. Is that clear? Is that clear? So here, because from now on my growth rate crystallizes and it is not going to change, only then I can use Gordon's. Is that clear? Are you all able to understand this? So when will I use Gordon? Only when my growth rate becomes constant. Till then, take the respective year's cash flow and arrive at the present value of that. Is that clear? This is the thing we will be following even in your 3-stage model also. Getting it? In a 3-stage model, what happens? In a 3-stage model, what happens? I can apply Gordon only here. Guys, getting it? Till then, I take the respective year's cash flow and arrive at the present value. And after that, I arrive at the terminal value. Exactly the same. But the wordings of the question could be a little different. So the calculation could be a little difficult. That's where I said you need to watch out. Beyond that, we have actually completed variable growth rate model. H model is a unique one. We will see that. Is that clear, guys? With the help of numerical problems, we'll be seeing variety of sums here. Now, shall we quickly solve the sum now? Guys, shall we quickly solve this sum? Are you guys getting it? Are you guys getting it? No, once again, there is another way of writing this equation. Some people even do this. P0 is equal to D1 by 1 plus KE to the power 1 plus D2 by 1 plus KE to the power 2 plus terminal value. Directly they write this. D3 divided by KE minus G. This is terminal value, but this is the value at the end of year 2. Hence into 1 divided by 1 plus KE to the power 2. Is this clear, guys? Now some students at the intermediate level, they used to ask me, sir, I think there is a typo error, sir. Here you have taken 3, here you have taken 2. I think there is a mistake. No. Gordon's model at the end of year 2 says next year dividend upon KE minus G. So hence I have taken 3 here. But the value is at the end of year 2. Hence this is only to the power 2. Is that clear? This is not a typo error and all. Are you guys getting it? Are you guys getting it? So please have this very clearly in your mind. This is another way of presentation. Accept it. Is that clear? Or you can just put terminal value upon 1 plus KE to the power 2. And here you can write what is terminal value. Is everyone able to understand this? Guys, trust me, we are sharpening the axe. In fact, we are also parallelly solving numerical problems. Trust me, this way, if you learn it, there is no way you can make a mistake. And of course, calculation, and whenever you're reading a question, be very, very careful. Now, quickly write this down. I'm just in the formula part here. It's an alternative presentation. You can just say or. Quickly write this down. Online folks, you can pause the video now. Take 60 seconds time. Quickly catch up. And then we continue watching the lecture. I'm pausing the video now. Okay, guys. Shall we get started? Yes, let's do this. I hope you guys have done this now. Okay. So, we'll do it in equation format itself. Or if you want, you can put it in dabba format. Any which way you want, you can do. You want it dabba format? Huh? Okay, let's do it. We will have a proper way of doing it. Write down. What is the format? Template. You guys should tell me the template. I've already told. Year, then. Use a common word, cash flow. Why? 2 years dividend. Then you have terminal value. Yes. Next. Yes. PV factor. It's given in this question. Or what rate? Always write the rate, guys. What percentage? 15%. Huh? Yes. And then PVCF. Now if you do it like this, chances of throwing up an error is very less. Okay, so now write down this is 1. Okay, one second, if possible make this into a bigger column to show some calculations if possible. Okay, now 1 2 and once again put 2, that's all. No guys, 1 2 d1 d2 and then tv only is there. No, all right. Now what is the first cash flow called? It is d1 now. D1, am I right? Then you have D2 here. Then you have terminal value. Am I right, guys? All these are for your reference. Now, what is D1? Can I say it is 4? Is it 4? No. 4 is D0. So, this into 1 plus G. What is G here? Guys, for the first 2 years, it is 20%. So, into 1.20. How much is that? Quick. 4.8. Am I right? Now the second year dividend is going to be what? I can say 4 into 1.2 to the power 2, or you can say 4.8 into 1.2. Both are correct. Guys, the previous year dividend into 1.2, or you can say this base dividend into 1.2 to the power 2. Both are same only. How much is that? Yes, 5.76. 5.76. Am I right, guys? Yes. Now terminal value. How will you calculate? You guys know. Now you're standing at okay, 1 second. If you want, leave a few lines, come down and write. I don't want to squeeze it here. Write down, take a red ink and write calculation of terminal value. Write it fully first. Terminal value. TV. Now you guys tell me, this is the most important calculation. From now on, this becomes the order of the day. Alright, even in business valuations, we'll be using it left, right and center, the next chapter. Okay, so now terminal value. We need to calculate terminal value as the end of year 2. Am I right? So it's going to be what? D3 divided by KE minus G. Am I right? 1 second. Here D3 is what? Now D2, can I say D2 into 1 plus growth rate divided by KE minus G. Am I right, guys? Remember, take a red ink. Take a red ink and here you put a bracket down, write down. G is equal to 10%. Am I right? Guys, from now on, I'm going to hit the constant growth and the growth rate is not 20, it's 10%. Is that clear? Now do this. Now, what is the base dividend? 5.76, huh? Yes, write down here. 5.76 into. So what is it going to be? 1.10. Am I right, guys? Divided by. What is KE? 0.15 minus what is growth rate? 0.10. How much is the numerator? 6.336 divided by the denominator is 0.05. How much is this? 126.72. Yes. So write down here. It's going to be 126.72. Guys, is that clear for everyone? Is this clear for everyone? So now PV factors, don't use your calculator. Given in the question, copy paste. 0.8696, 0.7561, once again 0.7561. Is that clear? Is that clear? Right. Next, PV CF multiply. Tell me how much? How much, ma? 4.174, then 4.355, then 95.813. How much is this in total? 104.34, stopping exactly at 3428, 2 something. Okay, put it as 2. That's about it. Is this clear? Now this is what? The intrinsic value of the share. Are you guys getting it? Now if you notice, out of the value of the share, significant portion of the value comes out of your terminal value. Guys, getting it? Significant portion of the value of a share comes from terminal value. Why? The initial only first few years. I'm planning to hold it till perpetuity. So significant cash flows will happen only after, the growth rate changes and all. Only when it becomes constant, the significant portion of my holding lies there. Hence, for every share, generally, The significant portion of its value is derived from terminal value. That is the importance of terminal value. That's why even in business valuations, they go based on terminal value. I mean, terminal value is very important. So initial cash flows, yes, they are important. See, roughly, just roughly speaking, about 104 rupees, some 4 plus 4, roughly around 7-8% comes from the cash flows for the first 2 years. Balance comes from what? Your terminal value. Is that clear, guys? Is that clear? Right? And that's about this particular question. Now, one more thing, guys. Here, D3, no? D3 is there, right? Can I say D3 is another way of writing? I'm just mentioning D3, another way of writing. Can I say it is 4 into 1.20 to the power 2 into 1.10? Can I also say this? This is nothing but what? This figure gives you D2 into 1 plus new growth rate. Am I right? This becomes D3. These are other ways of writing. So suppose, right, in ICA solution, if you see, in a printed solution, if you see something like this, no, don't worry about it. Right? It's not something new. This is all one and the same only. Is everybody able to understand? Right? And that's about this particular question. Can we just go and update our library of adjustments? Write down. So I think we'll have to write this. Write down, guys. Just write down. Yes, P0 is equal to, just come down and write, P0 is equal to 104.342. 104.342. And that's about this particular question. Oops. Yep, that's about this question. Right? So just go and update your library of adjustments. Write down. Calculation of P0. Hyphen write down calculation of P0 hyphen two-stage dividend growth model, or two-stage dividend discount model. Dividend discount model we put as DDM. Okay, dividend discount model, two-stage DDM. Is that clear, guys? Now, guys, before we wind up the session, just quickly, I will just walk you through this. Okay, I will walk you through this, and there is also a couple of things that I want to share here. We will do that. Okay, now please take your concept book. Now, variable growth rate model. This model is also called, underline or highlight please, multi-stage dividend growth model. Multi means what? More than one, right? Could be 2 or 3, right? Is that clear, guys? Next, in case the growth rates are not constant throughout the life of the company, Gordon's formula cannot be applied, cannot be directly applied. You can apply it only at a point of time when your growth rate becomes constant. So you can't apply it at T0, maybe at a future point of time. That's called as terminal value. Is terminal value already in present value? No, which means you need to bring it to present value later on. Is that clear, guys? Have the clarity. And in such a case, we will have to modify the valuation method. It should, however, be noted that though we can assume multiple growth rates, but one growth rate should be assumed for infinity. Only then we can find the value of equity shares. So no matter what model you follow, at some point of time it has to go till perpetuity. At that point of time we calculate terminal value using Gordon's model. Is that clear now? Right? Now, had I read all these things before doing the sum, you wouldn't have understood anything. That's the reason we do it in a different way. Is that clear, guys? Right? All those stages of the company's growth fall into the following categories, such as growth, transition, maturity phase. But for valuation, the multiple dividend growth can be divided into the following two categories. Two-stage dividend discount model, just now we saw, right? And you also have three-stage dividend discount model, right? Fine. Next, in both the cases, the following steps will have to be performed to arrive at the intrinsic value of the share today. Guys, basically, guys, in this case we saw, if you look at this, this is a growth phase. The company is growing well. This is called the transition phase. It is declining. And here they are calling it, they are giving it a different name here. They're calling it as the maturity phase. Exactly. From now on, the company becomes mature. Beyond this, there is no further scope for potential. It is like, it's in your everyday stock markets. I told you guys, large cap companies, they will actually, beyond a point, they've already grown companies. Beyond this, how much can they grow? So the growth potential is not that high, but risk is also not that high because they're a mature company. Even if there is a fall, there are multiple business. They can actually come back, right? Low risk but low return also. Whereas a mid cap or a small cap company, they have just started, or maybe they've not yet reached there. Now they are aggressive. Till the time they get there, the growth will be more. Once they also become into a large cap company, maybe the growth rate will stagnate. Is that clear, guys? That's why we say multi-bagger stocks, like stocks which can give you heavy returns, right? They are generally there in mid cap and small cap. Large cap giving a multi-bagger excellent return is extremely rare. One example was Nvidia. You saw Nvidia, I told you, no? Extremely rare, and no one can predict that also. It gave 100 times, 100%, no, 100x returns in a span of a few years. That's something crazy. No one would have ever heard a large cap company doing this well. Well, of course, they are saying it's an AI bubble, but let's see how it goes off. Is that clear, guys? Next one. So how do you do, guys? A constant, I've given some steps here. Number one, calculate the present value of the high growth dividends. In this question, first 2 years, high growth dividends, right? Respective year, use the respective discount rate. Next, number two, calculate the terminal value using what? Gordon's formula. Is that clear? And now what do you need to do? Now this terminal value is at the end of the period, guys. So this terminal value must then be discounted back to, please underline, it should be discounted back to year 0. That's why I said terminal value, right, divided by 1 plus KE to the power 2 in our example. Is that clear, guys? Right? As the value derived is for the year n, we should use the nth year's discount factor, even though the dividend is for year n plus 1. Now, in your Gordon's model, D1 we say, or the next year dividend, we take Dn plus 1, right? Guys, getting it? Year 2, we calculated what? Terminal value. We took D3. So, in the numerator, we take what? N plus 1 year. But in the denominator, the value is only as on the nth year. Hence, we take only n. Is that clear, guys? Is that clear? Right? And sum of the components. So, add the present value of high growth dividends plus the present value of terminal value. Is that clear? And you arrive at what? The intrinsic value of the share. Now, in case of a multi-stage K, we are saying multi-stage growth model only, no? Now, remember, growth rate we said was different. Even KE could be different. KE is a discount rate, sir. If discount rate is different, what will we do? We will see numerical problems there. Is that clear? Remember, even KE can be different. Sir, for a stable growth period, later on, can my KE change? The answer is yes. In that case, what should I do? We will see later. Is that clear? With numerical problems, we have sums for that. Right? So, we will do this later. Now, negative growth rate. Guys, can G be negative? GG. Growth rate. I am not talking about this decline phase, sir. See, in decline phase also what happened? Every year the growth rate declines. Here it was 20. Maybe then it becomes 17. 17 is still a positive number. Then it becomes 15. That is still a positive number. No. I'm asking, can G be, let us say for example, minus 5. Can growth rate be negative? Yes or no? Yes, why not? A company is declining. Why not? Yes, it can be negative. Is that clear, guys? Companies can have a negative growth rate. Somewhere the company is not performing well. Yes, G can be negative. P0 only cannot be negative. G can be negative. Is that clear? Now, what is the formula we use for Gordon's model? Guys, Gordon's formula. D1 by KE minus G. Now, here, G becomes minus, means ideally in this case, minus of, let us say minus 5. Ideally, in this case, we can also rewrite this formula and say D1 is equal to, P0 is equal to D1 by KE plus G. Is that clear? Or this is ideally not a formula. I would never recommend you to write this formula. You just put it like minus of minus and then you arrive at it. Don't remember this as a separate formula and all. Is that clear, guys? Right? In some books they do it, but I would generally recommend keeping it intact. So in a standard Gordon model, the denominator is the cost of equity minus the growth rate, KE minus G. However, subtracting, please underline, subtracting a negative number turns it into an addition. Therefore, when a company has a negative growth rate, the denominator expands to become KE plus G. Is that clear? It's not a separate formula, but it's just a normal thing. Okay, and okay, one more thing, guys. G stands for what? Growth rate. Growth rate of what? Growth rate of what? What is growing? The cash flow, that is basically the growth rate, is on the cash flow. That's why on D0 you apply 1 plus D. So I'm saying that the dividend is growing at 5%, 10%, 20%, whatever it is. It is not a growth rate of my share price. Is that clear? It is not a growth rate of my share price. The growth rate is on the cash flow. It is either on the earnings or on the dividend. Dividend is based on earnings only. Is that clear? So if my earnings is growing at that rate, maybe my dividend will also be growing at the same rate. But is it necessary that my share price is growing at the same rate? No. Is that clear, everyone? Hence, when I say G represents the growth rate of the cash flows, the dividends or the earnings, not the share price. Right? Share price can be growing at a different rate. P0, P1, P2, P3 can be growing at a different rate as compared to the rate at which my dividend is growing. Is that clear, guys? Now, in some sums, in intermediate level and all, they actually took one sum. Recent RTP also they had one sum where the growth rate of dividend alone was given, and this sum you had no other option but to take the same growth rate for your growth rate of shares also. In the absence of information, taking it is an exception, but exception cannot be an example. Is that clear, guys? So hence, please be very clear. Look, different G factors for EPS and DPS, which G to consider. While calculating the intrinsic value or the current market price of a share using any dividend discount model, we must strictly use the growth rate of dividend. Suppose they have given the growth rate of share price, don't take it. Now suppose the growth rate of earnings EPS is given, growth rate of DPS is given, and these two are different. Can it be different? Yes, it can be. Sir, how, sir? Every year the payout ratio they are changing. If the payout ratio is also kept constant, then the growth rate of earnings will be equal to the growth rate of dividend. Guys, it's a proportionate figure. Suddenly year-wise they are changing. They can change the payout ratio. No, it's company's call. They can recommend the dividend. Now, if that is happening, the growth rate of earnings and the growth rate of dividend could be different. Guys, getting it? In that case, what will you take? Now, always remember, we go based on cash flows. In this model, we are talking about dividend discount model. Apply the growth rate on the dividend, not on the earnings or on the share price. Is that clear, guys? That is the moral of the story here. Is this clear, everyone? So if the growth rate is given on the dividend, only that needs to be taken. Is this clear, guys? And I've just kept one small fun fact here. The terminal value magic, just now I showed it to you, know. When you execute a multi-stage valuation, all right, you will often find that 70 to 80% of the stock's intrinsic value is derived solely from the terminal value. In that case, it was only 2 years after that it became constant. Hence, 95% or more than 90% more than that was actually derived from the terminal value. But generally, guys, when you're doing it, terminal value contributes more to your P0. Is that clear? Thus, this highlights a terrifying reality. If you think out of the box, look at this. This highlights a terrifying reality of equity markets. Investors are paying massive premiums today almost entirely for a reality that is projected to occur after a decade, which means no one can predict the future. But based on this going concern assumption, which you study in audit and your accounts and all, now based on that, the market is pricing a share which you are willing to pay, right, on an assumption that the company goes on forever. And more than for the next few years cash flow, you are actually paying much more for the value that you are expecting to derive in the later years. That's the reason why they say when you are picking a stock, do all the calculations properly. It's not a new company that has come. No, you look at so many parameters beyond figures. Who are the people who are running the company? How are they doing it? All these things will have to be taken into account. I told you guys, you know, growth rate, how do you get con calls? Right, after the quarterly results, con calls, how do you do this? This shows the true intent of the management. What are they doing? Are they serious into the business? Is that clear, guys? Now, when I'm investing in a share, I look at one very important thing. I look at the promoters holding in the company. Who are the promoters? They are the one who formed the company. How much are they investing in the company? If they don't invest much, or if the promoter holding is reduced, I told you guys, free float market capitalization, first session market, your stock market's basics, there it's nothing but the total market float minus promoter holding. Promoter holding is subject to lock-ins. If they want to sell, they can't sell directly. They have to get SEBI's approval while selling it. Is that clear? Now, if over a period it is reducing, somewhere it shows they themselves are not confident about the business. In finance, we call it as skin in the game. My skin in the game, how much is it? Owner, I am the owner. If I am not confident about my business, how can I expect investors to invest? This is one of the parameters. This is one of the parameters you can see in screener also. I mean, I showed you the other day. So in the practical session, so in screen, you can see this. How much is the promoter holding changed by? If there is a drop, reason. The drop in the promoter holding could be because of multiple reasons. Suppose if they are raising new money, then numerator will be their holding divided by denominator is the total capital. The total capital is increased. They have not changed anything. In that case, it's okay. It is justified. The promoter holding will reduce. That is fine. But if numerator itself is reduced, look for the reason. It's something that is extremely important because it shows the intent of the management. What are they trying to do? If you are not confident about your business, why do you want me to invest in your business? Simple. One of the parameters. Is that clear, guys? Are we clear with this? Yes? Right, guys. Fine. So did I dictate the library of adjustment? All these things were done? Okay, perfect, guys. So with this, I'm concluding this session. Guys, please revise and practice all the sums we covered till now, and I will see you all in the next one. Thank you all so much. Bye-bye. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now, let's continue our discussion in this chapter, equity valuation. Right? The chapter name is valuation of security, but yes, we are the first section, equity valuation. Shall we begin, guys? Yes. So now in the previous session, we got introduced to the concept called as variable growth rate model, right? And we did a question there. So now let's continue our discussion. We'll be doing a few numerical problems in this particular session. Shall we begin, guys? Yes. Come on, guys. Let's get started. I want you all to be fully focused here. Now, question number 17, mark this as DBE. A good question, a very good question. Now look, guys, this is a study material question and a past exam question as well, right? And it even came in your MTP, but a very good question. Now, XYZ Limited paid a dividend of 2 rupees for the current year, right? Then, one sec. Yeah. Yes, it paid a dividend of 2 rupees for the current year. The dividend is expected to grow at the rate of 40% for the next 5 years and at 15% per annum thereafter. Now, it is what stage? 1 stage, 2 stage, 3 stage. What stage model? 2-stage model. Right? So, a high growth rate and then followed by a decline, and that's going to be a constant growth from then on. Is that clear, guys? So, 15% per annum. The return on a 182-day T-bill is 11% per annum, and the market return is expected to be around 18% with a variance of 24%. The covariance of XYZ Limited's return with that of the market is 30%, and you are required to calculate the required rate of return and the intrinsic value of stock. Now, what have they asked in this question? First, what do you need to calculate? What is asked in the question? You are required to calculate two things. What and what? You are required to calculate KE and P0, intrinsic value. Is that clear? Now, P0, how will you calculate? Your variable growth rate, 2-stage model, just like how we did the previous sum. Now, for that, always you need to, all these are in future values. To bring it to present value, you need a discount rate. The discount rate for an equity share is KE. Now, how do you calculate KE? Now, in this question, it's not directly given, but they have given you the ingredients of what? CAPM model, right? Now, for CAPM model, what's the formula? RF plus beta times RM minus RF. RF is given? Yes. RM is given? Yes. Beta is given? No. But can you calculate? Yes. What is the formula to calculate beta? Guys, recall long ago, there was a chapter called Portfolio Management. There one guy called Markowitz was there, but he didn't formulate this model. So to develop that, only Sharp actually formulated. You guys remember all the story? Yes. Now there are two formulas. What are the two formulas? So R is into something, huh? Okay. So correlation, R of a stock with the market into standard deviation of the security divided by standard deviation of the market. Or if you improvise this formula, it is basically, yes, covariance. Covariance of the stock with the market divided by the standard deviation square or the variance of the market. Now in this case, covariance of the stock is given. Sorry, where is it? Yes, covariance of the stock is given. Yes, and they have given the variance of the market. Don't put 24 square. This is variance itself. Is that clear, guys? Hence, we can calculate the beta. If you have the beta, you can calculate KE. If you have KE, you can go ahead and do this sum. Look, a beautiful sum. This is called as a multidisciplinary sum. Between multiple chapters, they are interlinked. You can't say, sir, this is from this chapter, sir, earlier chapter and all. No. This is how they actually interlink, and in my opinion, this is how they should give also. Is that clear? This is not a BCom exam, right? Getting it, guys? A very, very practical question, because I told you in real life, we arrive at KE using CAPM. In this question, they have went one step ahead. They are not testing you just on the CAPM formula, they are testing you on beta formula also, in a valuation area. Is that clear, guys? An excellent sum, though it might be small. Yes, we will put it under DBE category. Now, shall we do this, guys? Is everybody able to understand what has gone into this question? I'm just giving you guys an approach, so now let's do this. Yes, 1 second. Opening this question. My reference. Yes. Shall we begin? Guys, come on, let's do this. Let's do this quickly. So, TYK question number 70. TYK question number 70. Okay, guys, let's begin. Shall we? Yes. So, first, write down. Step number one, calculation of beta. So first you need to calculate beta and plug this in your CAPM to calculate KE, and then using KE and of course the other ingredients you calculate P0. Look how graded this question is, a brilliant question. Okay, so now first, guys, write down beta is equal to, tell and write, what is the formula we'll use here? Yes, covariance of this is XYZ limited. Okay, put it as covariance of X with M. M stands for market. Am I right, guys? Yes, very good. Very happy to see all of you are remembering the formulas, right? Okay, come on, tell me. Divided by what? Variance square. I mean the standard deviation square the market. Variance of the market. Is that clear? So now give me the figures, guys. It's directly given. 30% upon 24%, right? The percentage and percentage gets knocked off. Nothing to worry. It's 30 by 24. How much is this? 1.25 times. Is that clear? You guys know what this 1.25 represents, right? The market goes up by 10%, my stock goes up by 12.5%. That's the meaning of that, right? Next one, step number 2, calculation of KE within bracket CAPM, capital asset pricing model. Write down KE is equal to, tell and write, guys, RF plus beta times RM minus RF. Now what's my RF? Everyone, come on, 11% plus what's my beta? 1.25 times what's my RM? 18%. What's my RF? 11% again. So now, give me the figure. How much is that? It's going to be 19.75%. Getting it, guys? Any issues, any problem here? No. So this is the first part of the question. In the question, they had asked you to calculate KE and P0. KE is calculated, right? Next, P0. Write down step number 3. Use the same language. Calculation of intrinsic value of the stock. Intrinsic value of the stock. Within bracket, write down two-stage dividend growth model. Or you can even say two-stage dividend discount model. Both are one and the same. Is this clear, guys? Shall we do this? Now, how do we do it? Now, what have they given in the question? Guys, come on, I want your participation. What have they given in the question? For the first 5 years, they have given there is one discount. I mean, there's one growth rate. Hello? Yes, how much is the growth rate? 40%. And for the remaining up to perpetuity, it's going to be what? 15%. Am I right? Initial 40, then 50, which means Gordon's can be applied only at the end of 5th year. So you calculate something called as terminal value at the end of 5th year. Till then, respective year cash flows needs to be discounted at the whatever is the discount rate, and then you will also add the terminal value, which also has to be brought to the present value. Is that clear? The approach is same now. Shall we quickly do this? Right? We will do it in our Dabba format itself. Can we do it, guys? Right. Shall we do it? Yes. Let's do this. 1 One second. Can we just write the cash flow equation once? Write down. P0 is equal to, tell and write guys, I don't want the figures and all. D1, tell me D1 divided by 1 plus KE to the power 1 plus D2 divided by 1 plus KE to the power 2 plus D3 divided by 1 plus KE to the power 3 plus D4 divided by 1 plus KE to the power 4 plus D5 divided by 1 plus KE to the power 5, am I right? Plus terminal value divided by 1 plus KE to the power 5 only. Is that clear? And here, what is your terminal value? Put that also here. TV is equal to, come on, tell me. Yes, D6 divided by KE minus G, because terminal value is computed at the end of 5th year. Next year's cash flow is D6 divided by KE minus G. How do you calculate D6? D5 into 1 plus new growth rate divided by KE minus once again the new growth rate. Is that clear? Guys, getting it? Is this clear? Now let's put it in the dabba format. Write down your cash flow, and leave maybe a bigger space here. Then present value factor within bracket. How much percentage? Don't look at the question. It is there in your step 2. 19.75. Is that clear? Put it up here. 19.75 percentage. Then present value cash flows. Shall we begin? Okay. Now guys, quickly, want to do this? Write down your 1, 2, 3, 4, 5, 5. Correct? Why 5, 5? 5th year dividend and then 5th year terminal value. Come on, cash flows. First year dividend. Yes, you can directly do the calculations. Guys, will you do it? Can you do it? Yes, tell me. First year dividend, how much is it? So 2.8. How did you get 2.8? Now, it has paid a dividend of 2, which means that is D0. So, guys, you can use the calculator trick here also. You guys know that? So, every year it grows by how much? 1.4. So, guys, 1.4 is a common number that you need to multiply every year. Take your calculator, write down 1.4. Type 1.4. Put into. Right? Type 2. What is the first number? 2. Put is equal to how much you get? How much you get? 2.8. Am I right? Now this 2.8 needs to be multiplied once again with a common number. Wait, don't do anything. Put one more is equal to how much you get? That's all. 3.92. Then one more is equal to 5.488 or 49. 2 decimals. Okay. One more is equal to 7.68. One more is equal to 10.75 or something. Okay, 10.76. Is this clear? Now wait, that's all. Beyond this, you can't use this calculator trick. Alright. Next, you need to use you need to find your terminal value. Am I right, guys? Yes. So you need to find your terminal value. Come down and write terminal value. So terminal value is equal to. Now, guys, you need to arrive at D6. How will you arrive at D6? Can I say it's 10.76 into what is the new growth rate? 15. So 1.15. Am I right, guys? Divided by what's my KE? 0.1975 minus the new growth rate 0.15. Am I right? Am I right? So give me the numerator and the denominator. How much is that? 12.37 is the numerator divided by 0.0475. Am I right? Okay, so 12.37 divided by 0.0475. Figure? You get 260.51. I get 12.37 divided by 0.0475. Okay, 260.42 something is coming, no? 10.76 into 1.15 divided by 0.0475. 260 point. Oh, you retain the decimals, is it? Okay, guys, you guys retain the decimals. In the numerator, you retain the decimals. Okay, then it's okay, fine. It's okay. 0.51 now. 5052 something you get. 0.51. Okay, guys, nothing to worry. So 10.76 into 1.15 if you do, you get 12.374. So if you don't take the 374, if you just take 37, you get one answer. 374, if you read in the decimals, you get a slightly another answer. It's okay. Decimal round off, don't worry. In exam, it is fine, right? But rounding off generally towards the end you can do, or maybe here this is fine. Don't worry. It will have just some small variation. Institute will not penalize you for that. Go up and plug it. It's going to be 260.51, right? Okay. Now put up the present value factors. You guys know the calculator trick for this. 1 divided by 1.1975 is equal to 3 decimals 0.835. One more is equal to 0.697. One more is equal to 0.582. One more is equal to 0.486. One more is equal to 0.406, and no one more is equal to copy paste. This is also for the 65th year only. Is that clear? Multiply, tell me the figures. 2.38 3.3 2.34 is coming. Yes, 2.34. Next 2.73, then 3.19, then 3.73. Very good. Then 4.37, then 105.77, single button MRC 122.13, and that is the end of this question. Simple, isn't it, guys? That's all it is. You've got the present value of all the future cash flows and you're done here. Is that clear? Visualize in this chart. You visualize first 5 years one growth rate, then it suddenly drops and it becomes what? Another growth rate. 40% for the first 5 years and then 15% for the remaining. Is this clear, everyone? Guys, getting it? That's about this question. Okay, so during the break time, one student asked me this question. Let me also clarify. Sir, will the growth rate always only fall, sir? So here, sir, earlier it was high, then it fell down like this. Earlier, sir, it was high, then it gradually declined. Here also decline. Sir, will it always decline? Generally yes, because in the initial phases, I told you the potential of earning is much more. The growth potential is much more. And eventually it will decline. This is how generally it happens. Sir, no sir, I have seen companies which actually keep growing every year and the growth rate itself will increase. Yes, practically it is possible. But here we are talking about models. When you're having some model, it is based on some assumption. So based on the assumptions, yes, these are the popular models available. If you have a different actual reality, based on whatever is the reality, you apply the concept. That's about it. Is that clear? Right? Maybe in exams, I mean, they will not, but I'm just telling you, initial 20%, initial few years, then suddenly it became 40%. Practically not possible, but yes, if at all they give, apply it accordingly. But as models, when we are doing it, this is how it generally works. There will be a decline eventually. Is that clear, guys? Right? So now, that's about this question. Please go and update your library of adjustments. Write down. Calculation of beta within bracket covariance, bracket close, semicolon. Calculation of beta within bracket covariance, bracket close, semicolon. Calculation of KE within bracket CAPM. Calculation of KE within bracket CAPM. Semicolon. Calculation of P0 within bracket 2-stage DDM. Calculation of P0 within bracket 2-stage DDM. Dividend discount model, or you can say dividend growth model, whatever it is. Are we done here, guys? Are we done here? Now, shall we move on to the next question? Okay, please take TYK question number 6. Please take TYK question number 6. It's on page number 118. Okay, TYK question number 6. Okay, shall we do this, guys? Okay, so this was a past RTP, of course, study material, past RTP, and even an old exam question. Shall we get started here? Guys, yes, let's do this. Piyush Lunkar and Associates, some company, okay, presently pay a dividend of 1 rupee per share and has a share price of 20. So very strictly speaking, legally and associates and all, it is not a company, correct? So when you are a company, it has to be private limited or limited as such. They have given here, this company is paying dividend now, which means, I mean, it's actually not a company. Don't worry too much about the technicalities. Okay, some company, okay, they are paying a dividend of 1 rupee per share. The share price is how much? 20 rupees. Now, number one, if this dividend were expected to grow at a rate of 12% per annum forever, what is the firm's expected or the required return on equity assuming the dividend discount model approach? Number two, instead of this situation in part 1, suppose that the dividends were paid, were expected to grow at 20% per annum for 5 years and 10% per year thereafter. Now, what is the firm's expected or the required return on equity? That's all. This is what has been asked. Now, guys, I'll give you 2 minutes time. I'm not looking for the answer. I'm looking for the approach to the solution. That's the most important part. Answer, we will do it together, but approach to the solution. Online folks, pause the video now. Take 120 seconds time, not more than that. Please pause the video now. Understand, digest the facts, frame and approach the question. Do not look at the solution, right? Try attempting it and then continue watching the lecture. 2 minutes. Now, guys, tell me, what is being asked in this question? What have they asked to calculate? What have they asked to calculate? KE, ROE in this question signifies the expected return on my equity investment. That is nothing but KE. Contextually understand, strictly speaking, ROE and KE are two different things. What is ROE? The return the company is able to generate on its equity. That is from the perspective of the company. Your money with me, how much am I able to generate return out of your money? KE is not the actual return the company is able to make, the expectation of the shareholders. But in this context, contextually, if you understand, they are asking for KE. Is that clear? Very clear. Now, what is the firm's expected or required return on equity? Means what? Expectation. They're talking about KE only here. Here, R doesn't come anywhere, right? Your G is equal to B into R. That R does not come anywhere here. Right here, it means that ROE and KE are interchangeably used. Contextually understand. Strictly speaking, they are two different things. Is that clear, guys? Now, in this question, should you calculate P0? No. What is P0? 20. Is that clear? Sir, the company has a share price of 20, sir. Then, sir, this 20, is it the actual price? Yes, it is the actual price. This is also equal to intrinsic value. How do you know? Only then, you can make out of the question. The data is given such. So to calculate the intrinsic value, then they should have given KE. KE is the discount rate. Without that, how can you find? Which means in this question, they have given you the intrinsic value. They have given ways to compute every year cash flows and all. The only missing figure in this question is what? KE. You need to calculate R. I mean, the discount rate. The discount rate in this question. Is that clear, guys? Yes? Now, first part of the question, what are they saying? Come on, guys. What are they saying here? Now, the dividend is expected to grow at the rate of 12% per annum forever. Right? Calculate KE. Now, is it a direct Gordon's model? One stage growth, single stage growth. Right? Getting it? Gordon's model directly I can apply. Hello? Shall we do this? Come on, write down. This is TYK question number 6. Write down. TYK question number 6. Part 1. Write down part 1. Part 1. Now, guys, can I say P0 is equal to T1 divided by KE minus G? Why? Single stage growth model. They're direct Gordon's model. Am I right, guys? There's only one growth rate here up to perpetuity. I can apply it Gordon today only. Is that clear? Now, putting this up here, you guys tell me what is P0? Is this given data or not? Guys, yes or once again. Using this, can I say KE is equal to D1 by P0 plus D. We have already seen the derivation here. Cross multiply. What derivation here? Cross multiply. KE minus D is equal to D1 by P0. Then one G goes the other side. KE is equal to D1 by P0 plus D. We have seen this earlier. Getting it? Now, You guys tell me. So KE is equal to apply. What is D1? Now they have given paid dividend or presently pay a dividend of how much? 1. Growth rate is also given 12%. So it's 1 into 1.12. Am I right, guys? Divided by what's my P0? It's given 20. Plus what's the growth rate? What's the growth rate, guys? Come on. Yes, 0.12. Do this. It's going to be 1.12 upon 20. It's going to be 0.056 plus 0.12 gives you how much? 0.176, right? Or 17.6%. So now you know that the investors can expect a return of how much? The net return of how much? 17.6%. This is going to be the investor's expectation. Simple, vanilla, plain. Is that clear? Now let's move on to the next one. Shall we, guys? Yes. Okay, let's move on to the next one. Instead of the situation in part 1, means forget part 1. Suppose the dividends were expected to grow at a rate of 20% per annum for 5 years and 10% per year thereafter. Now what is the firm's expected, or calculate the KE. Now guys, here it's a 2-stage dividend growth model. It's not a single stage growth model. So now what will you do? First thing that you need to do is frame the cash flow equation. Many students commit a mistake here. You actually frame the cash flow equation and then it will automatically lead you to the solution. Is that clear? So write down, okay, write down part 2, 2-stage dividend growth model. Maybe for part 1 you can take the heading single stage dividend growth model. Okay, part 1 you can update the heading single stage dividend growth model. Okay, we will do it properly. Shall we get started? Hello? Guys, come on, guys, tell me. Let's do this, shall we? Now, first and foremost, frame the cash flow equation. Now, tell me what is it? P0 is equal to, guys, come on, write it out. D1 divided by 1 plus KE to the power 1 plus D2 divided by 1 plus KE to the power 2 plus D3 divided by 1 plus KE to the power 3 plus D4 divided by 1 plus KE to the power 4 plus D5 divided by 1 plus KE to the power 5. Once again, plus don't put terminal value. We'll arrive at the terminal value. What is terminal value? How do you arrive at terminal value? D6 divided by KE minus G. This is the terminal value, but I need to arrive at the present value of the terminal value. Hence, into 1 divided by 1 plus KE to the power 5 only. Is that clear? Everybody, is this clear? And remember, this G is going to be a new growth rate. And here also D6, how do you arrive? D5 into 1 plus new growth rate. Is that clear, guys? First, is this clear for everyone? Is this clear for everyone? Right. Now, first plug the figures. What are the figures available? P0 is available. Yes, what is P0? 20. Put it up. 20 then, yes, 20 is equal to, come on guys, I need your help here with the figures. Dividend D1. So I told you use a calculator trick. First, what will you do? So what is the growth rate for the initial years? 20%. 1.2 into 1 is equal to, then is equal to, then is equal to, then is equal to. First year, how much is it? 1.20. Okay, so divided by 1 plus KE to the power 1. Then plus 1 more is equal to 1.44, right? Guys, you are understanding the calculator trick? Yes. Divided by 1 plus KE to the power 2. 1 more is equal to 1.76. Sorry. How much was that? Okay, starting middle, they have made a mistake. 1 second, 1.2. 1.728. So we'll put it as 1.73 is divided by 1 plus KE to the power 3 plus, yes, how much is it? Next one, 2.07. Okay, 1 plus KE to the power 4 plus 2.49. Yes, by 1 plus KE to the power 5 plus. Now you need to have a D6 value here. How do you arrive at D6 value? Put the calculations, no problem. 2.49 into 1 point, what is the new growth rate? 10%, right? So 1.10 or 1 plus 0.10, whatever, whichever way you want, you can write. Divided by, what's my KE? I need to calculate. What's my G? Which G will I put? 10% by 0.10 into 1 by 1 plus KE to the power 5. Is this clear for everyone? Is this clear for everyone? Hello, guys? Now this is like this return on investment formula. Basically, guys, the rate that equates my inflow with outflow, right? I call it as what the effective rate of return, nothing but IRR. Am I right, guys? Now in this case, you need to calculate KE using IRR approach. Guys, getting it? For you to do that, the first step is to frame the cash flow equation properly. If you make a mistake here, gone. You might get the steps right, but you are working on the wrong figures. Is this clear? Now what do we do first? Time value of money. Remember, recall. What will you do? I will first take this 20 to the other side. This is present value of cash inflows. I'll take this to the other side minus present value of cash outflow. This is already in present value, today's value only, right? Now I will say this is I call it as NPV. The rate that makes my NPV equal to 0 is called as IRR. Now we will take two trials. Trial 1. If you get a positive NPV, then what will you do? I want to reduce and make it equal to 0, right? So what will I do to reduce the NPV? I increase the discount rate, right? Second trial will be more, and accordingly get a negative NPV and do an interpolation, arrive at the correct KE value. Is this clear, guys? Shall we do this now? Quickly, shall we do this? We have already done this in time value of money. Am I right? We've already done this. This is the reason why I do all those things there. Else here I'll have to start once again. What do you mean by IR? This chapter has its own complexities. Is that clear, guys? Shall we get started here? Shall we get started here? Now. Okay. Okay. Now, can you just rewrite this by saying 0 is equal to, then once again, please do this, guys. Rewrite this and take this 20 here and put minus 20. Can you do this? Once we'll do it, and then we'll just take two trials. Can you do it? Guys, please rewrite it again. Make it fast. So this is nothing but this represents present value of cash inflows. I'm an investor, am I right? Minus 20 is the present value of cash outflow. I pay 22 actually buy the share. Am I right, guys? So the rate that makes my NPV equal to 0 is called as IRR, the effective return. That's what is KE, expected rate of return. Are you guys getting this? You guys have done this here? Copy paste the inflows, put minus 20 is equal to 0. The rate at which, the rate that makes my NPV equal to 0 is called as IRR. We have seen this before. Am I right? Guys, please reciprocate. Yes. Now, we need to take two trials. In this question, they actually didn't give you the hints. But generally in exam, they will give you, sir, out of the blue, where will we start, sir? Yes, ideally speaking, they should have given an exam they will give. The two trials will take, first trial will take it as 18%. Okay? And we will see. Okay? We will see. Shall we do it? How do we know in exam they will give you? In exam, if they have not given, I told you how to do it. First take 15%. And then based on the answer of NPV, you either take the next trial as 20 or the next trial as 10. Is that clear? Generally, it lies here. In exam, theoretically, this is how it happens. But generally, they will give you, do not worry. Is that clear? The test is not, I told you, IRR in real life, one tap of a button you will get. Here, the test is on applying the concepts of time value of money. That's about it. Right? They will not, they are not testing you on which guess you are taking right and all. That is not the test here. Right? So first, write down, guys. Let KE equals 18%. Let KE equals 18%. Now guys, at a KE of 18%, so we'll have to calculate NPV. Hello? Now let's calculate NPV. NPV is equal to, so now, 1 second, how do we do this? 1.2 into, leave some gap, am I right? Plus 1.44 into, leave some gap, plus 1.73 into, leave some gap. Am I right, guys? Hello? Why do we leave the gap? Calculator trick. Are you getting it? What happened? Yes? Yes? So plus 2.07 into, leave some gap, and then you have 2.49 now. 2.49 into, leave some gap, plus, now this is, can this be done? Okay, let's do this here. We'll have to do this. Guys, here it has to be 2.49 into 1.10 divided by KE. We are taking KE as what? 18%, am I right? Hello? So I put it as 0.18 minus 0.10. Am I right? This is the value into the discount rate. Guys, getting it? The discount rate we are yet to arrive. The same discount rate for the 5th year, we are going to put it here. Am I right, guys? Guys, are you getting it? Yes, finally, minus 20. This is your outflow. Now, plug and play. 18%. So 1 by 1.18 is equal to, how much you get? 0.847. Yes, I assume they have used, they've used 4 decimals in this question. Okay, this question, let us also use 4 decimals. In exam, you can take 3. Now, not a problem. For me, let us match the answer of ICA for this question. Sir, in exam, how will we know? You take 3 decimals, that's fine. So take 4 decimals. Tell me, guys, how much is it coming out to? 0.8475. Yes, one more is equal to 0.7182. One more is equal to 0.6086. One more is equal to 0.5158. Yes, one more is equal to 0.4371. One more is equal to no, it's the same only. So 0.4371. Is this clear, guys? Now please do the calculations. Tell me the total of present value of inflow minus 20 is already there. I want this total of present value of inflow. Please do it, guys. Please do it quickly and tell me. Or fine, figure wise, let's do this, because there's a terminal value also here. What is the first figure? 1.2 into 0.8475. How much is it? Hello, please do it, guys. Do it and tell me. How much is it? First line item, how much is it? 1.017. Yes. Plus second line item. Please be loud. Please be loud. Yes. 1.034 plus third line item. 1.053. Fourth line item. 1.068. Yes. Fifth line item. 1.088 is 1.088. Okay, 1.088, no problem. Okay, then plus the last line item 14.97. 14.97. You guys did this into this value. Am I right, guys? The present value of terminal value. Am I right? You're getting 14.97. Very good. This is, if you add this up, it's called the present value of cash inflows. Am I right? Finally, minus 20. So you guys tell me, what is the present value of cash inflow here? 20.23 minus 20. So you get how much? So 0.23, it's a positive figure. Alright. Now which means it's not exactly 0. It's not exactly 0. Guys, which means now had this been IRR, had 18% been IRR, your NP would have been 0. Guys, but now you're getting slightly a positive number. So which means now, should you increase the next trial or reduce the next trial? You should increase, guys. Trial you need to increase. If you increase the denominator, the value will reduce. I don't want a positive figure, I want a 0 value. Guys, getting it? Which means only if I increase the next KE trial, my overall NPV falls down. Guys, getting this? Please tell me. Yes, you're looking at, you guys in revise, Come on, guys, come on. This is your intermediate level area itself. Still I did time value of money. But anyways, you guys are clear with this, alright? So now let's take the next trial as 19%. Right now. Let KE is equal to 19%. Now what's your NPV? Once again, guys, you need to do this entire working. Yes, it is laborious, but it has to be done. Now, write the respective inflows into what? Leave a gap, and then finally you will have to plug all these values. Come on, let's do it. For me, it's slightly easy. Very easy, huh? Okay. Unfair, no? Unfair, huh? Dabba potu kuda we can do, but The reason why I'm doing it like this is because to understand the concept, you should frame the cash flow equation. That's the most important part. See, this is not a P0 calculation sum. This is not a P0 calculation sum. Yes, you are right. You can also put it under DABA format, but is IRR we need to calculate here, but you can also put it under that DABA format. But anyways, you're doing it like this, you can also do it like that, no problem. Okay guys, I'm just erasing off the decimals. So the respective cash flows into, leave some gap, we're going to fill this up, and here it's going to be 0.19 now. Okay, you guys have filled in the figures. Okay, shall we plug the discount factors? Hello guys, it's going to be 1 by 1.19 is equal to, how much you get? 4 decimals I told you. 0.8403. Yes, one more is equal to how much you get? 0.7062. One more is equal to 0.5934. One more is equal to 0.4987. Yes, 0.4987. One more is equal to 0.4190. Am I right? And that's about it. This is also going to be 0.4190. Guys, is everybody following? Is everybody following? Guys, it's just a computation driven sum, but nothing beyond that. IRR calculation. Come on, give me the figures, respective line items I want. The first line item, how much is it? 1.008. Good. Then plus. Second line item, 1.017. Third line item, 1.026. Huh? Yes. Next one, 1.032. Next, 1.043. No, 1.043. Please take your calculation. Plus 1, 2, 3, 4, 5. Fifth year, you have this the present value of terminal value. How much is that? 12.75676. We'll put it roughly. Is that clear? This is the present value of all your cash inflows minus 20. Now tell me how much does it come out to? No. Total of inflow is how much? 17.89 minus 20 gives you how much? How much? Minus 2 point. Okay, minus 2.11. Am I right, guys? Am I right? Yes. You guys are getting it. Now you got a positive value, you got a negative value. Am I right? So now what do you need to do? Interpolation. You can either do it logically or you can use that formula approach. You guys know that formula? Yes. So can I say IRR is equal to the lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate into higher rate minus lower rate. You can use this formula, or logically I do that arrows and I show it to you. Before this I did it like this. This sum I wanted to do it using formula. Any which ways you can do, not a problem. Interpolation, solve the same answer only. Right? So what's my lower rate? So I know clearly that my IRR is 18% plus something. It's between 18 and 19. It's going to be 18%. Plus what's my NPV at the lower rate, guys? 0.23 here. It's going to be 0.23 divided by, what's my lower rate? I mean NPV at the lower rate, 0.23 minus of minus 2.11 into 19% minus 18%. So 0.23 minus of minus becomes plus 2.11 gives you 2.34. So 0.23 divided by 2.34, you 0.0098. So it's going to be 18% plus 0.098. That's roughly about 0.1%, 0.098%. It's going to be 18.098%. Is that clear, guys? All right. And ICI finally they have rounded out to 18.10% roughly. But yes, you can retain this year also, not a problem. Is this clear, guys? Everybody, it is a hardcore IRR calculation sum in a valuation area. They have given the value and asked you to calculate the expected rate of return. Is this clear, everyone? Easy, right? This is the reason why we started off with time value of money. Are you guys getting it? Are you guys getting it? This is the reason we are doing this. Assume had I started the subject itself with time value of money, then instead of portfolio management, I should have said long ago, we studied this area. So that's why at the respective point, I'm giving you guys an introduction and background, and I'm taking it forward because this was not used anywhere in the first part of the subject. Am I right, guys? Right, first part as per me, right? This sequencing is something that I have done. In your study material, it's all jumbled and mixed up. So I just wanted to introduce you guys to the subject in a very logical manner. Okay, guys, that's about this, and we're done with this particular question. Just go and update your library of adjustments. Right on. Right on. Calculation of KE within bracket IRR. Calculation of KE within bracket IRR hyphen under single stage dividend discount model, single stage DDM and two stage DDM. Under single stage DDM and two stage DDM. Are we done with this? Yes, mark it as a DBE question. A good question. I think this is perhaps the only question that revolves around ulta, reverse working, to calculate KE, KD and all these things you have seen in your Inter, right, to calculate. But look at this. This type of question you would not have seen in your Inter. Under variable growth rate model, calculating this KE and all is something new at the final level. Is that clear? It's just they are just playing around with the concept. That's about it. So this we have finished this TYK number 6. 1 second. Now, please go to MRP number 9. MRP question number 9. Guys, if you notice, I've already told this. Here for study material questions, the background is yellow color. There it will be blue color. So just by looking at the background, you guys will be able to figure out what's the page number. MRP 9 is in 146. Huh? Okay. Yes. Shall we begin, guys? Hello? Yes, let's begin. Now, Seawell Corporation, a manufacturer of DIY, do-it-yourself, hard work and housewares, reported an earnings per share of 2.1 euros. Now, 1 second, guys. I think they have lifted this question from some maybe some ACCA or something like that. Do not worry. That's why the figures are in euros. So euros, sir, should I do INR conversion? We are not talking about a forex question. Assume this is INR only. If at all you assume INR, what will it be? Maybe assume that you are sitting in Europe and solving this question. So your home currency, we call it as home currency. In forex, we'll be seeing all that. This question has nothing to do with exchange translation and all. Assume this is rupees and solve this sum. That's about it. Is that clear? But you can't change it. Final answer, we'll put it in what? Your euros. That's about it. You guys know that this symbol is euro? Yeah? You guys are aware of that? Yes. Right? So don't worry, this is not a forex question. Don't worry about translation and all these things. Right? Conversion into INR. So, okay, so they reported an EPS of 2.1 rupees in 2013. Okay. Onwards, it paid dividend per share of how much? 0.69 rupees. The earnings are expected to grow at 15% a year from, please change this, it is a mistake in the RTP itself. This is an RTP question. It is not 14 and 18, it is one, just change this, it is 2000, it is not 2004 to 2008, it is 2014 to 18. The last dividend was 2013, right? This has to be 14 to 18. Please put 1 alone in both the places. Is that clear? Hello? Yes. So during this period, the dividend payout ratio is expected to remain unchanged. Now, after 2018, the earnings growth rate is expected to drop to a stable 6%, and the payout ratio is expected to increase to 65% of the earnings. The firm has a beta of 1.4 currently and is expected to have a beta of 1.1 after 2018. The market risk premium is 5.5% and the treasury bond rate is 6.25%. Number 1, what is the expected price of the stock at the end of 2018. Alright, they're asking for the value at the end of 2018, which means what are they asking? Terminal value. Next, what is the value of the stock using a two-stage dividend discount model? Ideally, first part they need not have asked only. Why? To calculate P0, anyways you need TV. Is that clear? But anyways, they have classified it into two. Now, I'll give you 2 minutes time. Forget about the final answer. Frame the approach, the solution, read every single line. Of course, this is without saying a DBE question. Right? Read the question carefully, digest the facts, frame the approach. Don't jump to the solution. You think that you are actually saving time. No, that's a suicide mission. Never do that. Spend time with the question. Automatically the time you spend on the solution will reduce. Online folks, pause the video now, take 2 minutes and then continue watching the lecture. Okay guys, so now first, what's the uniqueness of this question? What's something unique in this question? Can anyone tell me? Okay, payout ratio is changed. Okay, then earnings growth rate is given. Okay, very good. They are saying that the earnings are expected to grow at 15% during some initial year. Okay, and the payout ratio is expected to remain unchanged. So what? Okay, okay. Now fine. You guys have a fair idea. Now they have given current EPS is how much? 2.1. Current DPS is how much? 0.69. With this, you can calculate the current payout ratio. What is the current payout ratio? This figure divided by this figure. Am I right? And they are saying the payout ratio means what? Out of the total earnings, how much am I going to pay out? That payout ratio remains unchanged for the initial phase, 14 to 18. Am I right? 14, 15, 16, 17, 18. For the next 5 years, payout ratio remains unchanged. Then what they are saying, after 2018, what will happen? The earnings growth rate will drop to how much? 6%, which means from then on, EPS will change. They are not talking about DPS. But remember, the payout ratio is going to be 65% of earnings, which means in this question, first you need to arrive at how much is going to be your EPS for this first 5 years and the remaining period later on, constant. And then year-wise, you should be able to compute your DPS based on the existing payout ratio for 5 years and for the constant portion, 65% of my EPS. Am I right? So in this question, they have actually made you to calculate the dividend amount itself, where the growth rate on earnings is given. And guys, generally growth rate for earnings is equal to growth rate of dividend, provided there is no change in the payout ratio. But there's a change in the payout ratio. Hence, DPS wise, you need to compute. Is that clear? Right. That's all. Huh? That's all. Huh? Now, another point here. What? They are saying for the first 5 year beta is 1.4. After this, it's going to be 1.1. When beta changes, what happens? KE also changes. KE is the discount rate. So discount rate itself is changing. Is that clear? I told you, right? Discount rate can also change. KE can also change. Doubt buster I kept. I told you I will do this in detail in a separate sum, and that sum is this. Is that clear, guys? A beautiful sum. In one earlier RTP they had kept, I saw this question and I said, excellent. And I picked this up mainly because this is the kind of thought process that you need to have in exam. Don't say an attempt is difficult. They actually expect you to know all these things. It's given in an RTP. See, H model I accept. Nowhere it was given and suddenly they asked. That is wrong. But all these things we can't miss. This is actually there in your, earlier RTP. So that's the reason. Literally, guys, every single RTP I analyzed, and wherever I felt was an excellent good sum, even from older area, I've picked it up. That is the reason. And this is one beautiful sum. That's the reason we have taken this up. Now, shall we do this question, guys? Now, that is why I said frame the approach. Once you frame the approach, getting the solution is not the problem. Getting it, the approach, the thought process, the roadmap is very important. Then, yes, you can do. You have to be careful only in calculations. That's about it. Shall we get started? Guys, shall we get started? Yes, let's do this. Now, this is the MRP, 9. MRP, question number 9. Now, one second. First, let me do it. Let me do something, and then I'll give you guys a time to write down. But please participate here. I'm doing this. I mean, the template framing is very important. This is for a reason. Okay. Now, I'm just writing down working note. You can also write down working note. Calculation of EPS and DPS within bracket year wise. Shall we begin? Yes. Now guys, please, I'll do it first. I want you all to just participate, take your calculators, give me the figures. That's all I need. Year, EPS and DPS. I'm doing it exactly as per this RTP presentation. RTP presentation in this case was good, so I'm also following the same. Now 1 second. What is the current year? 2013, 2013. Am I right? Yes. 2014, 2015, 2016, 2017, 2018, 2019. Wait. Now 2013, is it a past year or an year that is yet to come? Read. Past year. Sir, then why do you need this, sir? Now in this year only they have given the EPS and DPS. Based on this you observe and arrive at the payout ratio. Now for us, these 5 are the years with a variable, the initial high growth rate. Guys, getting it? Now we calculate the terminal value as at the end of 2018. For that I need the next year's dividend, and hence I'm doing 2019. Have this roadmap clearly. So our years are only 2014 to 18. I need this previous year to observe and find out the payout ratio, and I need this next year to calculate what terminal value. Is this clear for everyone? Is this clear for everyone? You guys are getting the idea? Anyways, let's do this. No. I'll give you time to write down. Don't worry. Just participate. Now, first, 2013. What is my EPS? Okay, I'll put this, ideally it's in rupees, but we'll put it as euro because it's given in the question. Here I told you this forex has nothing to do with the question. Okay, how much was it? 2.1. How much was my DPS? 0.69. Now, what have they mentioned? For the first 5 years, my earnings are going to grow at the rate of 15%. So you can use your calculator trick for this. How will you do it? 1.15 into 2.1 is equal to, how much you get? Guys, come on. 2.415. One more is equal to 2.78. Okay, we'll put 2 decimals here. One more is equal to 3.19. One more is equal to how much? 3.67. One more is equal to 4.22. One more is equal to no. Your growth rate changes from 2019 onwards. So what's your growth rate? How much? It's 6%. So clear. 4.22 into 1.06. How much you get? 4.47. Okay, if you retain the decimals here, ideally you get 4.48. Okay, if you're retaining all the decimals. See, while presentation you are presenting 2, but in your calculator you retain the decimals, right? When you're doing it into 1.06, if you do, you get 4.48 roughly. Is this clear? Now we've got the EPS. Hello? Yes. Now we need to calculate DPS. Be careful. Now, guys, tell me what is the dividend payout ratio here? Can I say the payout ratio is 0.69 divided by 2.1? How much is it? 0.69 in 2.1. How much is it? 32.85. Don't round off and all. Keep it as such. 0.3885. I mean 328571 something. Simple. Now what should I do? This is the payout ratio. This needs to be, same figure needs to be multiplied with for the next 5 years EPS. Am I right? This figure you got, no? Put into. Then first figure 2.415 is equal to, how much you get? 0.79, right? 0.79. Yes. Next, 2.78 is equal to 0.913. Okay, we'll use 3 decimals here. The previous one was how much? 2.415 was 0.793, right? Okay, this one is 2.78 is equal to, how much you get? 0.913. Am I right, guys? Yes, then 3.19 is equal to 1.048. Then 3.67 is equal to 1.206. Yes, then 4.22 is equal to 1.387. Am I right? Stop. Next year, don't do it. Why? The payout ratio is changing. Guys, remember, this is going to be the 5 years that we are talking about. After this, growth rate changes, your payout ratio changes, everything changes. Is that clear? So now, here what will I do? Directly 4.48 into what? 65%, 0.65. How much you get? 2.912. 2.912. In a red ink only, I'm doing this. Is this clear, guys? Is everybody able to understand how this table has been arrived at? Is everybody able to understand? This is the step. Now, if you are in a hurry and get this wrong, entire question is gone for a toss. Getting it, guys? And this is not required anywhere for my present value calculation, but based on this, I calculate DP ratio. And that figure needs to be multiplied with the next 5 years earnings to arrive at my DPS for each of the years. Are you guys getting this? Are you guys getting this? How to do this? This simple piece of machine can do wonders. This is the reason I'm telling you. All these calculation tricks, you're getting it. Now you got a common number that needs to be multiplied with different number. I told you how to do that. That into multiply and you get this. Guys, getting it? Look, this is the process that we are seeing in our lectures. It is not just a question answer. Even the process, the thought process, how you can quickly get the answers, everything I'm telling you, I hope you guys are practicing it. Alright? So please do it now. Please do it. Online folks, you can pause the video now. Take a minute time and quickly do the calculations and do it. Don't just copy paste. Do the calculation by yourself. 1 minute time. Guys, one more observation here. If you notice, now here we incremented every year by 15%. Correct? Now, sir, DPS, sir, instead of arriving at the payout ratio and then doing it randomly, sir, directly, sir, on this 0.69 itself, I can apply what 15% more. Once again, here 15% more. Yes, that way also you can do, because I told you when there is no change in the dividend payout ratio, the growth rate of your EPS will be equal to the growth rate of your DPS. Mathematically, it has to be the same because there is no change in the in between payout ratio, right? So directly on this also you can increment this by what 15% every year and you can do it, not a problem. That's another way of doing, but there could be some round off issues. That's the reason why I prefer this way of doing. Arrive at the DP ratio and then you actually apply this on the respective EPS, right? Anyways, you can pause the video now and completely finish this up and then we'll continue. Now guys, we got the cash flows. Okay, can we do something, guys? Instead of mentioning this as a working note, can we put it as step 1? Can you just change it? Can you just change it? Sorry, can you just change this? Make it to step 1, calculation of EPS and DPS. Okay. Step 2, if you want, you can also put it as working note 1, working note 2, working note 3, and then final answer, part A, part B, you can write. That's your choice. Okay, there's no hard and fast rule on the presentation. Don't worry about it. Now, step 2. Now, we need to calculate KE. Am I right, guys? Write down calculation of KE within bracket, obviously using CAPM. Now write down hyphen. Now there are 2 KEs that we're going to do. What is it? Before 2018 and or up to 2018 and after 2018. Write down up to 2018 and after 2018. So clearly you're telling the examiner what you are actually doing it right now. Is that clear, guys? All these steps and all are not there in the study material. I mean, the RTP, they've just randomly done it, but we will do it in a very structured approach. Now, first, write down KE within bracket up to 2018. Now, how much is this, guys? RF plus beta times RM minus RF. You guys know what is RF? Hello? 6.25%, 6.25% plus, what's my beta, guys? 1.4 into RM minus RF, RM is 5.5. RM is not 5.5. Read the question direct. We read the question. They have directly given you market risk premium, which means RM minus RF itself is equal to 5.5%. Is that clear? How many of you missed this out and took it as RM? Be honest. No one, no? Very good. Okay. Sorry, you're not being honest. Okay. Anyways, guys, I trust you. But guys, watch out. All these things right now, you are having it, but even in exam, I want you to have it. So it's going to be into what? 5.5%. So tell me, guys, how much is your KE? Come on, tell me. 13.95. Yes, 13.95%. Next, KE within bracket after 2018. After 2018. 6.25% plus. Now the beta becomes how much? 1.10 into 5.5% figure. 12.3%. Wait. Now you guys got the key? You guys got the key? No. Now what we need to do, sir, 2 keys, sir. The discount rate itself is changing. Yes. Now guys, this is the discount rate applicable for the next 5 years. Am I right? 14 to 18. Am I right, guys? We are only going to discount these cash flows. Am I right? Now, the discount rate that I will use to discount the cash flows for the next 5 years is going to be how much? 13.75. Beyond this, whatever discounting I do, I will discount at what rate? 12.3. Or in other words, for the purpose of calculating terminal value, I will use this K. Having calculated the terminal value, that value is as at 2018 only. That I discount using this rate. Is that clear, guys? This is what you need to do in this question. Are you understanding this? So what is the terminal value formula? So the D6 divided by KE minus D. Here G is a new G, KE is also a new KE. This figure. Once you do that, you bring it to the value as at 2018. Now you can use this value. Is that clear, everyone? Excellent question. Small point. This is where students miss out. Is this clear? Look, this is hidden in one RTP long back. It can come anytime in exam. It can come anytime in exam. That's why, when we prepared this book, a lot of research went into it, because I was very clear. ICAI, to some extent, there is a pattern that you can notice. You can notice some pattern in IC. The way they test certain areas, MCQs will never be repeated, because every time they use all this AI and all. That's why we are preparing from the scratch conceptually. But the practical area, things get repeated here and there. There is a pattern, and keeping that in mind only, even from old area we have taken, it is not out of syllabus. So back then it was called SFM. So what? It is all the same only. SFM, AFM, strategic, advanced, that's all. Nothing else has changed, so everything is same only. So wherever it's actually required, we have actually brought it here. So now let's do this, guys. Step number 3. So now, once again, we'll first calculate the terminal value. They are asked, no, that is one part of the question itself. Write down. Calculation of terminal value. Yes, shall we do it, guys? Shall we do it? Write down terminal value. To put it in short, we can put it as P5. Sorry. Yes, terminal. Okay, put it as terminal value TV is equal to. Okay, guys. So from now on, I'm standing here. 1, 2, 3, 4, 5. So it's going to be D6. Am I right, guys? Yes. So put it as D6 divided by KE minus G. Am I right? Guys, am I right? Now what's my D6? You already have the figure. How much is that? 2.912 upon. Take a red ink. What's the KE you will use now? Guys, what's the KE? Post 2018 terminal value KE is 0.123. Normal ink minus growth rate. You guys know the new growth rate. What is the growth rate? 6%. Guys, getting it? So which means denominator, both the figures are changing. So existing 15% growth, now you need to take a new growth. Existing KE was 13.95, but you use the new KE right now. Is that clear? How much is this, guys? How much is it coming out to? Okay, it's going to be 46.19. Okay, euros. Okay, all these things are in euros or in rupees, whichever way you want, you can put. Retain the 2.912. Okay, it's 0.123 minus 0.06. Okay, 2.912 divided by MRC. 46.22. Now question, so that is the solution printed by ICAI. They have actually not taken this one decimal, that's all. Okay, anyways, 46.22 is correct. Getting it? That's about it. Now shall we proceed forward? Shall we proceed forward? Now write down step number 4. What is step number 4? Calculation of intrinsic value or P0. Guys, correct? Hello? Yes? Intrinsic value within bracket P0. Okay? Yes, that's what they've asked, no? Yes? Shall we do this, guys? Yes? Now can we put this dabba format now? Huh? Write down. Your cash flow. Then present value factor within bracket red ink. What percentage? 13.75 only. Why? Now even the terminal value has been brought down to year 5 value only. Am I right, guys? So which means this is the rate applicable for me. Guys, getting this, learn it conceptually. 13 point, how much percentage? 95, 95%. Right, then you get PVCF. Okay, year, don't put 1, 2, 3, put actual years. Starts from? Yes, it starts from 2014 and ends at 2018. Is that clear? Write down. So 2014, 15, 16, 17, 18 and 18. Now what are the cash flows? Plug and play. It's already there on the top. Copy paste. Not 0.69, definitely not. 0.69 is 2013, irrelevant figure. This is the figure with which you need to start. 0.793. Write down 0.793, guys. Watch out, please watch out. 0.793. Then 0.913. Yes, then 1.048. Then 1.206. Then 1.387. And now you get what? 46.22. Am I right, guys? Yes. So now take your calculators. Let's do this present value factor. 1 by 1.1395 is equal to, guys, come on. Yes, how much you get? 0.8788. Okay, 0.878. One more is equal to 0.770. One more is equal to 0.676. One more is equal to 0.593. One more is equal to 0.521 and the same 0.521. Now multiply 0.793 into 0.878 is equal to m plus 0.696. Guys, then the second figure comes out to 0.703. Okay, then third figure 1.048 into 0.676 gives you 0.708. Okay, then 1.206 into 0.593 is equal to 0.715. 1.387 into 0.521 gives you 0.723, and 46.22 into 0.521 gives you 24.081. Yes, so how much is your MRC? 27.626. Okay, 63, whatever. 27.63. So write down here. What have they asked? Intrinsic value of the stock is equal to euro 27.626 or 63, whatever it is. ICAI solution, they have given 27.58. Randomly they have taken 3 decimals in some places, 2 decimal in some places. It's marginally there's a difference. Okay, 27.58. It's 0.04 decimal difference. That's okay, accept it. Are we clear with this? Guys, are we clear with this? So remember, just like how you can have multiple growth rates, you can also have multiple KE. For the respective year, the respective KE should be used, right? In this case, for your constant growth area, post 2018 you had 1 KE, pre 2018 you had 1 KE. Yeah? Now suppose it is, we'll see later, okay, if it is going to be a 3-stage model, initial highest growth rate, then over a period it will decline, and then it becomes constant. Like this, if it happens, you can have you will have 3 growth rates, you can also have 3 KEs. Then in that case, what to do and all, like we will see later what has to be done. Is this clear, guys? Is this clear? Alright, please go and update your library of adjustments, mark this as a DBE question. Put it up. Write down. Calculation of P0 within bracket 2-stage DDM. Calculation of P0 within bracket 2-stage DDM hyphen calculation of year-wise EPS and DPS. Year-wise EPS and DPS. Year-wise EPS and DPS within bracket upon change in DP ratio, within bracket upon change in DP ratio, bracket close, semicolon, bracket close, semicolon. Calculation of KE, semicolon, CAPM. Sorry. Calculation of KE within bracket CAPM, bracket close, upon change in beta, semicolon, calculation of TV, terminal value, TV, upon change in KE and G. That is the adjustment here. Both changes. Generally G only changes, but here upon change in KE and G. If possible, KE, put it in a red box. If possible, KE alone, put it in a red box. See, whatever we have done in the solution in red, that we are also mentioning in our library of adjustment. So basically, when you look at it itself, you will know this was the adjustment. Okay, so that's about this MRP question number 9. Okay, so with this we have finished quite a few sums with 2-stage. Okay, so no problem. I will start with a 3-stage model in the next session. Okay, so I'm leaving you guys a little early today, so have fun. So fine, guys. So with this, I'm concluding this session. So please revise and practice all the sums you covered till now, and I will see you all in the next one. Thank you all so much. Bye. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now let's get started with the next concept, which is 3-stage dividend growth model. Okay, I think I'll have to turn on the projector. Just give me a minute. Okay guys, so in the previous session we saw your constant growth model. That's a normal direct application of your Gordon's formula. Then we saw a 2-stage dividend growth model. Right, just to set the context, this is done a constant growth model d1 by ke minus g, and then we also went on to see a 2-stage dividend growth model. Is that clear, guys? Right, so we said you will be having a higher growth rate and there will be a sudden drop, and from the very next year onwards it will be growing at a constant rate forever. Am I right, guys? Guys, getting it right? Now let's go on to the 3-stage dividend growth model. Now guys, in a 3-stage dividend growth model, how it works, I told you there are 3 stages. There are 3 stages. Stage 1, you have the high growth rate. Am I right? This is for an initial few years. Now under a 2-stage model, what we saw, for example, the high growth rate was 20, low growth rate, the constant growth rate was 8%. The drop of 12% happens suddenly. Right? Let's say for first 5 years, 20%. 6th year onwards, it's going to be 8%. We saw a sudden drop. This is called a 2-stage model. But in reality, growth rate, suddenly will it drop? No. It drops over a period of time. So let's say until the first 5 years, example, it was 20%. Now, eventually it will drop to what? 8%. But this 12% drop, let us say, happens over 4 years. And when I say over 4 years, this model assumes there is going to be a linear drop. When I say linear, exactly in this case 12% over 4 years, right? Guys, over 4 years by 4, exactly every person there will be a drop of 3 years. Is that clear? Linear means what? For every 1 year, by exact same amount of drop, it has to be actually falling. Is this clear, guys? It's called linearity. Sir, no sir, over 4 years only, but first year 5%, second year 2% randomly, then it will not be a line, it will be a slope. No, this model doesn't assume that. Can that be the case of slope formation? Could be, but we are reading about a model. Model comes with assumptions. Is that clear, guys? So this model says there will be what? A linear decline, not a sudden abrupt decline, a linear decline. Is that clear, guys? Which means stage 1, a high growth rate, stage 2, a decline growth phase, and stage 3 is going to be your constant growth phase. Is this clear, guys? It's a 3-stage dividend discount model. Is everybody able to understand? And once again, guys, when can you apply Gordon's formula? One of the assumptions of Gordon, only when my growth rate remains constant up to perpetuity, which means only at this point of time I can use. Is that clear, guys? Till then, what will I do? Arrive at the respective year's cash flow, discount it, and arrive at the present value of that. The moment it becomes constant, at that point of time, apply Gordon's. So once again, we are using Gordon's, but not at T0, but at a point of time from when my growth rate becomes constant up to perpetuity. Is this clear, guys? Are you guys able to understand? So we are still in Gordon's only, but different variety of Gordon. All these are called, I told you, variable growth rate model. Double stage or 3-stage and all, these are different types of variable growth rate model. Is everybody able to understand this? Perfect. That's about the context here. That's about the concept here. Now, shall we go and do a numerical problem? Yes, shall we go and do a numerical problem? Now, guys, in your study material, they have just mentioned what is it without graph also. Just like that, they have mentioned and left it. Question was also not there. So we will be doing one MRP question. But in exam, they are asking all these things. Okay, so please take MRP question number 15. It's on page number 152. Please take MRP question number 15. Quick. Shall we, guys? Shall we get started? Yes, let's do this. Now, mark this as a DBE question. There is no question from the study material, but definitely they can ask you. Look at this. Your November 20 attempt, May 19 attempt and all. This is actually a very common model, and most importantly, guys, this is the basis on which the next chapter is actually built. Business valuation is completely based on all these models only. Variable growth rate model, 2-stage or 3-stage as the case may be. Is that clear, guys? Shall we begin? Yes. Now read the question carefully. An investor is considering to purchase the equity shares of LX Limited, whose current market price is going to be 112. The company is proposing a dividend of how much? 4 rupees for the next year. Which means 4 is T1 directly. Be careful. LX Limited is expected to grow at the rate of 20% per annum for the next 4 years. The growth will decline. What word they've used here? The growth will decline linearly, which means abruptly it is not going to decline, linearly to how much? 16% to 16% per annum after the first 4 years. Thereafter, it will stabilize at 16% per annum infinitely. The investor requires a return of 20% per annum. What is 20%? It is K, the discount rate. Right? Okay. You are required to, number 1, calculate the intrinsic value of the share, which is P0. And number 2, whether it is worth to purchase the share at this price. What will you do? Actual market price is given. Compare this with actual and say whether it is under or overvalued and take a decision based on that. A very good sum. Now, sir, what is the big deal, sir? Now I explained the concept of your 3-stage model and now I am doing it. Now You will say, sir, 3 states, sir, what is the big deal? Assume you are sitting in the exam hall and in between multiple sum, this question is coming. How many growth rates are given in this question? Look at it and answer. How many growth rates are given? How many growth rate? Only 2 growth rates are given. What and what? 20 and 16. Immediately what will you do? 4 years, sir, 20. Then afterwards 16. This is not 2 stage, 3 stage. What differentiates? One word. Linear. Is that clear? Now I explain and I'm telling you it's fine. All of a sudden in an exam, I'm preparing you for the exam right now. Right? In the exam, this one word makes all the difference between a 2 stage and a 3 stage model. Number 2, linearly, it declines. Sir, over a period of how many years is not given? Guys, the decline phase has to be over a period of time, no? How many years? Have they given it? Hello? Have they given it? No. How will you do it? How will you do it? Now, guys, now, in this case, you tell me, the high growth rate is how much? 20%. What is the low growth or stable growth rate? How much is it? 16%. What is the difference? 4%. Now they have given linearly. Hence we will say over a period of 4 years. Am I right? Sir, is it an assumption? Wait, there is an indirect hint given in the question. What is that hint? The period is given. So but period is 7 only. Wait. Once we do, you will get the answer to all these things. This is how you need to read the question. I am just explaining the process here. Right? So which means we will say that it declines by 4% over a period of 4 years, which means every year it's going to decline by 1%. Guys, all these things are not explained anywhere. By observation, you need to know. So which means for the first 4 years, the growth rate will be 20%. 5th year growth rate will be 19%. 6th year, 18. 7th year, 17. 8th year, 16. 9th year, 16. 10th year, 16. Which means from 8th year it crystallizes. Which means the terminal value should be computed at the end of 7th year. Is that clear? That's why 7-year data is given. Are you getting this? Are you getting this? This is how you need to read the question. One word can make the difference, and how do you take all these? It's not an assumption. Hints are hidden in the question. Is this clear, everyone? Right, sir? It declines over 4 years, sir. No doubt. No doubt. 20, so becomes 19, 18, 17. From the 4th year, from then onwards, 16, 16, 16, 16, which means you stop at the 7th year and say from the 8th year onwards till perpetuity, it becomes what? 16%. Hence, terminal value should be computed at the end of 7th year. Is this clear? Is everybody able to understand? Guys, for that purpose, terminal value at the end of 7th year requires D8. Right? The dividend at the dividend of the next year. For that purpose, we will compute D8 also. But not for discounting it. Is that clear, guys? Everybody able to understand? This is why I said, out of all the models, the most challenging is 3-stage model. Number 1, it requires the art of identifying that it's a 3-stage model. Number 2, having said that, you should know the years of decline. And number 3, when to compute terminal value. Many students do it at the end of 8th year. No. 8th year itself is happening at a stable growth, which means you should stop at 7th year. Is that clear, guys? This is the catch. This is the catch, which means in this diagram, I will calculate the terminal value at this year. Why? From this year onwards, it's going to be what? It is going to be a what? It is going to be a constant growth. Hence, the terminal value stops here. I compute it here. Is everybody able to understand? Guys, getting this? This is how you need to read this particular area. All this explanation is not given anywhere in the study, but some itself they have not given. I've picked it from the past exam only. They're asking it in exam. It's not my own question also. Is that clear, guys? Right? So watch out. This is a very important area. Many students struggle here. That's why I explained the concept and directly we are seeing one numerical problem. Now shall we do this? Now shall we do this? Guys, that's why I'm saying if you spend more time on the question, lesser will be the time you spend on the solution. Without reading quickly, 2 growth rate is only given. That's all. One word make the difference, guys. One word made the difference. All right, getting it? Let's do this question. An excellent question. MRP question number 15, right? Okay. Write down. MRP question number 15. Okay. Now, okay, we'll draw a rough diagram here. Okay, this is just for your understanding. This diagram is not required in the exam. Okay, this is just for your understanding. It gives you a very good clarity. Okay, shall we do this? Okay, so now for the first how many years? 5 now? 4. Yes, for the first 4 years, yes, it's going to grow at the rate of 20%. Okay, then there is a decline. Okay, over the next 4 years, and from then onwards it's going to be what? It's going to be at the rate of 16%. Okay, so I'm just doing, okay, here I will put this as, okay, so here is going to be my growth rate G, so it's going to be 20%. The constant area is going to be 16%. Am I right, guys? Now here it's going to be what? It's going to decline by 4%. Decline by 4% linearly. Linearly. So there's going to be a linear decline of 4%. Means what? Exactly, the decline over this 4 years will be equal every year. Only then it's called as a linear decline. Is that clear, guys? Everybody able to understand this? Right? And I can put this as years. So here it's going to be what? Okay, year 1, 2, 3, and 4. Correct? Guys, getting it? Right? Then what happens over the next 4 years? So 5, 6, 7, and 8. So at the 8th year, actually, final drop happens, and then it continues to be 16%, so on. So then it goes on till infinity. Am I right, guys? This is how it works. Guys, everybody able to understand this? So whatever was given in the question, we have actually understood, interpreted, and put it in a diagram format. Is everybody able to get this? Right. Now, shall we frame the cash flow equation first, and then we'll put it in a Dabba format. Shall we frame the cash flow equation? Come on, everyone. Tell me, guys. Tell and write. P0 is equal to, yes, D1 divided by 1 plus KE to the power 1 plus, tell and write, D2 divided by 1 plus KE to the power 2 plus D3 divided by 1 plus KE to the power 3 plus D4 divided by 1 plus KE to the power 4 plus, continue, D5 divided by 1 plus KE to the power 5 plus D6 divided by 1 plus KE to the power 6 plus D7 divided by 1 plus KE to the power 7. Now, 1 second. So, first 4 years over, 5th year, 6th year, 7th year. Now, we have done till this. From 8th year and onwards, I am actually seeing that the growth rate is going to be constant. Hence, at the end of 7th year, I will apply Gordon's formula to calculate what? Terminal value. Is this clear? Have this logic, have this concept. Is that clear? Hence, write down here, red ink. Okay, so plus red ink, terminal value divided by fully red ink divided by 1 plus KE to the power 7 only. Is that clear? The entire thing is in red ink. This red ink is not for terminal value. It's for calculating terminal value at the end of 7th year. Don't do it at 8th year. Is that clear, everyone? Yes. Guys, getting this? Is everybody able to understand? Right. Now, here you come down and write once again the same red ink only. Terminal value is equal to formula. Now you put it as D8 divided by KE minus G. Here, what is the G? The constant growth rate. Right? So whatever was the 16 now. Is that clear, guys? Everybody able to understand? Is everybody able to understand? And one more thing, guys, this is just for your reference. So 5th year, no? 5th, 6th, 7th, and 8th anyways is 16%. 5th year, what is the growth rate? 20 minus 1 becomes 19. Right? 6th year is going to be 18. 7th year is going to be 17. And from the 8th year onwards, it's going to become 16. Is everybody able to understand? Now, why do we need this? Respective year dividend. You need to calculate based on this growth rate only. Guys, getting it? For that purpose, we need it. Is everybody able to understand? Right? So with this, can we just go and prepare what? The statement? Can we do this? Yes, come on, let's do this. Write down. Write down. Year. Cash flow. Give some bigger space. Then present value factor within bracket at what percentage, guys? What percentage? 20 percentage. KE percentage. Am I right? Yes, then write down PVCF, present value cash flows. Shall we get started? Shall we get started? Now we have, okay, we'll write down the years. What are the years? 1, 2, 3, 4, 5, 6, 7, 7. Right? 7 twice because of the terminal value. Is that clear? Next, what are the cash flows? What are the cash flows? Now, one second, guys. First, let's write this also. D1, D2, D3, D4, D5, D6, D7, and terminal value. Now, can we do it? Now, can we do it? Now. Guys, what is D1? Directly 4. Why? Next year dividend given in the question. Very good. 4. Now, D2 is going to be 4 into 1.2. Am I right, guys? Yes, how much is it? 4.8. Am I right, guys? Now, D3, can I say it's 4.8 into 1 more 1.2? Guys, or you can say 4.2 into 1.2 to the power 2. That way also you can say. But can I say it is previous year into that year's growth rate? This is a better way of doing for this sum. Why? Because suddenly it declines and all. Guys, getting it? So previous year growth rate into what? 1 plus that year's growth rate. In this case, it is 1.0. How much is the figure? 5.76. Year 4, 5.76 into 4th year growth rate. Look at the graph on the above. We are still in the first 4 years. 1.2. How much is that? 6.91. Now, 5th year, 6.91 into. Now, take a reading. Now, guys, what is the 5th year's growth rate? 19 percentage. So the previous year into this year's growth rate. So please take a reading and do it. 1.19. Huh? Am I right, guys? So how much does it come out to? How much? 8.22. Right? Now 8.22 into, once again reading, 60 years growth rate is 1.18. Am I right, guys? Linear fall. How much is that? 9.70. Next, 9.70 into how much? 1.17. Reading. How much is it? 11.35. Am I right, guys? Yes. Are we done here? Now, terminal value we will compute. Come down, and say terminal value is equal to, the formula is already written on the top, D8 and all. What is D8? 11.35 D7 into how much? 1.16. Am I right? Divided by, what is my KE? 0.20 minus what's my growth rate? 0.16. So how much is this? 13.17 divided by 0.04. Huh? Figure, come on, tell me. How much? 329.25. Put it up here. It's 329.25. Is that clear? If you want here terminal value, you can put a star, come down and put a star here. Is this clear, guys? Guys, be very clear with the calculations. Be very, very clear with the calculations. Why we are stopping at 7th year every year? Why we are doing all these things linearly? Here, if you see, it's declining. Every year growth rate is changing and all. Conceptually be strong. Then no one can take away the subject from you. Right, guys? That's about it. Now it's just a matter of your calculation. Come on. Take your calculators. Of course, no need to take your calculators. It's all given. Use the same figures given in the question. PVCF, quick. 0.833, 0.694, 0.579, 0.482. Yes, 0.402, 0.335, 0.279 and 0.279. Is that clear? Now, guys, PVCF, help me out with the figures. How much is that? Please tell me the figure and put it in M plus. How much is the first figure? 3. 332, second figure. 3.331, third next figure. 3.335, next. 3.332, next. 3.304, then 3.249, okay. Then I'm trusting you guys with the figures, so please tell me. Final answer, we have it here. But come on, then 3.167, then correct, huh? Guys, is everybody getting these figures? Do your own calculation, please. Don't binge watch. Do your calculations. Yes. How much? 91.861 MRC total. 114.91 now. Yes, perfect. Yes, then it's correct. The answer is correct. Okay, guys, getting this, everyone? And that's about it. That's about it. Guys, tell me, was this difficult? No. Have the right approach. Have the right approach. In study material, I don't know for what reason, they have just mixed up multiple things, important concepts, they have not given examples and all. That's why we are literally doing everything, right, in a very graded manner. This structuring took me a lot of time, because when I opened the study material, it was haphazard. So the structuring, both in our concept book as well as in the classroom discussion, the structuring took a lot of time, because look at this, randomly we are taking one question from MRP, and there is no illustration. First of all, in this chapter, there is zero illustration, only TYK. So in the institute study materials, TYK also they have not given any sums, so that's the reason why we are doing it in a very structured approach. Okay, guys, are we done here? Right? So write down here, write down, come down and write. That's about it. Number one, what have they asked? Intrinsic value. Write down intrinsic value is equal to rupees 114.91. That's about it. Done. Next, number two, what have they asked? Whether it's worth to purchase a share. Now tell me, guys. Worth Varma. Okay, so what is it? The actual price was 112. Here was the price, intrinsic value 114. So the correct value, this stock is actually worth 114. But in the market, it's quoting at 112. Over or undervalued? It is undervalued. Is it undervalued? It is undervalued, right? Yes, it's undervalued. Hence, yes, you can go ahead and buy it. So write down. Since the actual price, or write down, since the CMP, current market price, since the current market price within bracket 112 is less than the intrinsic value, comma, the share is undervalued and hence can be bought. The share is undervalued and hence can be bought. The share is undervalued and hence can be bought. Is that clear? Is that clear? Now, this is exactly what ICA has also done. But they have also given one more line. However, other factors need to be taken into consideration since the difference is only slightly higher. This is true, guys. Now, just because a share is undervalued, you can't say, I've spotted a good share. No, it doesn't work that way. This is one of the parameters. Is that clear? Right? It's not the only parameters. Why? Why is the stock price less? Let's say the intrinsic value is 120. Current market price is only 100. 20 rupees difference. Now, are investors, are they idiots? No. For some reason, maybe something else could be there. Immediately don't say, good stock, let me go and buy. No, it doesn't work that way. There could be other parameters. Was there a change in the management? Is this MD, did he resign? Some systematic risk areas, right? That's where you open up. It is not as simple as saying, go buy, go sell. Other factors remaining constant, yes, I'll say yes, you can go buy. But in reality, this is not the only factor. Is that clear, guys? Is everybody able to understand? Guys, getting it? Now, that's about this question. Just one small thing I wanted to tell you, which we'll be doing later on. Now, guys, when you are analyzing a stock, right? I want to buy the stock. When you want to, you do some analysis, right? Before you're buying or selling or whatever it is, before you participate in the market, you do some analysis. Hello? Yes. There are two types of analysis. Stock analysis. There are two types of analysis. One is called as fundamental analysis. The other one is called as technical analysis. What are they? Fundamental analysis, technical analysis. Fundamental analysis is something that is done by long-term investors. Technical analysis is something that is done by short-term, basically traders. Is that clear? Now, one second. I'm just opening this up for you. We will be seeing more about this in a chapter called security analysis, right? There will be seeing, but I'm just opening this up for you. What do you mean by fundamental analysis? Literally, whatever we are doing right now is called as fundamental analysis, calculating the intrinsic value, the correct price, and apart from that, knowing more about the company. Right? I'm a long-term investor. I want to stay with the company and I want my money to grow as the company grows. Short-term investors, they are not bothered about the growth of the company and all. Am I right, guys? Quick money. So I am a long-term investor. Before I put my money, I want to grow along with the company. So I will see certain parameters. Now in the previous session also I was telling promoter holdings, how much is their skin in the game? How much are they actually investing? Right? What is their outlook on this particular company? Right? And this company is in what industry? Is this industry going to boom? There are so many parameters. And is the stock price correctly valued? Right? Using intrinsic value, Gordon's model and other things. This is called as fundamental analysis. You are analyzing the fundamentals. Fundamentals, when I say the valuation, right? The balance sheet, P&L, you look at it. What is the profitability? Year-wise, how much is it growing? You read the financials. I will, in a practical session, I will clearly show you how I pick a stock, right? Of course, once again, I'm telling you, quantitative parameters are only to some extent. Qualitative parameters, which cannot be explained, are much more, right? So when something happens, the global markets or something happens in the market in general, now what will be its impact? This kind of vision you will have only when you are actually investing in the markets, right? But the fundamental analysis part, I will be taking a separate session and I will be telling you guys how to actually do it. I'll open screener and I'll show you. Is that clear? Now, moving on to technical analysis. Now, you are a short-term trader, intraday, maximum in actually traders, there are multiple types of traders. Okay, for those who do not know, I mean, yes, chances are you might not know this. Intraday, square off within the same day. Now, if I take delivery, it doesn't mean I'm an investor, right? Generally, more than a year, if I hold, that's called as an investor, but investors generally have a long-term outlook. That's why they say indefinite period. We calculate Gordons and all, right? So, in trading, we have something called as swing trading, positional trading and all. So, actually, I did a swing trading course, and that's what, I mean, one chunk of my portfolio, about less than 5% of my portfolio, I've kept it just for swing trading. Swing trading is not some, random intraday. Intraday is pure play speculation. I don't get into that generally. At times, just for knowledge purpose, I do it, but that is not, I'm not dependent for that for money. No, I don't try to get returns out of it because somewhere I feel ethically it's not correct, because it means if you're making profit, it's clearly the cost of someone else. Someone is making an equal loss. So generally, I don't do that, but intraday, little bit I do just so that I'm keeping myself aware of what's happening around, right? But positional trading, swing trading, generally the tenure is about 2 to 3 weeks, right? You hold it. Now, guys, you tell me in this case, am I going to travel along with the company? No. I just spot an opportunity and I say, okay, if the company, my prediction is the stock will go up in the next 1 week or 2 weeks, then I will go buy it. If I feel it's going to go down, I will sell it. If I don't have it, short selling. Is that clear? Now, for me to predict the movement, that is, it's going to go up or go down, do I need to read about the fundamentals, whether the promoter is traveling along the company? No. I will not even calculate the intrinsic value. I'm not bothered about that. Then, sir, how do you do? There's something called 100-day moving average. Have you guys have heard of this? 50-day moving average. I calculate the moving average of the price, of the stock. All these calculations, EMA, there's something called exponential moving average, arithmetic moving average. All these are a part of your syllabus. In security analysis, we'll be seeing. Or there's something called trading signals in the market, right? Support and resistance level. All these are a part of your syllabus, guys. Stock security analysis will be doing that. Candlesticks, guys know candlesticks, right? These are patterns indicating that this is how the stock will go. It might go up, it might go down. I am more bothered about the technicals. Technicals means the signals in the market, not about the fundamentals. Is that clear? Is that clear? So there's something, when you actually, when during my swing trading program, I told you guys that I have actually done the swing trading program with Bombay Trading School. Okay, that they used to teach. There are multiple signals that you see, something called as bullish harami. There's certain, I mean, there are a lot of words that these guys use. There's something called Dawes theory. It's all based on that. Basically, guys, what happens is you just want to know the moment. Forget about anything else. Even if the stock is overpriced, I'm not bothered. Will it go up or will it go down? That's all I'm bothered about. Is that clear? Now, how do you actually do this? Simple. It all revolves around psychology of money, because on the other side, there will be another guy trading. Now, what will be his outlook? What will be my outlook? Or what will be the outlook of this particular instrument of all the traders in the market? That is what is going to make the stock go up or down, at least in a temporary phase. In a long run, it all offsets. One up and one down will get offset. So I'm not bothered about the temporary movement if I'm a fundamentalist, if I'm a long-term investor. But if I'm a short-term trader, if I want to make some quick bucks, now I need to know what is the, the trend that's going around in the market. Am I right, guys? Am I right? So here, I'm not bothered about the fundamentals. I read the signals. I'm bothered about the technicals. Now, the concept of technical analysis, hence, it's about what is the outlook of the people, the traders in the market. Hence, the concept of technical analysis can be applied on any instrument that gets traded on the internet. So the concept of technical analysis, I can apply it on Bitcoin. I can apply it on anything you name, anything that is getting traded, I can do. Derivatives, yes. Whereas fundamental analysis, no. For equity instruments, the fundamental valuations are different. For debt instruments, they are different. So are you guys getting an idea? Are you guys getting an idea here? So this is how actually, this is what differentiates between your fundamental analysis and technical analysis. And guys, about 90 or 95 or 99% of the syllabus revolves around fundamental analysis only. Even in CFA, significant portion of syllabus revolves only around fundamentals of the company. Technical analysis is very limited. That's why in a theory chapter, you have something called security analysis. There we'll be seeing technical analysis, some EMA, AMA, there's something called support and resistance level. Some small concepts are only there. Beyond that, the entire finance revolves around what? Fundamental analysis. This is why you see valuations. This is more about the people's outlook on the market. To make some quick bucks, generally this is not the focus of any financial management course that you take. Is that clear? I am just setting this context right here because this is very much a part of your syllabus. Remember this when we are doing security analysis area. Are we clear on this? Are we clear on this? So whatever we are learning here is ideally called as what? Fundamental analysis. We are calculating the true intrinsic value of the company. Is everyone able to understand? Right. So please go and update your library of adjustments. Write down. Calculation of intrinsic value hyphen 3-stage DDM. Calculation of intrinsic value hyphen 3-stage DDM. Calculation of intrinsic value hyphen 3-stage DDM, semicolon red ink, identifying the years of decline. Identifying the years of decline. That's all. Identifying the years of decline. So you had to identify. That is the biggest art of this particular question. Are we done here? Guys, are we done? Okay, great, perfect. So now, let's move on to the next numerical problem. Please take question number MRP 26. MRP 26. So on page number 161. Shall we? Guys, shall we do this? Yes, shall we do this? Yes, let's do the sum. An investor is considering purchasing equity shares of Alpha Limited, whose current market price is 172.45. Okay. Now the company is proposing a dividend for rupees 6 for the year ending 31st of March 2024. And Alpha Limited is expected to grow at the rate of 20% per annum for the next 4 years. Thereafter, the growth over the next 3 years will decline linearly by 100 basis points per annum. 1 second. What do you mean by basis points? You guys are aware? 100 basis points. No, 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 no. Simple, guys. 100 basis points means 1%. Okay. Now, you guys must have read this in headline. RBI cuts the repo rate by 10 basis points. 10 basis points means 0.10%. So they always call this as basis point. Basis point is 1/100th of 1%. Basically, you can say 100 basis points will make 1%. Is that clear? So now in this case, what they are saying, it will decline linearly by 100 basis points means what? 1% per annum. Over, okay, per annum is given, which means over the next 3 years, which means 20 for 4 years. Then it becomes what? Then it becomes 19, 18, 17. Is that clear? This is what they have given. Thereafter, it will stabilize at, what have they given? Certain growth rate per annum infinitely. What is the constant growth? Has it been given? Have they given? No. Next, they have not given. That is the question. Okay, you need to calculate. The required rate of return of the investor is 20%. What is 20%? KE is given the discount rate. The dividend value is to be taken in only in 2 decimals. Okay, you are required to. Yes. Calculate the stable growth rate of Alpha Limited after the end of 7 years. Number 2, to advise whether it's worth to purchase a share at this price if an investor has a stable target growth rate of 15% per annum. We'll do the second part later. First part. What is asked in this question? How do you do it? Now, guys, I'll give you 2 minutes time. Okay, online folks, pause the video now. Don't jump to the solution. First, read the question. Now, plot this in your mind. If possible, put a rough graph and all and see what is being asked. How is this different from the previous question? Right? Differentiate. I will not do any repetitive questions. So how is this different from the previous question? By the way, a past examination question, May 23. Literally, guys, every attempt I analyzed and based on that only I'm doing in the classroom. Whichever is really a never miss. Once again, guys, you can put this as a DBE question. Right? Now online folks, pause the video now. Take 2 minutes, read the question, digest the facts, and then continue watching the lecture. Okay, guys, so now what needs to be done? What needs to be done in this question? In this question, what have they asked? What do you need to calculate? Intrinsic value. Huh? You need to calculate intrinsic value? No. They are asking you to calculate what? The constant growth rate, that is the third growth rate. High growth rate, decline is also given. Stable, how much is what we need to calculate? Am I right? Now, if everything is given, right, you can calculate intrinsic value. Now in this question, everything is not given. They are asking you for the final, this growth rate they are asking you. Am I right? Now which means intrinsic value should be given in the question. Hello? Yes. Now is the intrinsic value given in the question? They have given the current market price is 172.45. In the absence of information, assume that the market is quoting at the intrinsic value. Is that clear? That's the only way to do this sum. It's a missing figure. It's a missing figure question. You can't say, no sir, you need to calculate intrinsic value and also growth rate. How can you do that? Intrinsic value is calculated using all the growth rates. If all the growth rates are not given, then intrinsic value should be given. If intrinsic value is not given, assume that the intrinsic value is equal to current market price. Is that clear? This should be the thought process. Are you getting this? Perfect. Now that you know this is the intrinsic value, I don't want the answer. Tell me the approach to calculate the constant growth. How will you do that? Huh? Now P0 is equal to, can I say, the present value of the dividend for 7 years, the first 7 years, respective years dividend you can calculate, plus the present value of terminal value. Hello? Correct. Now these figures you will be able to get it. Hello? Correct. This figure is also available. And in this figure, the only missing figure is your G. And with this, you can find out. Is everybody able to understand? Yes or no? Guys, getting it? Anyways, we will be doing it. And then you will get a complete clarity. Shall we do this question? Have the approach, guys. That's the reason I'm doing this question also. The previous question and this question might seem exactly the same. But there is a hidden adjustment. Here they are asking you to calculate the final G. There everything was given. They asked you to calculate intrinsic value. Is this clear, guys? Let's do this question. Write down MRP question number 26. No, you can't assume. You can't assume that 17. How will 17 be constant? Then it has to be 16. How will it be 17? No, it will be 16. Then 17, from then onwards it will become constant. Huh? Think 3 years you can't take it like that. Ma, from the next year only, from the 8th year only it becomes constant. Fine, once we do you will understand. Okay, MRP question number 26. Huh? Yes. Okay. Shall we begin, guys? Shall we begin? Yes, let's do this question. Now, write down here, just write down P0 is equal to, now guys, they have given first 4 years it will be at 20%, thereafter for the next 3 years it will decline, which means 7 years you are actually getting this decline phase, and from the 8th year onwards it becomes constant, which means the terminal value is also at the end of 7th year, just like how we did the previous sum. Exactly. Guys, getting it? Now, here guys, can I say P0, that is the intrinsic value, is equal to, which means for first 7 years, every year we should ideally calculate the dividend. So can I say present value of 7 years dividend? Am I right, guys? Yes. Plus present value of terminal value. Agreeing with me on this? Guys, agreeing with me on this? That's all, no? Similar to what we've done till now. Guys, getting it? Now, with this, can we calculate? Can we put the dabba? And can we say how much is going to be every year's dividend? Guys, and we can also calculate what? We can also calculate the present value factor, arrive at the present value of the first 7 years dividend. Am I right? And P0 is also given. And terminal value, we can write, terminal value is what? D8 divided by KE minus G. D8 is nothing but D7 into 1 plus G. D7 we would have got. G alone is a missing figure. Here also G alone is a missing figure. And KE is a figure that we get, which means we can frame this equation and arrive at G as a missing figure. Is everybody able to understand? Let's do this question right now. Straight away, put a dabba. Here. Write down dividend. No need cash flow. Dividend itself you write down. Leave a bigger space. Then present value factor. How much percent? 20%. I think it's given in the question. Yes, 20%. Great. And then you can write present value of dividend. Is that clear? So here terminal value we are not putting. Terminal value separately we will calculate based on the requirements of this question. What are the years, guys? 1, 2, 3, 4, 5, 6 and 7. That's all. No one more 7 because terminal value cannot be calculated. That is a missing figure. Now, dividend D1, how much is it? How much? 6. Sure? Yes. How can it be 6? Yes. Very good. They are clearly mentioning that the company is proposing a dividend of 6 rupees for the year ending 31st March 2024. Ending, which means it's not ended. So the year is still yet to come. Are you guys getting it? Which means this itself is the first year. Excellent observation. If you haven't written it, please put it in a reading. 6. Next one. Year 2 is going to be 6 into 1.20. How much? 7.2. Year 3, 7.2 into 1.20. How much is it? 8.64. Next, 4th year, 8.64 into 1.20. How much is it? 10.37. Now, be careful. 5th year, 10.37 into 19%, so which means 1.19. Am I right, guys? 1 plus the growth rate applicable for the 5th year is only 19%. It declines by linearly by 1%. How much is it? 12.34. Very good. 12.34 into 1.18. How much is that? 14.56. And 14.56 into 1.17. How much is that? 17.04. Is this clear, everyone? Anyone has any problem here? No. Now let's go on to this PV factor. No need to calculate, copy paste. Suddenly in this question they have used 4 decimals. Write it, that's all. Whatever they've given, just accept. 0.8333, then 0.6944, 0.5787, 0.4823, 0.4019, yes, 0.3349 and 0.2791. Correct? Yes, can you help me out with the figures? 4.99, 4.99, let's round it out to 5. Let's round out to 5. Again you get 5. Again you get 5. Again you get 5. Why? Guys, no magic here. Numerator is multiplied by 1.2. Correct? Growth rate is 1.2. No? Denominator is also divided every year by extra 1.2. In this case, G is equal to KE. Hence, numerator and denominator gets knocked off. That's why. Okay, else if you calculate also, you'll get the same. Is that clear? But look at this. The moment the growth rate changes, numerator is increasing by 1.19. Denominator still increases by 1.20. Hence, it will not be 555. Are you guys getting it? Anyways, guys, just do it. Right? So tell me, how much is this? 4.96. Then? 4.88. Correct, no? Yes, then 4.76, I suppose. Correct? The respective dividend to PVCF, I mean present value factor, how much? 4.76. Always, as a thumb rule, line gap total. If you made a mistake, you have to insert some space, it needs to be given. How much is it? 34.5, okay, 60. 34.5 and 34.60. Is that clear? Guys, rounding off here and there, if you have something, nothing to worry, don't worry about it. Are we clear with this? Yes. So the present value of dividends is how much? 34.60. Next, guys, next. Now, guys, present value of terminal value is equal to, now first terminal value, can I say, is nothing but 4.76 D7 into 1 plus G. I don't know, I need to calculate this G. Am I right? Guys, everyone, when am I calculating this terminal value? At the end of 7th year. So Gordon's model says next year's dividend, that is this 4.76 into 1 plus G divided by KE minus G. How much is KE? 0.20 minus how much is G? That's what we need to calculate. Is this clear? What happened, ma? Any issue? You're getting it? Huh? Hey, I'm sorry, guys. I'm sorry. I took a present value. I'm so sorry. It's okay. No problem. I mean, when I'm prone to make mistakes, so it's good that you pointed out. Yes, it's 17.04. Oh, I took present value of dividend. I'm sorry. Yes, it has to be 17.04. I stand corrected. Is that clear, guys? Is that clear? So now it is going to be what? D7 into 1 plus G divided by KE minus D. This is the terminal value as at the end of 7th year. So which means I need to bring it to present value. Am I right, guys? Hello? So can I say into 0.2791? Guys, this is the present value factor, no? Hello? This is the terminal value at the end of 7th year. Into this figure, I bring it to present value. Am I right? Is everybody able to understand? Is everybody able to understand? Is there any issue here? No. So this is the present value of terminal value. Guys, getting it? Now you can frame the equation. Now, what is the intrinsic value? Come on. What is the intrinsic value given in the question? How much? Can I say 172.45 is equal to present value of first 7-year dividend? How much is it? 34.60 plus present value of terminal value, this entire figure. Am I right? Write down plus 17.04 into 1 plus G upon 0.2 minus G into 0.2791. Is this clear? Now you need to solve for G value and you're good to go. So it's 172.45 minus 34.6 gives you 137.85. Correct? Is equal to 17.04 into 1 plus G upon 0.2 minus G into 0.2791. Okay, by 0.2791 you get some figure. Okay, by 7. Okay. Okay, let's solve for this. So guys, this and this will go on to the denominator. Am I right? Correct, huh? This and this can go to the denominator. Am I right here? Cross multiplication. Guys, just normal solving only. So if you do that, you can say, so 137.85 divided by 17.04 divided by 0.2791. How much you get? You're getting 28.98. Is anyone getting the same? In study material, they have not given all these calculations directly. By solving this, you get G value, is what they have given. Guys, solve it now. You guys know how to solve this? Guys, I remember doing this in 4th standard. Okay, let's do it, guys. Come on. Okay, so I'm just putting it here. It's 28.985 is equal to 1 plus G upon 0.2 minus G. Please solve for this. Okay, I'll do it like this. So this has to be 0.2 is equal to, so you get 5.797 minus 28.985 G is equal to 1 plus G. Okay, and this goes to the other side. This comes back here. It's going to be 4.797 is equal to, so it's 29.985 G. So 1 second. Just tell me what is the G value that you guys get. You get 16%? You get 16%? Yes, that's the correct answer. 1 second, I'll just put it here. Divided by 29.985. If you do, yes, 15.99. You ideally get 16% roughly. Guys, is everyone getting it? Is everyone getting it? So what I did here was, look, this equation was there, right? Now what I did, this and this are in full numbers, right? I took this to the denominator. So 137.85 divided by 17.04, and once again you say divided by 0.2791. If you do, you get this number. This is equal to, what is left over? 1 plus D divided by 0.2 minus D. Now you cross multiply this. This is what you will get. And you can take this to the other side. So 28 point something. So minus becomes plus here. You add 1G here. So it becomes 29.985. So is equal to 5.7 something minus 1 becomes 4.7. If you actually solve for G value, 4.797 divided by 29.985, you get what? G is equal to 16%. Is everyone getting this? Guys, is everybody getting this, right? So G is equal to 16%. Is that clear? Now by observation itself, you could have answered. By observation itself, you could have answered, no? Look at the question here. What are they saying? What are they saying? So it's 20% is a high growth rate. Am I right? Hello? And then they are saying it reduces by how much? It reduces by 1 basis point. So 1%, 100 basis point, 1% every year. Am I? Over the next 3 years. So obviously from the next year onwards it's going to become constant, right? So which means 1% only it can fall. So from 17 it can further fall to 16 only. So by observation itself you can say, but if this is an MCQ question you answer like that. But if it is a full-fledged descriptive problem, then you'll have to solve it fully. This is how you need to solve. Is that clear, guys? So I'm telling this trick also so that if it's an MCQ question, don't break your head, directly do it. Is that clear? Are you guys getting it? And madam, you understood now why it is not 17, it is 16, because it becomes constant from the next year onwards. One more 1% fall is due. That's the reason. Is everybody able to get this, guys? Right? And then the next part of the question, what do they say? Next part of the question, what are they saying, guys? Hello? To advise whether it is worth to purchase the share at this price if the investor has a stable target growth rate of 15%. The investor is expecting that after the 7 years, from the 8th year onwards, it is only going to grow by 15%. But actually it is growing by how much? 16%. Am I right, guys? Guys, getting it? Now, which means the actual growth is much better than his expected growth. Hence, you can go ahead and buy. Am I right, guys? Yes, if it's going to grow at a much better pace, it's going to be beneficial for whom? the shareholder only. Is that clear, guys? Is everybody able to understand? So please write on part 2 of the question, or you also write as yes, you can just put 0.2 here. So you can put this as 0.1, G is equal to 16%, 0.2, write down. Since the actual growth rate is more than the target growth rate, since the actual growth rate is more than the target growth rate, comma, it is worth it to purchase the share. It is worth it to purchase the share. Right? Guys, done? It is worth it to purchase the share. That's about it. Vattu Varma. That's all. Okay? Done, guys. So let's go and update our library of adjustments. Write down. Write down. Write down. So what was the previous library of adjustment I dictated? Okay. Write down. Calculation of constant G. Calculation of constant G. G stands for growth rate. Constant G within bracket reverse working. Within bracket reverse working. Bracket close hyphen. Bracket close hyphen. 3-stage DDM. 3-stage DDM. Three-stage DDM. Are we done with this? Are we done with this? Hello? Yes, guys? Fine. So with this, we have also completed the 3-stage dividend discount model. So guys, that's about your constant growth rate, 2-stage dividend discount or 2-stage growth rate model, and even 3-stage dividend growth rate model. Now guys, we will go to the talk of the nation, which is your H model. Okay? H model. This is also called as declining growth rate model. Why is it called declining growth rate model? I told you what a H model is. Anyways, we'll be doing it. Now guys, in case of H model, there is one formula given in your study material. Trust me, promise, only this much is given in your study material. Now, why this became a sensation after the May 26 exam? It's not fair on the part of ICAI. First of all, they had just mentioned H model. Some 2-3 sentences they had given, or maybe one paragraph. They gave this formula. Now look at this formula. P0, what is P0? Intrinsic value. So this formula also talks about valuing the intrinsic, valuing the correct price of the share is equal to D0 into 1 plus Gn divided by R minus D. R stands for, R is your discount rate, KE. Okay, that also they didn't put KE, they mentioned only R. R minus Gn plus D0 into H1. This is looking like that virus name and all they give, H1N1 flu. So like that it is given. Into Gc minus Gn divided by R minus Gn. That's all. If you get this formula, any question you can do. Now they had tested one question on H model. First of all, many students didn't know there was something called H model. Fairly so, because it was there in one corner of the study material, but there was not even a single numerical problem regarding this. So if at least institute gives one TYK question or an illustration, then people, or even in RTP had they given it, then students will know, okay, so this is a practical area. Nothing was given, and directly this landed in an exam. That's where the problem arises. Now guys, don't worry. This is very logical. I will prove this to you. And this H is there here, no? They've used some H, and hence the name H model. What is it and all? I will I will explain it clearly. Once again, no mugging up. Everything is logical, absolutely logical, and we will do it. Shall we get started, guys? Shall we get started? Now, first of all, now we have seen constant growth model, guys. Direct Gordon model. Next, the 2-stage DDM, sudden fall. 3-stage DDM, linear fall. Now coming to H model. Now, what is H model saying? From today onwards, the decline starts. Unlike 3-stage, where for the next few years you can enjoy the high growth rate, and after that the decline begins. H model says you are already past the high growth stage. Now you are starting at a point where your high growth is over. From today onwards, you are starting with this decline phase. Is that clear? Which means H model ideally is nothing but a 3-stage DDM, but starting after the high growth rate period. Is this clear, everyone? Is this clear, everyone? Right. Now, in this case, what they are saying, ideally speaking, guys, here also there is only 2 growth rates, right? But you can't say it's a two-stage DDM, because 2-stage DDM, there is no decline and all. High, low, that's all. Whereas here, you have what? A declining phase followed by a constant phase. First of all, is everybody able to understand what this H model says? Is everybody able to understand? Now, sir, they have given one big formula to calculate P0. Right? They have given one big formula to calculate P0. First of all, you tell me, only using that formula, can you calculate? No. Year-wise, if you have the dividend, from year onwards, you use Gordon's formula. Am I right, guys? Just like how you do for 3-stage, here, you don't have this initial phase. That's all, no? So, with this itself, you can do, yes, you can apply. But what if the data given in the question is such that you have to do only with the formula? So first we will understand what this formula says, and then we will do one numerical problem. May 26 exam question itself we will do, and we will knock it off. Are we clear with this? Shall we begin, guys? Yes. Now, guys, I have just presented this in a pictorial format. Do not worry, I will give you some time to write down later. Just focus right now. Online folks, you can also focus right now, and then I will give you some time. You can pause the video, then you can write down all this diagram and all. I humbly request you to focus. If you miss this, you will not get it. Okay, I'll give you some time, boss. I'll give you some time to write down. Do not worry. Okay, because if you miss this part, then it's gone. That's all. Okay, and guys, it doesn't have any impact on the subsequent areas. It's a standalone area. Okay, let's quickly knock it off. Not a great issue. Now, I told you, what is this concept of H model? You start from what? A linear decline phase followed by a constant growth phase. Am I right, guys? Am I right, guys? Yes. Now we need to calculate P0. That is the intrinsic value of the share, where dividends I'm going to receive is what? On a linear phase followed by a constant phase. Is this context clear? Perfect. Now, guys, visualize this. Now, guys, from here onwards, it is going to be constant. Am I right, guys? Let us say after 6 years, and I'm telling you, over a period of 6 years. Okay, let us say that the highest growth rate was 20%. The constant growth rate is going to be 8%. This is the example we take normally. And let us say it is going to initially decline linearly over a period of 6 years. What is the total decline? 12%. It is going to decline over a period of how many years? 6 years, which means every year it falls by 2%. Is that clear? Is the example clear? I'm giving an example. Is this clear? Now, this is how it is going to be. The shape, the graph, is everyone clear? Is everyone clear with this? Yes. Now, guys, this is going to be your constant growth. Am I right? Now, with a pencil, I just drew this even for the initial years, right? Now, guys, can I say this area, the shaded region area, had this only been there, it is nothing but a direct Gordon model application today itself. Constant growth up to perpetuity. Am I right? But on top of the normal Gordon's model, we also have one triangle on the top. Am I right? If you add the two, you will get the value, intrinsic value as per the H model. Am I right or not? Am I right or not? So basically, can I say it is this area plus the area of the triangle? If you add this, you will arrive at P0 under H model. Is everyone clear with this? Is everyone clear with this? Now, what will I do? First, this value, you guys know, that is sum of growing cash flow at a constant rate up to perpetuity. What is the formula for that? T1 divided by KE minus G. Now, instead of D1, can I call it as D0 into 1 plus, I will put it as GS. Why GS? The stable growth rate. Right? Because there are two growth rates here. I should know which G I am referring to. Am I right, guys? Divided by KE minus GS. Am I right, guys? Am I right, guys? That is the first part of this H model formula. Is that clear? It is the area of the bottom rectangle that runs up to perpetuity. That is already given by Mr. Gordon. Is that clear, everyone? Any issues, any problem till now? No. And here I am carefully using what? The stable growth. Right? D0 into 1 plus GS upon KE minus G. Is everybody able to understand this? Right. Next. Now I need to calculate what? The area of the triangle sitting on the top. If I calculate the area of this, I can simply add this to this and I will arrive at what? P0 under H model. Is everybody getting this? Now, you guys tell me, in your school days you would have studied the area of a triangle. What is the formula? I'm not kidding, I'm seriously asking. It's based on that only. Huh? Half into base into height. You guys know that? Yes. Now, this is nothing but half into, what is the base? Now, base, can I say, is the years of decline? Can I say is the years of decline? That is nothing but how long it is going to actually decline over a period of 6 years. Guys, 6 into what is the height here of this triangle? 12. The difference between the high growth rate and the stable growth rate. Hello? So can I say here it's going to be what? 20% minus 8%. Am I right, guys? Am I right? Is everybody clear with this? Any issues, any problem till now? No. Now, this half into base is there, no? Half into base. This is called as H1. In this model, they call it as what? H1. So H1, can I say, is nothing but half of the period for which the decline happens. Ideally, that's nothing but the midpoint. Guys, getting it? It is nothing but your simple mathematics. Your triangle area formula is being used here. One hype they are giving, that's all, with some fancy terminologies. Is that clear? So what is H1? Simple, the year of decline, the period is there, no? Guys, getting it? The years divided by 2, half into base. Is that clear? That I call it as H1 into what is this 20 minus 8? Can I say this is GH minus GS, the high growth rate, minus what? The stable growth rate. Guys, getting it? Is this fair enough? Is this fair enough? Logical? You need not mug up, guys. My commitment to you, don't mug up anything. It's not even a sin, it's a crime. Now, you guys logically think and tell me, what are we trying to calculate? P0, value, intrinsic value. Now, here if I actually apply this directly, what will I get? Here it's 6 by 2 is what? 3 into this 20 minus 8. How much is it? 12%. You will get the answer only in percentage, or ideally this is nothing but it represents growth rate. If you want a value, obviously to this you should multiply with D0. That is the base dividend. Am I right, guys? Hence, this needs to be multiplied with the D0. Are you getting this? Are you getting this? Is everybody able to understand? If you do this, you will arrive at the value of the area of this triangle. Not in percentage, it will be in value because D0 is multiplied. And that is what they have given here. D0 into H1 into the high growth rate minus stable growth rate. Is everybody able to understand? Is everybody able to understand? Guys, getting this? Guys, getting this? Now, the final touch here. This is the amount that you receive initially itself. Now, this amount that you received initially, now recall, I told you our entire subject is based on the assumption of reinvestment. I told you reinvestment assumption. Once you receive a cash flow, you can't go happily spend it. For you to get that actual return, you need to reinvest at the ongoing rate. Am I right, guys? Now, this triangle area value that you get will be reinvested up to perpetuity. Am I right, guys? This will be reinvested up to perpetuity. That is the assumption. I don't know for how long I'm going to hold this. So this gets reinvested up to perpetuity. Hence, in the denominator, you will use Gordon's model right now. You will say divided by KE minus what? The stable growth rate, because now onwards up to perpetuity the rate that you have, the growth rate that you have is only what? Your stable growth rate. Is everyone able to understand? And hence the formula. What is the formula? Now you tell me first this formula. You guys only tell me. This formula, this normal Gordon's model. Can you tell me? Now don't say D1. D0 into 1 plus the stable growth rate divided by KE minus the stable growth, right? Plus. Now on the top, half into base into height, but first on this I need to multiply with the D0 to get the value. D0 into, now half into base. The base is nothing but what? Your years. That is called as what? H1 into height. What is height? The high growth rate minus stable growth rate. If you do this, you will get the area of the triangle. But the present value of it invested up to perpetuity. Hence, I use KE minus the stable growth rate. Ideally, the denominator is same only here. If you want, you can put this entire thing and give one common denominator as KE minus DS. But generally, ICI does this. Now you go to this and tell me, is this a difficult formula, guys? That's all the formula is proved. Are you guys getting this? Are you guys getting this? This is not a difficult formula, guys. It's all very easy. But one small thing, I used GH and GS, high growth rate, stable. ICI has used a different, instead of, see, they have used N is the normal growth rate, long run. So long run, hence you have used N, stable growth rate, right? And C is what? Your current growth rate, initially, whatever was the highest growth rate. Now, sir, can I use in exam the high growth rate H and your stable growth rate? Yes, you can use. Just write this, where GH stands for the current growth rate or the high growth rate. SGS stands for the stable growth rate. You can write it. Now tell me what's the formula here. So D0 into 1 plus your stable growth rate. Don't say G and GS and all. It's stable growth rate divided by KE minus the stable growth rate plus D0 into H1. What is H1? The years of decline by 2. Half into base. That's all. Triangle formula into height. This is nothing but, guys, if you forget this also, this is nothing but half into base into height. Multiply it with D0. That's all. So here, what is the differential growth rate? GH, high growth rate, minus the constant growth rate, stable growth rate, right? You get the value, but this amount gets reinvested up to perpetuity. Hence, use Gordon here, divided by KE minus D. Sum of infinite cash flows. So divided by KE minus D. Simple, isn't it? Simple. Guys, that's all it is. So it is not difficult at all. It is not difficult at all. Looking at this formula, don't get worried. This is all it is. Now, as promised, I'll give you some time to write down. See, that's all. We finished the explanation here very quickly. Beyond this, there's nothing there to explain. Okay, guys, come on. You can just go and maybe write this down. I'll give you about 3 to 4 minutes time. So please do it. Online folks, you can pause the video now. First, you take down this diagram. Once you're done, you can play it again, and I'll scroll it down. And once again, you can pause and write it down. So do it, guys. Okay, guys, I've scrolled it down a bit. You can now, once again, you can pause the video and write this down. Okay, guys, so now let's move on. Let's do one numerical problem in this particular area. Shall we begin? Yes, guys, let's do this. Everybody understood, right? Hello? Everyone understood? Boss, Attamainda? Correct only, no? Okay. I'm learning a little bit of Telugu, but okay. Correct me if I'm wrong. Okay, guys, so now just go to question number 45, MRP. MRP 45, and of course, put it under DBE. Yes. The only question in ICI publication landed directly in your May 26 attempt. Yes, put it under DBE, guys. Not because of its complexity and all, because it's the only sum in this model. That's about it. Shall we do this? Yes, let's get started. Guys, read the question carefully and let's do it. Okay, now XYZ Limited recently paid a dividend of 40 rupees. Now, the company is entering a 5-year transition phase where its current 15% growth rate will decline linearly to a stable perpetual rate. Is that clear? Which means 15% is the high growth rate. Okay, next. Financial parameters, transition period 5 years, declining linearly from year 1. Okay, so what is your the base? What is your base? Guys, number of years. So basically it is going to be 5. So H will be what? 5 by 2. Am I right, guys? 2.5. Is that clear? H1. They mentioned it as H1. Is that clear? That's the name of the model. For some reason they have done it. Next. Current data of ROE is 20% and a retention ratio is 25%. What is this, guys? Huh? G is equal to B into R. Correct? Now what is B? Retention ratio 0.25. What is R? What is R? 20%. Am I right? Now what's your growth rate as per this? 5%. But they have given 15% as the growth rate. Getting it? Guys, the growth rate is given as 15%. And they have clearly mentioned, look at this. Terminal data is given. This is current data. Terminal data means after, from 6th year onwards, ROE is going to be what? 12%. Retention ratio is going to become how much? 50%. Am I right, guys? Which means the stable growth rate, you can calculate using this. Guys, how much is it? 6%. Current growth rate is how much? Guys, 15%. Hello, it's given or not? Am I right, guys? It's given as 15%. Now, current growth rate is 15. Stable growth rate is 6. Now, why have they given the current data here? It is a mistake in the question. No, it is not decline. What decline? 15 is the topmost. And from going forward, stable growth rate is 6. The difference between the two declines linearly. That's all. Now, why do you need another current data? How can they say this is the B and R? If you compute G is equal to BR, you're getting 5% on the current data. But current growth rate is only 15%. This is a mistake. Having given this sum, this itself was a first mistake. In that mistake, committing another mistake is not acceptable. This is a mistake in the question. So, had you just put the question number in the exam, you would have got grace marks. Yes. Yes. You know what happened? May 26 attempt. One student scored 99. That student said, sir, not to me. Online it became some North Indian student. It became a sensation. Why? Sir, Dena Mayamo Mandramo, I don't know, sir. I wrote only for 60 marks. So I got 99, sir. So much grace mark, I don't know. But this was a mistake in the question. If they are giving this question, at least they could have been careful. But anyways, whatever it is. It's a mistake. Don't worry about it. It's a mistake in the question. Okay. So now the market data, required rate of return. What is that? KE, 13%. Now the current market price is given as 850, which means the actual price. You calculate P0, compare it. Now you are required to, number 1, estimate the intrinsic value per share using H model. Is that clear? Fine. This is number 1. Number 2, given the current market price of 850 rupees per share, assess whether the stock is undervalued or overvalued and calculate the percentage deviation from intrinsic value. Percentage deviation means what? By how much it is, less or more. Don't say standard deviation. That's not what they are meaning. Deviation means change. That's all. Is that clear? Easy sum. Am I right? Provided you know what H model says, what is the formula and all these things. This is a data which is a mistake given in the question. Not required. They should not have given it. Is that clear, guys? Shall we do the sum? Shall we do the sum? Yes. Write down. MRP number 45. Yep. Shall we get started? Yes. So first, guys, write on the formula. Write on the formula. Write down. Write on part 1. Part 1. Intrinsic value of share as per H model. As per H model. Write down. Write down. P0 is equal to, everyone tell and write. Tell and write. T0 into 1 plus G. We use H, right? Okay, let's use the same terminology which they have used. They call it as N. N means long run growth rate. All right. So into what is this, 1 plus gn, am I right? Okay, divided by ke, here we use ke, minus gn, am I right? Is that clear? So n is basically that, we use c, right? We use c here, the constant growth rate. That is the meaning of this. Is that clear? Now sir, can I write c? Yes, in exam you can write c. Below we will write what each and every line item stands for. Is that clear, guys? That's about it. Plus, now you guys tell me, t0 h1, you know what is h1, into, yes, gc minus gn. C stands for current growth rate, right? We use h, right? High growth rate we used. Is that clear? Divided by the same, ke minus gn. Is that clear? That's about it. Is everybody able to understand? Simple, right, guys? Nothing needs to be mugged up here. Now you guys tell me first, what is d0? Write it down. Ingredients 40. gn, n stands for what? The constant growth. How much is it? 1 second, guys. Write down. This is equal to, G is equal to B into R. Am I right? What is B? Retention ratio 0.5. Guys, 0.5, right? Into R is what? 12%. How much is this? 6%. Is everybody able to understand? Guys, any issue here? No. The other one, what is it? GC. C is the current growth rate, high growth rate. Now write down 15% within bracket given. Forget the data that they have given. That is a wrong data. Don't use it. Is that clear, guys? Yes. Next, we need to calculate H1. H1 is equal to half into what? That base. What is the base? Number of year over which the fall happens. What is that? 5. How much is it? 2.5. Is that clear, everyone? That's all, no? Now, KE. Okay, KE. How much is KE? 13%. Yes, 13% within bracket given. Now solve. P0 is equal to 40 into 1.06 divided by, what's my KE? 0.13 minus 0.06. Am I right? Plus 40 into, what's H1? 2.5 into, within bracket, 15%, right? So 0.15 minus 0.06. Am I right, guys? So from 15 to 6, the fall is 9%. It happens linearly over a period of 5 years. Am I right? The whole divided by same, 0.13 minus 0.06. So tell me how much plus how much. The first part is 40 into 1.06 divided by, how much is this? 7%, right? 0.07. Going to be 605.71. So 605.71 plus, what is this figure? 40 into 2.5 into, it's going to be 9%. 0.09. That's 9. Divided by 0.07 gives you 128.57. Am I right, guys? Guys, this is not 1.15, 1.06. Just the growth rate. 0.15, 0.06. Is that clear? Right, half into base into height, that formula. How much is it? Rupees 734.28. That's about it. That's about it. Is that clear? That's all. The sum is over. That's all. The much hyped H model is very, very simple. Are we done? Now let's go on to part 2. What is part 2? Under or over valuation, right? So write down part 2. Part 2. Write down, guys, what is the current market price? CMP is equal to rupees 850. What is the intrinsic value? Write it fully in exam. IV. Intrinsic value rupees 734.28. You tell me, as per your calculation, as per our calculation, the true value of the stock is only 734.28, but it's actually quoting at 850. Over or undervalued? It is overvalued. So will you buy or sell? You will only sell it. Is that clear? So now write down. Have they asked anything? Assess whether it is under or overvalued. Write down. Write down. That's all. Don't give a recommendation on buy or sell. Just say whether it's under or overvalued. Write down. Since the current market price is greater than IV, so CMP greater than IV, the share is overvalued. The share is overvalued. The share is overvalued. Is that clear? Yes, they have not stopped there. They are asking you to calculate percentage deviation. Means by how much percentage is the increase or decrease. So write down percentage deviation. Percentage deviation from intrinsic value. From intrinsic value. Can I say, guys, this is nothing but 850 minus 734.28 divided by 734.28. How much is this? 15.76 percentage. Am I right, guys? Yes. From the intrinsic value, keeping that as the base, right? By how much is the market price overvalued? We are computing. Is that clear, guys? Is everybody able to understand? Any issues, any problem here? So we can say that the current market price is 15.76% more than the intrinsic value of the share. Am I right? Yes. Now there's another way of saying this. See, they have asked for deviation. You can also say it is going to be 734.28 minus 850 divided by 850. So here you are keeping the current market price as the base and you are saying how much percentage is my intrinsic value less as compared to the current market price. Is that clear? The percentage will change in that case. Are you all able to understand? There has to be one base. From that only you can do it. So ICAI has done both. They have done both. In my opinion, what was the question? Deviation from intrinsic value. Keep that as a base. Right? That's my way of looking at it. And of course, that is even fair enough. That's correct. Is that clear? So you can only write this and leave it here. You need not do both. Are you guys getting it? Right? So this indicates that my current market price is 15.76% more than my intrinsic value. And that's about this question. Please go and update your library of adjustments. Write down. Write down, write down, write down. Quick, quick, quick. Write down. TBE question. Write down. So the previous questions, what did I say? Intrinsic value. As per 3 stage. What did I say? Calculation of P0 I said. I use the word intrinsic value only. So write down calculation of intrinsic value under H model. Under H model. Under H model, semicolon, under slash overvaluation. Under slash overvaluation. Right, guys? Fine. Okay, we'll take a break now. Fine, guys. So with this, I'm concluding this session. Please revise and practice all the sums you covered till now, and I will see you all in the next one. Thank you all so much. Bye-bye. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj. So now, let's continue our discussion in this chapter, equity valuation. So guys, till now, we have completed all the dividend based models. Am I right, guys? We have finished the zero growth model, basically constant dividend up to perpetuity. Am I right? Then we have seen this constant growth model. So it's not constant dividend, growth rate is constant, right? Which means direct Gordon's formula. Then we've seen variable growth rate model. In this variable growth rate, we saw 2-stage, 3-stage, and I told you H model is ideally a part of growth rate, variable growth rate model. But still, since students missed this out because it was in one corner of the study material, I've put this at the initial section overview area itself. Is that clear, guys? But ideally, there are only 3 models here, and we have seen so many numerical problems covering every single concept till now. Clear with this, guys? Right? Now we will see this alternative share valuation models. There are certain other models which you can use to value the share, which means P0. To calculate the intrinsic value, there are also certain other models. We will be seeing this right now. Okay, and it's a very good way to actually shift from dividend based to alternate, and then we will come to this cash flow based models. This is very important. In fact, your business valuation, the next chapter is predominantly based only on these 2 models. FCFF and FCFE, free cash flow to the firm and free cash flow to equity. What it is, we'll see later. But before that, first we will do this alternative models, and ideally guys, all these alternative models are also something which you would have covered at your intermediate level. But anyways guys, to set the context right, we'll be doing it, we'll be starting it from the scratch, and we'll be doing every single thing. Is that clear? So under the alternative models, what are we calculating right now? To calculate the intrinsic value. That's what we are doing. We are in valuation of equity area, right? So here, one model is called as earnings growth. Then you have something called as PE. Then you have an yield approach and Walters model. Does it ring any bell? You guys have seen this? Where dividend decisions at your CA intermediate level, you have something called as a Walters model. You guys remember that? Right? So we'll be doing that right now, and a numerical problem. And guys, earnings growth, nothing exactly same as this dividend growth model, but here what do you discount? Dividend. Here instead of DPS you use EPS, and that's about it. The model is over. Is that clear? Why? Earnings fully belongs to equity shareholders, whereas here under the dividend based models, what do? We are arriving at the price of the share based on the dividend declared. Guys, getting it? Now dividend is a discretionary thing. Now top companies, right, like Alphabet, that is Google, or even Microsoft, they don't declare dividend that frequently because they feel with this money we can manage it much better than giving it to you today, and we will manage this money and make sure that there is a growth in your stock price. That way you can actually earn more. Is that clear? So now if I don't pay any dividend based on the dividend discount model, you will start saying that the share price will be zero because dividend itself is zero. I mean, it is absurd, right? Hence, instead of taking dividend as the cash flow to discount, you take your earnings itself and apply the same Gordon's model. Is that clear? So once again, here also you can have zero growth, constant growth, variable growth, under variable growth, 2-stage, 3-stage, H model, everything you can have, only with one difference. Instead of DPS, dividend per share, you use EPS as the base to do calculation. That's all. This model is over. Is that clear, guys? Right? Now, we will first see Walters model. We'll first see Walters model. There is a guy called Walter. He has given his, his model. He has given his formula to calculate P0. Ideally, a part of your CA intermediate in a chapter called dividend decisions. It will be there. We'll first see this. There is one numerical problem, a very good model, in fact a sensible model. But once again guys, remember, whenever I say model, it comes with assumptions. So you should know what the assumptions are based on which the model has been created. Is that clear? Shall we get started? Yes, let's do this. Please take this alternative share valuation models. A lot of interesting stuff here. So let's do this quickly. Yes. Yes, alternative share valuation models. Under that, please go to Walters model. Please go to Walters model. Yes, so what is Walters model? Walter has given his formula. Right? So what is the formula he has given? He has given a formula to calculate what? Price of the share, which means he has given a formula to calculate P0 only. Am I right, guys? He says P0 is equal to D plus E minus D into R by KE, the whole divided by KE. This is the formula he has given. You guys know the logic for this formula? Yes, sir. Very good. How many of you know the logic for this formula? Okay, 1, 2. Okay. Fine, guys. Ideally, at the intermediate level, this entire derivation and everything I would have done. But anyways, guys, let me do this here. But, this once again, in fact, the first question in your study material is about your Gordon and Walters model. So, TYK question number 1 deals with that. But anyways, guys, I'll be doing it right now. And there is another way in which you can write. I don't like this way of writing the formula. I will tell you how to write it. And I will also explain the logic and derivation. Quickly, we will do that. It will take some 10 minutes time, and then we will do it, and we will do some numerical problem and wind up. That's about wind up this concept. Okay, right? Wind up na kalami beda poringa. Okay, clear? Fine, guys. Now, first of all, you need to know what Mr. Walter says. Okay, guys, please catch up running notes. Walters model, ideally guys, a part of your intermediate level. Nothing new that we are going to learn here as compared to your intermediate. But anyways, now The formula is P0 is equal to D by KE plus R into E minus D by KE square. I would actually prefer to write this formula in this way. D by KE plus R into E minus D by KE square, where D stands for dividend per share, E stands for EPS, earnings per share, KE stands for the investor's expectation of return. Right, guys? Yes. And what does R stands for? G is equal to B into R. R. Return on equity. Return on equity, or the return on investment. Basically, return on investment or return on equity. It could be anything. The amount the company is able to, the return the company is able to generate by using your funds. Sustainable growth rate. Guys, you guys remember? Right? So here, using the retained earnings, the company plows it back into the business. Hello? Yes. And the rate of return that they are able to generate. The return on equity, basically. Is that clear, guys? Now, this is the formula. Now, if you look at this, basically, can I say D by KE? Hello? That's what I've separately mentioned. Plus, instead of putting this R at the back, I put it here. I said R into E minus D divided by KE. And once again, the whole divided by KE was there, right? So I said divided by KE square. Is that clear, guys? So I have just rewritten this formula in this way. This is a very, very good way to actually write this formula. Logic, I will tell you. Is that clear? Now, before going to the logic, what are the assumptions under Walter model? Based on what assumption Walter has developed this model? Sir, always will this assumption hold good? No. If the assumption hold good, only then you can use Walter formula. Is that clear? Alright. Now, the first assumption that this guy says is your EPS and DPS remains constant. What does he say? Your EPS and DPS remains constant, which means you are not going to have any growth rate. There is going to be zero growth. There is no growth here. It is going to be constant up to perpetuity. Is that clear? Of course, we are assuming we're talking about a company's share valuation. So obviously, going concern assumption, perpetuity. Is this clear, guys? Right. Number 2, R and KE will also be constant. R is what? Return on equity. The company is going to generate return on whatever is the amount that is getting invested. KE is what? The expectation of return of your equity shareholders. Is everybody able to understand? Guys, everybody able to understand this? And this model assumes that is also not going to change year-wise. Is everybody able to get this? Right? And of course, the most important assumption, life of the company is perpetual. These are the 3 assumptions based on which Walter has developed his model. Clear with this, guys? Now, shall we see what this model says? Now, guys, now, example, I'm telling you. Let us say the EPS is 10 rupees. Okay? Now, out of this, DPS, the dividend per share, is 2 rupees. Let's say the retained earnings per share is balance 8 rupees. Correct? Now, you guys tell me, as per the Gordon's dividend discount model, to value the share price, we consider only 2 rupees. Based on that, we actually do the valuation of security. Am I right? Valuation of the equity share, guys. Correct? Yes. Now, as per this model, as per this assumptions of Walter, now here we are saying the dividend amount, earning amount, both are going to be constant. Is there a growth? No. Which means, now, if you are using the dividend discount model, what will be the formula to calculate the share price? Annual dividend divided by discount rate, annual cash flow divided by discount rate. Am I right? So can I say it is going to be D divided by KE? Am I right, guys? Because here the cash flows are going to be constant, not growth rate. Cash flow itself is going to be constant. Am I right, guys? That is the first part of the formula. Is that clear? D divided by K, which is nothing but annual cash flow divided by discount rate. Is everybody able to understand? Now, Walter says, how can you just consider the dividend? What belongs to the equity shareholder is not just dividend. They also enjoy ownership over retained earnings. Am I right? Don't stop here. don't stop here. He says, now you should also consider retained earnings. Am I right or wrong? Right? This is what Walter says. Is that clear? So he says, also consider this retained earnings. So which means I should also consider the present value of retained earnings. Am I right, guys? Am I right, guys? Now, how do we do that? It is not a direct calculation, but there is something hidden inside it. What is what I'm going to explain right now to derive this formula. We will take about 5 to 10 minutes time. I'll derive this logically, pure hardcore time value of money concept. With this, we will understand and we will do one numerical problem, and with that, we'll be done with this concept. Shall we do it, guys? Ideally, this is a part of your intermediate. Once again, I'm telling you, but since I promised you guys, I'll set the background for everyone. We will do this. Shall we, guys? Yes. Now, the first part of the formula is already derived. Am I right, guys? That is nothing but constant cash flow up to perpetuity. So, D divided by KE, annual cash flow divided by the discount rate. Am I right, guys? Yes. Now, I am focused on the second part of this formula. I'm going to derive this. How did you get this? R into E minus D by KE square is what we're going to do right now. Shall we get started, guys? Okay. Now, guys, let us say at the end of first year, I had a retained earnings amount. Okay. That retained earning amount was how much? The retained earning amount will be E minus D. Am I right, guys? Earnings minus dividend paid out. This is the amount of retained earnings. Am I right? Which year? Year 1. Am I right, guys? Now, this amount was retained at the end of year 1. Guys, everyone please answer back. Now, what will the company do with this amount? With this, they will reinvest starting from the second year onwards. Every year on this amount retained, they will be able to generate a return that is equal to R. So which means, what is the return generated on this retained earnings from year 2 onwards? Can I say R into E minus D? Am I right, guys? This is the return earned in amount on the retained earnings. Am I right? In our example, it was 8 rupees. Right? Let us say, for example, R was 0.2. So 0.2 into 8, every year they are going to earn 1.6 till perpetuity. Am I right, guys? Every year, so in year 2 also, using the first year's retained earnings, they will earn what? R into E minus D. In year 4, once again, R into E minus D. Am I right, guys? Up to perpetuity. Is that clear for everyone? Is that clear for everyone? Now, please remember. What am I talking about? The first year's retained earnings alone I'm talking about. The first year's retained earning will start to generate return from the second year till perpetuity. Agreeing with me? I am not even getting into the second year's retained earning. I'm still with the first year's retained earnings. So then for second year, third year, what have we done? The return generated on the first year's retained earning alone I'm talking about. Is that clear, everyone? Is that clear, everyone? Guys, everybody clear with this? Right? Now I should arrive at the present value of the returns generated on the first year's retained earnings. Am I right? Hello? How will I do that? I need to add all these things. Hello? Guys, correct or not? You please tell me. Yes? So can I say present value of returns earned on year 1 retained earnings? Can I say is nothing but R into E minus D. Now this is, when will I start earning the return? Second year onwards. Bring it to present value. Can I say into 1 plus KE to the power 2 plus R into E minus D divided by 1 plus KE to the power 3. Guys, this was the return earned on my first year's retained earning in second year. I need to bring this to present value. Similarly, in the third year, I earned a return on the first year's retained earnings. I need to bring it to present value, but since this was earned in the third year, I'm bringing it now to present value. Guys, getting it, everybody? Right? I am just talking about the first year's retained earning. The return generation starts from year 2 and grows till perpetuity. Are you clear with this? Are you understanding the context? Yes. So plus similarly R into E minus D divided by 1 plus KE to the power 4, and it goes on till perpetuity. Are you all able to understand? Guys, are you all able to understand? Any issues, any problem here? Now, how will I arrive? How will I add all these cash flows? Once again, you can see if this is a geometric progression series. Hello? Now, how will you do? You divide two adjacent numbers, look for a common ratio. If the common ratio is same, then you can use sum of infinite geometric progression series a by 1 minus r. Hello? Yes, correct. Guys are getting it. You guys are getting it. So now, can I calculate and see if I'm getting a common ratio? Guys, common ratio, obviously you will get. Now the second number divided by first number. Can I do it, guys? So it's going to be r into e minus d divided by 1 plus ke to the power 3. The whole divided by r into e minus d divided by 1 plus ke to the power 2. This and this gets knocked off. This 2 and this 1 comes in here. Basically, I get what? 1 divided by 1 plus ke. Am I right, guys? Now you do, if you want, you do third and second. Once again, you'll get the same figure. Basically, this and this gets knocked off. Only one figure you have here. Guys, getting it? Getting it? So obviously, can we accept this as the common ratio? Guys, getting it? So now, can I use that a divided by 1 minus r formula? So a by 1 minus r if I use, what is a? The first number, this figure. Am I right, guys? What is that? R into e minus d divided by 1 plus ke to the power 2. The whole divided by 1 minus, what is r? 1 by 1 plus ke. Is everybody getting this? Guys, is everybody getting this? Yes, any issues, any problem here? Now can we solve this? So you get r into e minus d divided by 1 plus ke to the power 2. The whole by, you need to take an LCM, right? This goes up. Hello? Becomes 1 plus ke minus 1. The whole by 1 plus ke. Am I right, guys? Hello? You guys are getting this? So now this and this gets knocked off. Am I right, guys? This and this gets knocked off. Hello? So basically, what are you left with? What's there in the numerator? R into e minus d divided by, so you have 1 plus ke and once again divided by, so this and this gets knocked off, ke. So can I put it like this? Divided by ke into 1 plus ke. Guys, this anyways, the numerator in the denominator becomes the denominator. Am I right, guys? Hello? You guys know this, right? So can I say this is the present value of what? The returns generated out of the first year retained earnings alone. Similarly, in the second year, I will have a retained earning. That will start generating return from third year till infinity. Similarly, third year I can have a retained earning. That will start generating return from fourth year till infinity. Right now, I only calculated the first number. What is it? The present value of returns earned on year one retained earnings. Am I right? Guys, getting this? This is not the final answer. This is just a starting point. Guys, getting this? Is everybody able to understand? Now, similarly, guys, in year two, once again I will have, how much is the retained earnings? E minus D. Am I right, guys? Now remember, as per this model, E will be constant, D will also be constant, no growth and all. Is that clear? This is year 2's figure. So this amount will start generating return starting from year 3. Year 3, what will be the return on this? R into E minus D. Year 4, it's going to be R into E minus D. And this goes on till perpetuity. Am I right, guys? Guys, are we clear on this? Is everybody able to understand? Is everybody able to understand? Guys, are you all clear with this? Right? So now, once again, so now you tell me, this is year 2. Now I have to calculate the present value of returns earned on year 2's retained earnings. Am I right, guys? Yes. So can I say the present value of return earned on year 2 retained earnings? Now, how will you calculate this? Guys, quickly, can you frame the cash flow equation? Tell me, guys, how will you do this? R into E minus D. This is the amount of return on year 2's retained earnings, but this you will earn only when? Year 3. So bring it into present value. How much you get? 1 plus KE to the power 3. Am I right? Similarly, plus R into E minus D divided by 1 plus KE to the power 4 plus R into E minus D divided by 1 plus KE to the power 5, and it goes on till infinity. This is what? The second year's retained earnings, the return on the second year's retained earnings, sum total of the returns earned on the second year's retained earnings starting from third year till perpetuity. Is that clear? Is that clear? Guys, getting it? Are you clear with this? Are you clear with this? So once again, if you notice here, you can actually, you'll get this geometric progression series only. If you divide the second with first, once again, you'll get a common ratio. Guys, getting the common ratio will only be this 1 by 1 plus KE. Is that clear, guys? Is that clear? And if you use this A divided by 1 minus R formula here, the sum of, that is the present value of the retained earnings, right? The return on the retained earnings of the second year's retained earnings. Basically, if you do this, you'll get basically, now what we got here, you'll get something similar, R into E minus D divided by KE into 1 plus KE to the power 2 you will get. Guys, if you apply the same formula, here it started off from year 2, right? If you do this, you will get what? You will get R into E minus D divided by KE into 1 plus KE. If you are doing this for the second year's return, you will actually get what? Everything is the same, but R into E minus D divided by KE into 1 plus KE to the power 2. If you want, I will do this and show. No problem. So what is A by, so A by 1 minus R. What is A, guys, here? This figure, am I right? R into E minus D divided by 1 plus KE to the power 3 divided by 1 minus, so you'll be having R. What was R? R is going to be the same. 1 by 1 plus KE. 1 by 1 plus KE. Is that clear, guys? Guys, getting it? So now what happens here? It's going to be R into E minus D divided by 1 plus KE the power 3, the whole divided by 1 plus KE minus 1 the whole by 1 plus KE. Am I right, guys? So now what happens? This and this gets knocked off. This removes 1. So 3 becomes 2. So now what do you get? R into E minus D divided by 1 plus KE to the power 2. But once again, this KE is also here. Guys, getting it? This is what I said here itself. Are you getting it? And what is this? The present value of the returns earned on the second year's retained earning till perpetuity. Are you getting it? Are you getting it? So now, what Mr. Walter says, now, first year retained earning was there. It started generating return from the second year till perpetuity. He is asking you, what is the present value of all the returns earned on the first year retained earnings? This is this figure, am I right? So how much is that? R into E minus D divided by KE into 1 plus KE. Am I right? He's saying plus. Second year you had a retained earning. That started generating return from the third year onwards. What is the present value of all the returns that you earned on the second year's retained earnings? R into E minus D divided by KE into 1 plus KE to the power 2. Similarly, in the third year you will have a retained earning that will start generating returns from the fourth year onwards. What is the present value of all the returns generated on the third year's retained earnings? It is going to be R into E minus D divided by KE into 1 plus KE to the power 3. Guys, getting it? And it goes on till perpetuity. So he's asking you, he's telling you, look. The intrinsic value of a share is not just the present value of the dividend. D divided by KE, that is only one part. On top of it, you should add the return generated from each year's retained earnings, and the return calculation will start from the next year onwards till perpetuity. So every year you will have a retained earning. From the next year onwards, it will start generating return, arrive at the present value of that. Like this for every year you need to do. So which means the first year's figure will be this, second year's figure will be this, third year figure will be this. Like this you should keep on adding. Guys, getting it? So now this is the final cash flow equation. So sum of this will be equal to the second part of this guy's formula. Are you all able to understand this, guys? Come on, please reciprocate. You guys are able to understand till now? Is this clear? Now, once again, we need to use what? Let us see if it has a common ratio. Obviously, it will be having a common ratio. Now, second number divided by first number. So, can I say 2 divided by 1? It's going to be how much? R into E minus D. Come on, guys, help me out with the figures. KE into 1 plus KE to the power 2, the whole by. So, R into E minus D divided by KE into 1 plus KE. Am I right, guys? Yes, so now what do you have? This and this gets knocked off, this and this gets knocked off, this becomes 1. So I'll say this is 1 by 1 plus KE. Am I right? This is the common ratio. If you want, you can try 3 by 2. Once again, everything is same. Only it is incremented by 1 plus KE. Am I right, guys? So now, are you guys accepting that this is a geometric progression series? Yes. So now if it's a geometric progression series, you will have to do A by 1 minus R. So what is A? The first number. So R into E minus D divided by KE into 1 plus KE. Correct? Huh? The whole divided by what? 1 minus R. What is R, guys? The common ratio 1 by 1 plus KE. Now solve for this. Solve for this. So now can I say this is nothing but R into E minus D divided by KE into 1 plus KE. The whole divided by. So now this LCM you need to take goes on to the numerator. Am I right, guys? This goes on to the numerator. Am I right? So becomes 1 plus KE minus 1 the whole by 1 plus KE. Guys, getting it? This and this gets knocked off. This and this gets knocked off. You're left with R into E minus D divided by KE square. 1 second. I think this started off with yes, this is correct. Okay, you get KE square. Yes, this is right. Are you guys getting it? And this is exactly the formula that we saw there. Guys, R into E minus D divided by KE square. Yes, this is what I told you here. R into E minus D divided by KE square, and hence it's proved. Are you getting this? So basically what he says is the intrinsic value of a share is the present value of the dividend plus, don't say present value of retained earning, present value of the returns earned on every year's retained earning up to perpetuity. Is that clear? So there are multiple layers hidden behind this small formula. Are you getting it? Are you getting it? So first year retained earning will start generating return from second year onwards till perpetuity. Second year retained earnings will start generating return from third year onwards up to perpetuity. Using this model, he has arrived this formula, and he says this is how you need to arrive at P0. A logical method, right? And core of time value of money concept is hidden here. Is this clear? So what is the formula, guys? As per Walter model, D by KE plus R into E minus D divided by KE square, and that's about this model. Guys, getting it? Yes, you knew this before itself, huh? You knew this before itself. Okay. I was asking for derivation. That's what I was asking for. Okay, right. So you're saying you knew this formula. Formula, if anyone sees, they can know. Okay. Okay. Logic you knew, but derivation you didn't know. Okay, no problem. Guys, now is everybody able to understand? Guys, the reason why I'm doing this is because now tomorrow, even if you struggled somewhere, at least you will know, okay, fine, this was the reason why it was done. That's about it. The derivation is not required for exam, but I want you guys to have a control over it. Just in case you forget this formula, you should know how to, get this. Is that clear, guys? Everybody? Yes. Now, with this, shall we just go and do a numerical problem? I'll just go and do one numerical problem. Yes. Come on. Please take TYK question number 1. Okay, what's the page number? 115, huh? Okay, I got it here. Okay, guys, please, come on, let's do this quickly. Okay, let's begin, guys. Let's begin. Now, a company has a book value per share of BVP is of how much? 137.80. Its return on equity is going to be 15%, and it follows a policy of retaining 60% of its earning. What is 60%? Retention ratio. Can we call it as B? Yes. All right. And this 15%, what is it? R. Am I right, guys? So this 15% is R. This 60% is B. Am I right, guys? If the opportunity cost of capital is 18%, what is it? KE. I am an investor. If I am not investing in the stock, elsewhere if I invest, I will get 18%, which means I will expect 18% from this particular stock. That is the meaning of opportunity cost. Compute the price of the share today using both dividend growth model as well as Walter's model. Is that clear? Now guys, remember, dividend growth means what? Gordon's model. Gordon's model. Now, Gordon assumes that it is going to grow perpetually at a constant rate. Walter, no growth, zero growth. He assumes that dividend remains to be D up to perpetuity. Earning remains to be E up to perpetuity. Is this clear? Now, how do we do this question? Have they given the earnings or have they given anything? Huh? PR is given. With that you can arrive at growth rate. Growth rate will apply on what? Dividend only, no? Where is the dividend amount? Payout ratio is given. You apply it on EPS. Then where is EPS? Price is given. P ratio is not even given in the question. Guys, you remember I gave one formula in between. What formula? EPS is equal to BVPS into return on equity. I gave this formula. Guys, I told this formula if you remember. What is it? What is it? So, EPS is equal to BVPS, book value per share, into return on equity. Logic also I told you. What is book value per share? Guys, equity shareholders of funds divided by number of equity shares. What is return on equity formula? Earnings available for equity shareholders divided by equity shareholders funds. Guys, getting it? This and this gets knocked off. Ideally, you get what? Earnings available for equity shareholders divided by the number of equity shares, and hence the net figure itself stands for EPS. I told this formula just in the previous session or the session before that. Guys, ratios are very, very important at the final level as well. And please, in case you don't have a copy, download it from our website. I told you, I showed the website, and also I told you, Costfin.in under the free resources. Please, you can download and keep it for your reference. Is that clear, guys? Right? This formula is what is going to help you solve this question. Else, you can't even touch this question. Guys, getting this? Getting this? That is a starting point. And only after that, you can build this. Let's do this quickly. Write on TYK, question number 1. So first, write down EPS is equal to BVPS into ROE. Nothing needs to be mucked up. Everything is conceptual. How much into how much? Rupees 137.80 into the return of 15%. How much is that, guys? Hello? Figure. Rupees 20.67, huh? Yes. Yes, guys, getting it? Any issues here? No. Next. Now, how much is my dividend per share or DPS? How much is it? Guys, come on. How much is it? Now, 60% is the retention ratio. Guys, can I say this is nothing but 1 minus 0.6. 60% is retention ratio, which means 1 minus 0.6. 40% is my payout ratio on 20.67 figure. How much? Rupees 8.27. Am I right, guys? Guys, everyone clear with this? Any issues here? No. Next, what is my growth rate? G is equal to B into R. What is my B here? Don't say 40. Good. It is 60% retention ratio into what is the rate of return on equity? 15%. How much is this? It's going to be 9%. Are you guys getting it? Now, G is required for? Only for Gordon's. I don't need it for Walter because Walter assumes that the dividend is going to be 8.27 up to perpetuity. Is that clear, guys? Right? Next. R is equal to, what is R? Given in the question, 15%. Am I right? R is 15. And what is KE? K is equal to 18%. Is everybody clear with this? First, we are listing out the ingredients. Right? Now just go and knock off. Now write down. Write down first part 1. What is part 1? Yes, write down dividend growth model. Dividend growth model within bracket Gordon. Both these guys use only time value of money. Sum of infinite GP series. Both these guys use it. Is that clear? So then why, sir, they have named the model after them? They linked mathematics to finance and they said use this, and hence we are calling that as their model. Is that clear? Then why did you use Markowitz's portfolio theory? He applied his mind in saying that, look, standard deviation is something that's a good measure for calculating risk. Hence we are using his model. Else what he said was only standard deviation. Are you getting it? Right? Fine. Now, write down here. Write down here. So here it's going to be, write on the formula. P0 is equal to, come on. Yes, D1 by KE minus G. Is that clear, guys? So now, once again, sir, can I take this as D1 or can I take this as D0? Your choice. Nothing is given in the question. Okay, we can take it as D1 directly. Please write a note. 8.27 divided by, what's my KE? 0.18 minus, what is my G? 0.09. Figure, how much is this? Rupees 91.89. What is this? This is as per Gordon's model. Is that clear, guys? Is that clear? Where we are only considering the dividend amount, but we are saying dividend will grow every year. The next model, what is it? Yes, part 2. Walter's model. Walter's model. Come on, write the formula. What is formula? Come on, guys, I proved it. I derived it. P0 is equal to T by KE plus R into E minus D divided by KE square. Is that clear? Is that clear? The present value of dividend plus the present value of the return earned on each year's retained earnings. Is that clear, guys? Now, 1 second. Here, do you have any growth? No. We assume that, there is no growth. This G and all is irrelevant. I am not assuming. This is the assumption he takes. He says that it will not grow only. It is going to be constant. Is that clear? So just do it. Now what is D? 8.27 divided by, what's your K? 0.18 plus, what's your R? 0.15 into, what's E? 20.67 minus, what's your D? 8.27 divided by KE square, 0.18 to the power 2. Now, can you tell me, guys, how much is the first part? 8.27 by 0.18. So it's going to be 45.94 plus, okay. It's going to be 20.67 minus 8.27. It's 12.4 into 0.15 by 0.18 by 0.18. How much you get? 57.41 roughly. So how much you get? Rupees 103.35. Am I right? Okay. Yes. This is what you get. Are we clear on this? As per Walter model, if you see, the price is slightly different. Is that clear, sir? Which is the correct price? Based on his model, right? Gordon's model, this is the price. Based on Walter's model, this is the price. You choose whichever you want to follow. There is no one size that fits for all. There is no concept like that, right? Based on the assumptions of this model, you need to calculate the intrinsic value. Is that clear? Is everybody able to understand? Right? Is everybody able to understand? Clear with this, guys? Now, both these models have pros and cons. This guy completely ignores retained earnings. This guy completely ignores growth. So, you can't say which is a foolproof model. No, it doesn't work that way. Is that clear? Then I can say, sir, I will take earnings itself and apply it on Gordon's. So, instead of D, I will directly use E, sir. Instead of D1, I will use E1. Yes, that's another way of doing. Yes, you can do it. No problem at all. Is that clear? So, here we are not getting into which is correct, which is wrong. We are just saying what are the different models available. Is everybody able to understand? Now. That's about it. That's about this question. But wait. There's one very important thing. Now, at the CA intermediate level, you would have studied, it is also there at the final level, you would have studied what is the optimum dividend payout ratio as per Walter's model and as per Gordon's model. These two guys agree on this. These two guys agree. Whatever Walter says, exactly the same is said by Gordon also. Regarding what? Optimum dividend payout ratio. What do you mean by optimum dividend payout ratio? What should be the amount of dividend that needs to be paid? Is that clear? Is that clear? Now, go to your concept book. Now, look at this. Here, guys, as per Walter's model, what is the optimum dividend payout ratio? This is exactly as per Gordon's model also. Is that clear? Now, guys, Walter and Gordon, two guys, each of them have given two things. Number one, their manner of calculating P0. That is different. On top of it, they have also given one more thing. What is it? How much dividend the company should pay. Here, both these guys are actually agreeing on each other. Is that clear, guys? Now, how much should be the dividend payout ratio? Wait, you can't come to a conclusion directly. It depends on comparing two parameters. What and what? R and KE. It depends on comparing what with what? R and KE. What is R? The return on equity. That is, the company says, if I don't pay the dividend, if I keep it with myself, that's called retained earnings. Using this money, how much return I can earn? This is R. KE is what? The expectation of return of whom? The shareholders. They are saying, if you give this money to me, elsewhere if I put, I can earn this much. Am I right? Or in other words, can I say R is the return the company can generate with the money? K is the return the shareholder can generate with the money. Am I right, guys? Am I right, guys? Now you see, when R is greater than K, R is what? Return on equity. K is what? Your expectation of return of the investor. So let us say here, let us say example, R was 20%, K is only 15%. Now you tell me, who is able to generate more return with this money? The company. Hence he says don't pay anything. You are managing the money well, so payout ratio should be 0. And he's proving this with this formula. When R is equal to K, you apply my formula and see, only when the payout ratio is 0, which means dividend is 0, only then you will get the maximum share price. You try any proportion. Say, no sir, R is greater than KE in this case, but still I'm paying 50% dividend, 10% dividend. Definitely, you will not get the maximum share price, maximum P0. Maximum P0 you will be able to achieve only when your D is equal to 0. That is, you retain everything. Is everybody able to understand? So don't say, sir, as per Walter model, you should not pay anything. No. When R is greater than KE, Walter says the company is able to manage the funds much better. Let the entire money be with the company. Don't pay even a single rupee to the shareholder. Why? Because anyways, this amount also belongs to them only. Are you getting this? Are you getting this? Is everybody able to understand? Is there any issue here? Guys, getting it? And even Gordon says, you are right. Yes, I am also accepting with you on this. Is that clear, guys? Is that clear? So, in other words, can I say, when R is greater than KE, right? Ideally, the company should not pay anything, guys. And only when the company does not pay anything, the share price will be maximum as per his calculation. The intrinsic value will be maximum. Is that clear? Suppose the company has not paid anything. Or let's say the company has actually paid the entire money. Then if the payout ratio is 100%, then the share price will be the minimum. Are you getting the idea here? Are you getting the idea? All these sums we have done at the intermediate level itself. Is that clear? Now her company has paid everything. You'll get the minimum price. If you don't pay anything, you'll get the maximum price. Sir, I've paid everything, sir. Suppose if you start reducing the payout ratio, the share price will start increasing. And at max, it can go only when the payout ratio is 0. Is this clear, guys? When R is greater than K. Suppose R is less than K, ulta. Suppose the company is able to earn only 15%, but investor says he is able to earn 22%. Then Mr. Walter says, you are not managing the funds well. Pay everything to the investor. Pay everything to the shareholder. He says the optimum payout ratio is 100%. Why? He will actually be able to manage his funds better. You don't manage his money. Is that clear? And in this scenario, only when the company pays 100%, the share price will be maximum. Is that clear? Is that clear? If you start paying dividends slowly, the share price will reduce. I mean, if you start retaining, the share price will start reducing. Is this clear, guys? And Gordon also agrees to this. Is that clear? Is everybody able to understand? Right? When R is equal to K, let's say if the money is with the company, they earn 20. If the money is with the investor, then also they earn 20. Indifferent. You try and apply this formula anywhere. Whether the money is with the company or whether it is with the investor, it doesn't make any difference. Which means, irrespective of your payout ratio, the share price will always be constant. This is what Walter has said. You apply on this formula and you check for yourself. This is how it is. If you want, you can test this with CA Intermediate. Some questions are there. You can do that. It's not there at the final level, but I'm explaining the concept. Suppose in exam, they ask you for all these things, you should be able to know. That is what this table is saying. Is that clear, guys? Is everybody able to understand? Is there any issue here? And this this dividend payout ratio and all the optimal dividend payout ratio is exactly the same under Gordon also. Gordon also agrees that. He also says, how do you decide on the optimal dividend payout ratio? Compare KE with R. Now you guys tell me, if R is greater than KE, what is the optimal payout ratio? Think and answer. R is greater than KE, payout ratio should be 0. Why? Companies managing the funds well don't pay anything. If R is less than KE, optimum payout ratio 100%. You are not managing the money well, paid out. Is that clear? R is equal to KE. You pay anything, it doesn't matter. It will not impact on your share price. You apply this on the formula and you will see. That's why his formula considers everything. His formula considers what? R is also there, KE is also there, E is also there, D is also there. Is that clear, guys? So his formula considers everything. So it balances out. Are you all able to understand? Getting it, guys? Is everybody able to understand? And that's about this particular concept of your Walters model. Please go and update your library of adjustments. Write on. Quickly write on, guys. Come on, make it fast. Write on. Calculation of intrinsic value under Gordon's model and Walters model. Calculation of intrinsic value under Gordon's model and Walters model. Are we done here? Yep. And also write down semicolon for those who missed out. EPS is equal to BVPS into ROE ratios. EPS is equal to BVPS into ROE. Are we done? Yes? Done? During Walters model, we have given KE in the question now. Okay. They had given what? KE. Okay. Wait 1 second, I will come to that. That's the next concept I'm doing. So 1 by KE gives you PE ratio. That's what you are saying? I'll come to that. When to use, when not to use, you should know. You cannot use it every time. 1 by KE is equal to PE ratio. That's the next concept I'm going to come into. This cannot be used every time. This should be used as a last resort. In this question, how can you use? Then why else have they given BVPS? Why else have they given BVPS? You tell me. Book value per share is given. Market value. Oh, you're saying, okay, 1 by KE gives you what? A PE ratio. With that, what will you do? MPS divided by EPS you will get. Seri, where do you have MPS? This is not MPS. This is book value per share. Book value is different from market value. You cannot use this formula here. Book value per share, ma. This is not market value. This is not market value. You cannot use it like that. No. Had they given this as market value, then your thought process is correct. But this is book value per share. Book value means what? Shareholders' funds as per your books divided by number of shares. So it is not market value. Had they given market value, you are perfectly right. That's how you should do. Else you cannot do the sum. Yes. But here, that's not the question here. Getting it? Guys, shall we move on to the next one? Yes. Now, please go to, yes. Now, we'll go to the, we are in alternative models, right? The last part of the chapter, right? Under that, you have this earnings growth model. I told you what is earnings growth model. Exactly same as dividend growth model, except that the cash flow that you consider is not dividend, it's not DPS, it is EPS. Why? Logic. Now, dividend alone does not belong to me. The entire earnings belongs to me. Hence, whatever you are doing, whether it's a no growth, or a constant growth, or single double stage growth, triple stage growth, or H model, whatever it is, instead of D, replace it with E and you're done. Is that clear? That is called as earnings growth model. Are we clear with this? In this case, we apply, please underline, the same formula as Gordon's. However, instead of D1, we substitute it with E1. This model can be based on the below assumptions. The return on retained earnings remains the same. The retention ratio remains the same. Is that clear, guys? The return that you generate R is constant, and even the retention ratio, every year it remains constant. Is that clear, guys? These are some assumptions based on this. You can do this model. Fair enough? Simple. Now let's go to the PE multiplier model. Now guys, what do you mean by a PE ratio? We've already seen this, but just to set the context right. What do you mean by a PE ratio? PE ratio means what? Price upon earnings. What is price? MPS. What is your earnings? EPS. Is that clear? Right? Now let's say my market price per share is going to be 20 rupees. And let's say my EPS is 2 rupees. What is my PE ratio? 10 times. So what does it mean, guys? What does it mean here? It means the market is ready to pay 10 times the earning to buy the share. Am I right? It's a multiplier. Is that clear? It's a multiplier. Now, in some cases, in valuations, in business valuations, we'll be seeing it. Right? So some companies where they are startups. They are startups where you can't exactly predict the future, how much will be the earnings every year and all these things. They use a multiplier. They say, don't worry, we'll pay 20 times your turnover, 10 times your turnover. Turnover, or you can say on the total earnings. On the total earnings, 20%, 20 times your total earnings will be the value of the company. Or company means you'll say total earnings into 10 times. If you want it on a per share level, EPS into 10 times. Are you guys getting it? So multiplier can also be used as one of the valuation techniques. Suppose in the question they have given EPS is 2. P ratio is 10. What is the value of the share? 2 into 10. Is that clear? Simple. If this is given and this is given, you multiply the 2 to arrive at what? The value, the P0. Is that clear? This is another way of valuation. Are you getting it? These are contemporary methods. They are not traditional methods. Suppose if you have to resort to these methods, you can use it. So when to use what methods? Predominantly we'll be seeing in the next chapter, which is business valuation. Is that clear? By the way, guys, I'm just positioning you. We are in valuation of securities. Under that, we are in one section called equity valuation. And under that, we are in part 3. That is different alternative methods. So remember, we still have to do bond valuation. That's where the major chunk of the chapter lies. The biggest area of this chapter is bond valuation, not equity valuation. Equity valuation is relatively easier. Bond valuation is where you have a lot of rich issues and rich topic. Valuation peaks there. Is that clear? And then you have certain other things like buyback and other things. So we are just in one section of this chapter, equity valuation. Is that clear, guys? And once we finish all of this, we'll go to business valuation. So even bond valuation, everything we'll finish, and then we'll go to business valuation. Yes, you have a doubt? Yes. Yes. So what you're asking is, P0 represents intrinsic value. Here we are taking MPS, and based on that we are calculating it. So does MPS refer to P0? What I'm trying to say is, here currently we are saying how much is the market valuing the share. The market actually weighs, the market is ready to pay 10 times the earnings to actually buy one share. The market is the king. In this model, we base the market price to arrive at it. Now what we are trying to do here, historically the PE multiple has been 10. That's so we are calculating MPS, or we are calculating P0. Past the trend of the company shows that investors are ready to pay 10 times the earning, which means currently I have the earnings with me, multiplied with 10 to arrive at the intrinsic value. This is one of the methods. That's about it. Is that clear? So here ideally it's ulta. You are not computing PE ratio here. PE will be given. You are multiplying that with EPS to arrive at how much the market is ready to pay today. Are you getting it? So strictly speaking, we don't discount any cash flows. We are just trying to find out how much the market is ready to pay. That's what we are trying to do here. So that's why I said it's a contemporary, a new method, not a very traditional method. It's another method not used everywhere. We will see this in valuation later on. We'll see this in business valuation. How do you think WhatsApp was valued? How do you think WhatsApp, do they have any ads? No. Do they charge you anything? In India, no. In India, no. So how do they value? Why did Meta pay so much to actually acquire the company? If you use all these models, nothing will work out. They had a different way to value. Per user, they attached one value. How did they arrive? Valuation is not just a scientific way of calculation, it's also an art. You attach a value. If you see a value there, you will do it. We will see more about it later. But all these methods we see, but it cannot be applied every time in every single case. Exactly that, we are valuing the business itself. And I told you guys, if you guys remember, that deal happened over a single cup of coffee. WhatsApp announced that the company is going to be acquired by some other person on a Friday, I think on a Friday evening, if I'm not wrong. One meeting, and it completely changed the equation. Meta acquired. So that's how hostile takeovers, that's how it happens in markets. That's why they protect a lot. They make sure the news doesn't go outside anywhere until the deal and everything is finalized. Okay, so we'll be seeing more about that in business valuation, that you're valuing the entire business, but here first we're valuing just a share. Is that clear, guys? Are we clear on this? Is there any issue here? And how do you arrive at the EPS? EPS is nothing but EFE, earnings available for equity shareholders divided by number of equity shares. That's why you mentioned EFE is nothing but PAT, earnings after tax, minus preference dividend. Am I right, guys? You can call it as EFE divided by your number of equity shares. EFE is for our classroom discussion. Are you guys getting it? Is everybody able to understand? Is there any issue here, guys? No. Now remember one more thing. Once again, this is a part of your CA intermediate concept. Yes, whatever you are telling me till now. Now, guys, there are different models to calculate KE. You guys know that? Yes. Now I'm just once again going back to my CA Inter book, right? Here you have something called as earnings price model. You guys remember? Now this earnings price model says simple. Now as per this, the formula is what? I'm not assuming that my earnings is going to grow, right? So if I'm going to discount the earnings that I'm going to receive up to perpetuity, annual cash flow divided by discount rate, that's how we do. So can I say P0 is equal to, here E, I'm not discounting D, I'm discounting E. E divided by KE. Am I right, guys? Hello? You guys know this, right? Right? And if I cross multiply, can I say KE is equal to E divided by P0? So this is another formula to calculate what? Your KE. Am I right, guys? So this is called as earnings price model. Simple. What I earn divided by what I pay. Guys, getting it? Getting it? This is another way to calculate what your KE. You guys are aware of this? Yes, or we say EPS by MPS, ulta. MPS is the current market price. Are you guys getting it? Is everybody able to understand? Hello? You guys are able to understand? Now, look at this. One way of calculating this KE is what? Can I say it is EPS divided by MPS? Am I right, guys? Guys, are you all clear? This is as per what? Earnings price model. Assuming that earnings remains constant up to perpetuity, and I'm discounting not a dividend but earnings. It's another model, right? Guys, everybody understanding the context? Now, if I cross multiply this, can I say MPS divided by EPS is equal to KE? Can I say this? Guys, sorry, 1 by KE. Yes, can I say this, guys? Guys, I took this to the numerator, took this to the denominator, and brought this to the denominator. Can I say this? Guys, everyone, cross multiplication. Now MPS by EPS is nothing but PE ratio. So can I say PE ratio is equal to 1 by KE? Guys, getting it? Guys, getting it? Everybody? Or I can also say KE is equal to 1 by PE ratio. Are you getting this? Are you getting this? Now suppose in a question they have given PE ratio, right? And there is no other way to calculate KE. I can say 1 by PE ratio is equal to KE. Is that clear? This can be used as a last resort, not every time. Suppose CAPM is also given. Use CAPM. That is the best method. Are you guys getting it? Now, no other way to find out, sir. PE ratio is given. 1 by PE ratio is equal to KE. Once again, CA intermediate concept. You remember something that you've seen in CA Inter? Anyways, guys, this is also a CA Inter concept. Why am I doing it? All these things are tested at the final level as well. Is everyone able to understand? The context stems out of what? Your earning price model. And from there, we've built this. Is everybody getting this? Is everybody getting this? Right? So can I say 1 by PE ratio is equal to KE? Or 1 by KE is equal to PE ratio? Is everybody able to understand? Done. I think with this, we are good to go to the next sum. Okay, this is what we have mentioned here. The relationship between PE ratio and KE is inverse. The same can be summarized in the below formula. So here if you see, KE is equal to 1 by PE ratio, or PE ratio is equal to 1 by KE. Is everybody able to understand? This yield approach we will do later. I don't think there's any sum. If there is some, yes, I think there's one sum. We'll do it later. Not a problem. Guys, are we clear on this? Now, with this, please take TYK question number 4. Please take TYK question number 4 and let's do this. Shall we get started? Guys, these are alternative methods of valuing your intrinsic, calculating your intrinsic value. Is everyone getting this? Shall we begin? Shall we get started? Everyone, shall we get started? Yes. Question number 4. On the basis of the following information, current dividend D0 is given, discount rate K is given, basically it's KE, am I right? G is given. Calculate the present value of the stock of ABC Limited. Number 2, is its stock overvalued if the stock price is rupees 35? Actual market price is given. ROE is 9%. EPS is given as 2.25. Show detailed calculation using what method? PE multiple approach and earnings growth model. Is that clear? Earnings growth model means what? Same as Gordon. Instead of D, you use E. PE multiple, you guys know what is PE multiple. EPS into the PE ratio. Is that clear? Now guys, now please do not look at the solution. Do not look at the solution. Right? This was, look at this. ICA study material, past exam question and an MTP question. Right? It's a past examination question that we are doing. Now, do not look at the solution. If you look at the solution, it's gone. It kills your thinking ability. Try to arrive at it by yourself. Assume, I keep telling you this, assume you are in the exam hall right now and this question has come. Bring that survival instinct. Someone drops you in the middle of the ocean, you will not give up. You will grasp for breath. Bring that survival instinct. 6 months is no joke. Remember that. Online folks, pause the video now. Take 2 minutes time. First, don't jump to the solution. Take a step back. Read it. Enjoy the beauty of the sum. And then look at the nitty-gritties and then frame the approach. Answer will not take much time. Framing the approach takes a lot of time. Read the question carefully. Pause the video now. Now guys, now the first part of the question says what? Calculate the present value of the stock. That's all they have given. They have given D0, KE, G. Clearly it is dividend discount model. Am I right guys? Yes. So what do? So D1 divided by KE minus G. You do it right. So D1 is 2.5 into 1.02. 2% is a growth rate, am I right? Divided by KE minus G. KE is given and G is also given. That's about it. First part is not that great. Now, going to the second part. Actual stock price is given. Initially, to calculate intrinsic value, you don't need the actual. Finally, you arrive at the intrinsic value, compare with it and say under or overvalued. Now, you need to calculate the intrinsic value using 2 methods. One is PE multiple approach. The other one is earnings growth model. Now guys, what is the missing data in this question? What is the missing data in this question? Now, MPS is what you need to calculate, ma. That's what you need to calculate, right? And MPS is what? P0 you need to calculate. Now, what is this? What is the missing data in this part? Now, P ratio. How do you calculate P ratio? Huh? MPS divided by EPS. Okay. Now, sir, actual MPS is given. Where is the EPS? 1 by P ratio KE. Where do you have KE? 10.5 is KE. That is for the Sparta. Here they have not given anything specific about KE. Then why have they given ROE? So guys, here what ICA has done is they have taken a stand that this ROE stands for KE. Is that clear? This ROE stands for KE. That's what they have done here. Is everybody getting it? Now, sir, ROE is R. KE is KE. How can these two be the same? ROE is what? The return the company is able to generate. KE is the expectation of return of the shareholders. How can these two be the same? Generally, no. Generally, no. But here, since it was specifically given, you don't need ROE for anything else. Now, how do you calculate ROE? Return on equity. Basically, I can say what? It's nothing but the earning EPS divided by my the value of equity. Am I right? The value of equity. Basically, your equity shareholders funds. Am I right, guys? That's how you calculate. your return on equity. Now they are saying this is also a way in which you can say this is what the investors are expecting. What they earn divided by their money in the business. Is that clear? So guys, remember one thing. This question has to be construed or interpreted contextually. You are right in saying, sir, KE is different, ROE is different. Absolutely right. But in this context, you should understand and interpret that they are referring both to be the same. Is that clear? Else we can use this only, no? Guys, else we can use this only, no? Are you all getting it? Are you all getting it? But here they have actually interpreted and they've taken that this is your KE. Is everybody able to understand? And now you have KE. 1 by KE gives you what? The PE ratio. And once you have the PE ratio, now EPS into PE ratio gives you your valuation as per your P0 as per what? Your earnings multiple approach. Is that clear, guys? Are you getting it? Are you getting it? Now under the earnings growth model, what will you do? Once again, everything is same. Use Gardens, but instead of D, use what? EPS. Here also E into 1 plus G divided by KE minus G. Am I right? Now what is KE? 9%. But G they are taking it from here. So the reason is specifically ROE is given here in this area. Hence they are taking that itself as KE. Is everybody able to understand? Hence we will put this under an exceptional category. We'll put this under exceptional. Why? You need to take that interpretation. Is that clear, guys? Beyond this, there is nothing great in this question. But single question touches upon dividend discount model, the PE multiple approach, as well as on your earnings growth model. Is that clear, guys? Yes. If ROE was not given, you have no other option but to take this only as KE. Right? Since they have specifically given what more, I mean, for what else have they given this ROE? For that purpose only we have taken it. Is that clear? Yes, if this had this not been given, you can take this as KE. Now can we quickly do the sum, guys? Right on. TYK question number 4, isn't it? Right on. TYK question number 4. Let's do this. Let's do this. Right on. Part 1 now. Right on. Part 1. What is part 1, guys? Dividend discount model, right? Right on. Dividend discount model. Quick. Let's make it fast. What's the formula? P0 is equal to, yes, D1 divided by KE minus G. Right, where D1 is what? Give me the calculation. 2.50 is a past dividend into 1 plus growth rate. So 1.02. Am I right, guys? Divided by what's your KE? 0.105. 10.5% minus the growth rate of 0.02. How much is the numerator? How much is the denominator? 2.55 divided by 0.085. How much is this? Rupees 30. The intrinsic value is going to be rupees 30. Is that clear? Right? Part 1. That's all they have asked. They have asked for under or over valuation only in part 2. So part 1, just write this and leave it there. Next, go on to part 2. Part 2. Part 2. Now under this, take a red ink and write down. Please take a red ink and write down. Return ROE within bracket. How much was that? 9% is assumed to be equal to KE. Is assumed to be equal to KE. Is that clear? Is that clear? And based on this, they have framed the second approach. Now under this, write down part A or A. What is A part here? P multiplier. Write down value of stock under what method, guys? PE multiple approach. Are we clear? Yes. Now let's do this. Now for this, first we need to calculate what? P ratio. So write down here PE ratio is equal to 1 by KE. Am I right? Guys, getting it? Everybody getting it? Right? So now, which is equal to 1 divided by 0.09. And how much is your PE? 11.1111. It just keeps on going. Am I right, guys? 11.11. Now, you have an EPS in this question? Yes. How much was your EPS? Within bracket given. How much? Rupees 2.25. Now write down. Now write down. Value of stock is equal to EPS into PE ratio. So what is the meaning? At present the stock earns, the earning per share is 2.25 and the market is willing to pay 11.11 times the earnings in general. Is that clear, guys? Which means as per this approach, what is the valuation? 2.25 into 11.11. How much is it? Retain the decimals. So 24.999 comes out to rupees 25. Is this clear, guys? As per the PE multiple, it's going to be 25. Is that clear? Guys, are we done with this? Are we done with this? Yes. Now let's go to B. What is B? Value of stock. Value of stock under earnings growth model. Under earnings growth model. Right, guys? So now, what do you do here? What do you do here? Once again, you need to calculate what? The same as Gordon's formula, but in this case, instead of D, you use E. Write down. P0 is equal to, write the formula. Tell and write. E1 divided by KE minus G. Am I right, guys? Now, what's E? What is E? So, write down 2.25 into 1 plus growth rate. What is growth? 2. So 1.02. Can I say this, guys? Hello, everybody. You guys are getting it? Any issues here? Divided by what's your KE? Just now we saw it. In this thing we are taking as 9%. So 0.09 minus growth rate is 0.02. How much is this? Final answer, you tell me. Rupees 32.79. Is that clear? Guys, getting it? Any issues? Any problem here? No? Now we are not done yet. We need to actually mention whether it is overvalued or undervalued. Am I right? Yes, guys. So now write down. Come down and write. Come down and write. Actual stock price. Actual stock price is equal to rupees 35. Correct? So write down number one, value of stock under PE multiple approach was how much, guys? Was rupees 25. So as per the PE multiple, I see that the value of the stock should be only 25, but actual price is how much? 35. So write down. Since the actual stock price is higher, comma, it is overvalued. It is overvalued. Is that clear, guys? Since the actual stock price is higher, it is overvalued. Next one, write down. Value of stock under what model? Under earnings growth model. How much is that? Rupees 32.5. 32.79. Now, what is the actual price? Once again, 35. Under or over? Once again, it's over only. Actual price is 35. Still here, it's only 32.79. Write down. Since the actual stock price is higher, comma, it is overvalued. That's all. Buy or sell recommendation not asked. Decision making they have not asked. Is that clear? Since the actual stock price is higher, it is overvalued. Is that clear, guys? Are we getting it? Yes. Now. That's about the sum. Now, guys, 1 second. Let's just take a step back and look at it. As per dividend discount model, how much was the intrinsic value? 30. As per your PE multiple, how much was the value? 25. As per earnings growth model, how much was it? 32. For a single stock, you have so many intrinsic value itself. How do we take this decision? How much is the correct value? Now you're talking about a stock. Let's imagine, so share into number of, the share price into number of shares gives you the total value of equity itself. That's how mergers, acquisitions, for that you need to do the valuation, right, of the entire company. Value of a company has equity plus debt. So value of a company minus the debt value, you get value of equity. Any which ways you need to know how much you need to pay that is actually the worth of the company. Am I right? So on a per share level, we call it as value of equity. But as a whole, you need to value the business. Am I right, guys? Now, there are multiple ways in which you can arrive at the intrinsic value itself. Sir, in real life, what happens? In real life, what happens? Now, that's the reason why. In real life, we have just seen a few approaches. Okay. Even there are other approaches. We are yet to see the discounted DCF model, discounted cash flow model. I told you free cash flow for the firm, free cash flow for you. Beautiful models. They are very good models. In fact, that is predominantly used in our next chapter, business valuation as well. Now, guys, I'm just taking a step back and I'm just telling you. So actually, we do this valuations. For doing valuations, you need to signed value. You need to be a registered valuer. For that, you need to take up an exam. Right? So, we have a team member who is also a chartered accountant. We have, a separate wing for this. As per under our wealth management wing, we also do this. Registered valuation. And what valuation? We're talking about financial assets. These are all financial instruments, financial assets. Valuation, I can also value a machinery. That is technical valuation. So, for every single line of valuation, gold valuation, that is different. Here we're talking about valuing financial instruments. We have a separate course for that. Right? And based on that, you guys know insolvency professional, IBBI, the Insolvency Bankruptcy Board of India, they have a separate course for all these valuations as well. And for you to be eligible for this course, you should have finished CA or CMA or something like that. So there are certain courses that says that you're good, you're ready for valuation. And it is assigned, UDIN has to be generated for this. It's not just like there's some random. How will we do these valuations? So as an active part of our practice, we do that. I'm not a registered valuer, so I haven't got the license because I'm more tilted towards the wealth management part. Valuation, we have a separate member who takes care of it. But of course, the underlying valuations, we do it. Signing part, of course, he's also being part of it, but he does the signing and other things. But how do you do this valuation? We don't use one method. We use multiple methods and take weighted average. Is that clear? And how do you assign the weights? That's where your professional expertise comes into picture. Will anyone use book values? Historical cost? Yes, we will use. For companies like banking companies, for financial companies, they are already in ready market value. How much is receivable? Today's value. So depending on the sector, you will pick the valuation method. Once there was an assignment which came to us, that company was in the business of, plying lorries. They were having 200 lorries with them. And across India, they were providing this logistics services. And there was a target, this was a target company. There was someone who is willing to acquire. They wanted to know, how much should I pay? So there's something called buy-side valuation, sell-side valuation. Just like how the buyer has hired us, the sell side, of course, that's their company. They will know what is the fair value they would have hired. And we both get into a negotiation. This is how it happens. So there we valued for that. Every truck has to be valued, right? So there we use, you guys know insurance, you have something called IDV, the depreciable value. Every year it depreciates, so we use that as a base because that was one of the assets in the balance sheet. But there are things that cannot be seen. What is the goodwill? What is the market potential they are enjoying? There are multiple methods of valuation, and based on that you take a weighted average. Now I attach a value to a company. Let's say I'm seeing this company is worth about 50 crores. On the other side, that guy is actually selling his company. He'll say, no, my company is worth 80 crores. As per my valuation, he gives all these his assumptions. So 50 to 80 is the range of negotiation. So somewhere we come in between. And how do you do that negotiation? Based on the valuation. I say, look, this is how I have valued, and these are my underlying assumptions. You tell me, how do you say it's 80 crores? This is how we will actually deal with it. And finally, we come to a consensus. If not, fine, it's gone. That's about it. But this is how deals happen in real life. Mergers and acquisitions. So for that, the base is valuing the security, then valuing the business, and then talking about your mergers and acquisitions. All these chapters are interlinked. Is that clear, guys? Is that clear? So this is actually something we've seen, because rarely these kind of assignments come to us. Because valuations, I mean, normal valuations, just like that for banking purpose, the certifications are fine. Mergers and acquisitions kind of valuations are very interesting. And, for people who are into the real valuation game, I mean, that's about the private equity. I told you, these are unlisted companies. How do you value them? There are so many parameters, assumptions that you need to use, but it's a very, very interesting field by itself. It's a very interesting field by itself that you use the core of valuation. What are you seeing? So private equity companies, venture capital companies, how do they value? They're going to put their money on someone's idea. How do they do it? Right? They will put some random growth rate, random discounting, and they'll say, sir, this is what we are going to do. One model alone cannot actually be a representative of your valuation. There are multiple models that we use based on what suits your nature of business. That's where your professional judgment comes into picture, and you need to be able to justify it to the opposite party. That's the most difficult part. Are we clear on this? Are we clear on this? So here, how do you use the discount rate? KE. How do you use KE? That's nothing but how do you arrive at KE? CAPM. Now the problem with CAPM is you need beta. These are unlisted companies. How can you say if the market moves by so much? My company is not valued, it doesn't move only. So we use a concept of levering and unlevering that we will see in business valuation. Even for unlisted companies, for private companies, how do you arrive at the beta? It is not moving every day, but market moves. But how do I do it? You take a proxy company and which is listed, and based on that you rework. Right? So this company is similar to my company, and based on that I rework. What is what we will see later, but I just wanted to give you guys an idea. Sir, valuations are under one model it is different, another model it is different. It will be different. What is the correct value? No one can say. As per my perspective, I can say this is the value. As per your perspective, you can say another value. If we both are in agreement, the deal happens. Else, the deal will not happen. So generally, when even a successful private equity firms, the number of deals that happen generally will be less. It will not be very high and all. Everyday deals will not happen just like that. For a deal to even actually break through, it takes a lot of process. There's something called due diligence that needs to be done, financial due diligence, legal due diligence. A lot of things happen. You need to agree on the price. It's not an easy joke, right? And in a year, if at least a mid-sized firm is doing about two, three valuations, deals is a very big thing. Valuation, any number of valuations you can do. Actual deal, getting the deal done. That's why some firms, what they do? They charge based on the success rate. They will say, we will not charge you a single rupee if the deal does not go through. That's a very big risk, but if the deal goes through, give me a percentage. That's one deal is enough. 500 crores, 1000 crores. Just imagine for this person who valued. Again, there are some legal restrictions for that, whether professional ethics. There's a professional ethic clause that says a CA in practice cannot charge some percentage fee to a client that is contingent upon finding or something like that. So which means if it doesn't happen, or if it happens, if I base my fee on that, if I say if you get a refund in income tax, then you give me a 50% of refund, that's not ethically correct. Right? That is in fact punishable as well. But within the legal framework, some people do. And even some merchant bankers, these guys, they are not bound by ICA's guidelines. Right? So these guys might do. So it all depends. I'm talking about what happens legally as well, within the legal framework. Anyways, guys, you guys get a fair idea. So the intrinsic value can be calculated from different perspectives, and the answer value will change. Is that clear, guys? Fine. So with this, we're done with this question. Have we written down the library of adjustment? No, right? So please write down. Write down. Calculation of intrinsic value. Calculation of intrinsic value under dividend growth model, dividend discount model, basically dividend growth model, comma, P multiple model, and earnings growth model, dividend growth model, comma, P multiple model, and earnings growth model, semicolon, red ink, ROE is assumed as KE. ROE is assumed as KE. ROE is assumed as KE. Are we done with this? Okay, are we done, guys? Perfect. Now, predominantly we are done with all the main valuation models. Now, guys, can we do one question which is purely based on common sense? Okay, forget all this valuation and other things, right? Can we do one question that is purely based on common sense? It's a study material question. Please take TYK question number 14, 1-4. TYK question number 14. Shall we get started? Okay. Now, guys, purely based on common sense, I want you to do this question. Please, your eye should not go down to the solution. Don't do that. It's basically cheating yourself. Never do that. Attempt something by yourself. Even if you get it wrong, it's very good. That's where you know where you stand. And that's when you can correct. If you look at the answer, it's gone. Earlier, when I used to do this, prepare the books, I used to give all the questions first and then put all the solutions later on. So that even if you want to go down, your eyes cannot go down. But then it was very difficult to turn pages, students told, so hence I changed it to this model. Long back I used to do that. But guys, in my opinion, that is much better. Because your eyes will not stop. It will be tempted. One point you will get it right, then you will look at the answer. And then you will look at the remaining answer also. That is the problem. Don't do that. Please, please. Okay, shall we do this, guys? Yes. Guys, this is a generic question, but requires some thinking. Simple only, but it can be done. Mr. A, let's say you are thinking to buy shares at rupees 500 each, having a face value of 100. The share has a face value of 100 and currently the current market price is 500. He is expecting the bonus ratio of 1:5. Wait, 1:5 means what? For what I get upon what I have. This is the rule always, right? In mergers and acquisitions, we'll be seeing something called as an exchange ratio. That is also based on this. So 1 for every 5 I hold. Is that clear? So if I hold 5 shares, post bonus I will get 6 shares. Are you getting it? Yes. Right. Now he's expecting bonus of 1:5 today. No. When is he expecting the bonus? During the 4th year. The annual expected dividend is 20% and the same rate is expected to be maintained on the expanded capital base. Expanded capital base means what? Post bonus also. He intends to sell the shares at the end of 7th year at an expected price of 900 each. So when is he going to sell this? After 7 years. Per share, he is expecting the share price to become 900. Incidental expenses for purchase and sale of shares are estimated to be 5% of the market price. Is that clear? Which means if you buy or you sell, there is a brokerage. Example, brokerage. How much is it? 5%. 5% is too high. Real life it will not be. It will only be in decimals. Why? Some brokers charge 0 brokerage also. 0 the annual charge is 0. Right? That's why 0 the. 0. They charge 0. Discount broker model. So then how do they earn, sir? Only if you're taking delivery, it's 0. Intraday they have brokerage. Also there are other segments. What we've seen is only one segment called the CM, cash market. There's something called derivatives, F&O, currency derivatives, CD. There's something called commodity derivatives. They all charge there. But here they don't charge much. But anyways, guys, 5% and all is too high, hypothetical. But anyways, they have given. Is that clear? He expects a minimum return of 12% per annum. Yeah, his discount rate is K. The question is, should Mr. A buy the share? If so, what is the maximum price he should pay for each share? Assume no tax on dividend income and capital gains. So ignoring capital gains. Now guys, 1 second. Basically, what should I do? Arrive at the intrinsic value of the share. What is intrinsic value of the share? Present value of all the future benefits. Now, I am planning to hold it for 7 years. The 7 years dividend plus the sale value at the end of 7th year. Arrive at today's value of that. That is the intrinsic value. Right? And compare that with this amount they have mentioned here. Purchase price. Intrinsic value. If it is more than this 500, I will buy it. Share is undervalued. else I will not buy it. Is this clear? This is what needs to be done. Don't look at the solution. Tell me what is the intrinsic value. Calculate and tell me. I'm okay. I will give you 5 minutes time. Do not look at the solution. If you look at the solution, do not answer, please. Guys, it doesn't work that way. I humbly request you to be honest with yourself. Okay? Even if you have peeped into the solution, no. Even if you've taken one small hint, no. Please do it by yourself. If you're making a mistake, be happy because you're learning. That's when you learn. Is that clear? Online folks, pause the video now. 5 minutes. I'm giving you 300 seconds. Try to get the answer because not just the approach is enough. I told you the approach. It's about the calculation. Try. Okay? 5 minutes and then continue watching the lecture. Now, guys, come on. Please listen here. Now, many of you were giving me an answer which is not correct. Now, let me tell you what would have been the issue. Now, guys, what are we trying to calculate here? The intrinsic value, P0, per share. Per share. Am I right? Per share. Remove that. Now, when I have a bonus, the number of shares you hold will increase. But still, we are calculating on a per share basis. Is that clear? So now, okay. This is TYK question number. Okay, TYK question number 40. Okay. Now, guys, what is the bonus ratio? 1:5, which means you get a bonus of 1 share for every 5 shares you hold in the company. Am I right, guys? What is the dividend? 20% on the face value, 100, which means it's going to be 20. Dividend amount, they are saying, it remains constant. Am I right? Basically, dividend percentage is going to be the same, 20% on its face value. Is that going to change? No. Now, when you're calculating the present value of all the future benefits, now you guys tell me, when is the bonus issued? During the 4th year. Which means, assuming that the dividend is paid at the end, even in the 4th year, you will be eligible for what? The dividend on the new shares? Correct? Yes. Now, can I say year 1 to 3? Right? And then post bonus, year 4 to 7. Yes. Now, what is going to be the dividend per share I'm going to receive? Now, guys, you tell me. Now, before bonus, okay. Now, let us say I am currently holding 5 shares. I'm currently holding how many shares? 5 shares. Now, you guys tell me, what is the dividend per share? Can I say it is 5 into 20 divided by 5? For the 5 shares I hold, what is the dividend I receive? 20 per share into 5. The whole divided by number of shares I invested in. 5 shares. Am I right? So, it's going to be 20. Is there any problem here? No. Now, from the 4th year onwards, what happens? I paid my money to buy only 5 shares. I got 1 more share extra. What is the total dividend I receive? 6 into 20. 120. Guys, correct? But you paid your money and got how many shares? I bought only 5 shares. Which means effectively, per share, how much am I receiving? Per share invested. My money was only on 1 share. How much am I getting? 24. Average out, can I say 24 rupees is the dividend that I get on every share that I invested in. Strictly speaking, the number of shares increased, but average out on the amount of, on the number of shares which you purchase, it is only what? It is only 5 shares you purchase. Am I right? But you're getting what? 120. So 120 divided by 5, 24. Can I say this? Hello, everybody. You guys are able to understand? Because we are trying to buy the shares before bonus. Which means, if I buy this 1 share or if I buy 5 shares now, I will automatically get a 6th share and on that also I will receive dividend. Am I right, guys? Or in other words, basically what they do is 6 divided by 5. How much is 6 by 5? How much is 6 by 5? 1.2. So ideally, what they do is, for every 1 share that you buy right now, on an average out basis, you are entitled for 1.2 shares later on. Hence, the dividend will be 1.2 into 20. Am I right? How much is that? 24. Am I right, guys? This is another way of calculating. Are you getting this? Because you are only going to buy pre-bonus. Is that clear? Now first, this is the basis for preparing your cash flow equation. How many of you got this wrong? Be honest. This is the crux of this question. Is that clear? Is that clear? Right? Now you guys are able to understand how to get this. Now you might have a question. Sir, if I only buy one share, you are not entitled for bonus. If you have only one share, they cannot give you fractional share, 0.2 and all. No, it is assumed that you hold in multiples of 5. Sir, if I hold 7 shares, sir, you will only get 1 share extra. 1:5. Is that clear? That's how it works. Proportion doesn't work here. So it is assumed that you are holding in multiples of 5. That's how you will be able to you are eligible for your bonus. Is everybody getting this? Is everybody getting this? Right. Now guys, now based on this, can we go and arrive at the present value of all the future benefits that we arrive at? Now you guys understood this concept here? Yes, this is a very, very important thing. It's a very important thing. So yes, let's do this right now. Right on. Right on. Right on. Calculation of present value of dividend and the sale proceeds. Dividend and the sale proceeds. Shall we begin, guys? Yes, put this dabba here. Here. Write down cash flow. Then write down. You have present value factor. What percentage, guys? What percentage? KE, discounted. The discount rate is 12%. Alright. And then you have what? Present value cash flows. Now shall we put it back? Put it back. Put these figures here. Now, how many years, guys? 1, 2, 3, 4, 5, 6, 7, 7. Why? In the 7th year, you get some dividend as well as you get some sale proceeds. This is not terminal value. Finite life. Is that clear? Right. Now what are the cash flows here? Now tell me, guys. Year 1. Now for every share I hold, I mean it's pre-bonus, 20, 20, 20. Now guys, from year 4 onwards, during the 4th year, you got your bonus, and which means at the end of the year, they are giving you what? Your dividend. Now you are entitled for dividend on that extra share also. Guys, getting it? Is everybody able to understand? So how much is that going to be? This is the calculation. If you want, you can put a star, come down and also write this. So it's going to be what? 24, 24, 24, 24. Is that clear? You can put stars here. Come down, star, you can write. This is nothing but what? This calculation you write. Now I get 6 shares. Each share, I'm entitled for a dividend of 20 rupees. Am I right? Now, but how much did I invest? I invested only in 5 shares, which means literally I'm getting how much? 24 rupees for every share that I invested originally. Is that clear? Is everybody getting it? Is everybody getting it? Because we are trying to calculate on my investment, on the shares that I'm going to invest today, what is my eligibility? Is that clear, guys? But a company will pay 20 rupees per share. But I invested in 5 only and I got 6 shares dividend. That's how we are trying to calculate, average out. Is that clear? Or you can also put it as what? 6 by 5 is 1.2 times, just 20. That is another way of writing it. But I would prefer this way because it clearly shows the averaging. Is that clear, everyone? Anyone has any issues here? No. Now, tell me, guys, what is the sale proceeds you get at the end of 7th year? How much? How much? 900, minus 5%. No, guys, now you are selling the entire 6 shares. You are having 1 share extra and that is also being sold. So ideally speaking, here it has to be what? Here it has to be what? 6 shares into 900, right? But I originally invested only in 5. Guys, getting it? I'm averaging out. This is my sale proceeds, right? Divided by 5. Am I right, guys? But remember, there is some transaction cost here. How much was that? 5%. So into 1.05. Am I right? What? Yes, sir. I am receiving money. On that there is a brokerage. It has to be negative. 1 minus 5%. It has to be 0.95. Guys, remember entry load, exit load. Remember that. When I'm receiving something, I receive less if there is an expense. So if I put 1.05, it means someone is paying me 5% more. Are you getting this? Are you getting this? Hence, if you want, you can put a star here, or you can do the calculation here only. Okay, let's put a star here. put a double star here, come down and write. What is the sale proceeds, guys? Now, can I say 6 into how many shares? 900, 900 rupees per share. Guys, I invested only in 5. I got 6. Now I'm selling 6, right? 6 into 900 is my total sale proceeds. I mean, before that expense and all. But I only invested in 5. So on an average per share that I invested in, how much am I getting is what we're calculating. But this is not the entire money that I'm getting. I will receive 5% less. So into 0.95. Is everybody able to understand this? Guys, getting it? Getting it? This is a very tricky calculation, but very logical as well. So now tell me, guys, how much is this? Rupees 1026. Plug it here. 1026. Is everyone getting it? Yes. And now you can just do it. You will arrive at the value that you can pay to get this. So what's my PV factors? Is it given? No. 1 by 1.12 is equal to figures. 0.893, 0.797, 0.712. Am I right? 0.636, 0.567, 0.507, 0.452, and it repeats 0.452. Now what's my present value of cash flows? Come on, tell me, guys. Figures. 20 into 0.893 m plus all these things you do. Figures, tell me. 17.86 second year, 15.94 third year, 14.24 fourth year, sorry, 15.26 then, 13.61 then, 12.71 17 yes, then 10.85, and then finally 463.75 MRC. 563.68. Is this clear, guys? Is this clear? So literally, if you invest in this particular share, the present value of all the future benefits that you can enjoy is how much? 563.68. Is that clear, guys? Right now, what is the question? What is the question asking you? Okay, so now should he buy the share or not? Should he buy the share or not? If so, what is the maximum price he should pay? Okay, write down. Should he buy the share or not? Now, for that, you need to compute if you're investing in the share. Are you going to get a profit or a loss? Am I right, guys? So write down. Part 1. Gain / loss on, what is the word used? Buying the share. Now, how would you do this? So first, if I invest in the share, what is the present value of all the benefits I get? 563.68. So write down, that's the present value of inflow. Write down present value of dividend and sale proceeds. How much is it? Rupees 563.68 minus. Now, if I am buying the share, what is the cost of the share? What is the cost of the share? Now, 500, if you do, it is wrong. Why? They have clearly given in the question. What is it? Incidental expenses for purchase and sale is 5%, which means whether you're buying or you're selling, you need to pay this brokerage. Now, in this case, will you put 500 into 0.95? No, you're paying the money, which means 500 plus 5%, or in other words, 500 into 1.05. Is that clear? Honestly, guys, how many of you missed this? Be honest. Please take a red ink and do it. In exam, you should not miss. It's okay to commit the mistake in the classroom. You're here to learn. Absolutely fine. But don't commit the same mistake. Alright? So it's going to be what? 500 into red ink 1.05. How much is that, guys? It's going to be rupees 525. Are we clear on this? Right? And now if you see, net gain is how much? Rupees 38.68. So if you invest in this share, You're going to get a net gain of how much? 38.68. Will you go for the share? Yes, you can. Yes, you can, because you're getting a positive NPV. Call NPV basically. The net gain is NPV. Is that clear, guys? Are we clear on this? Yes. Are we done with the question? Not yet. Now, what else have they asked? If so, what is the maximum price he should pay for each share? So tell me, guys, what is the maximum price you can pay? Now, 563.68 is the maximum benefit you get. Now, the total cost you are allowed to spend is going to be equal to this amount. But the price of the share should be adjusted for the brokerage. So this amount includes the brokerage. Am I right? So guys, basically, the maximum amount that I'm willing to pay to buy the share is not 563.67. 563.68 is the total benefit I get, which means this is the maximum total cost I can spend. That cost includes share price plus 5% brokerage. So which means this includes 5% brokerage. Remove that and tell me how much is the price of the share that I'm willing to pay. Is that clear? So basically here, once again, just write down here. Part 2, maximum price Mr. A should be ready to pay. Now guys, one second. Now you guys tell me, what is the maximum benefit I get out of this investment? 563.68. If I invest, what is the benefit I get? Without adjusting for the cost, I'm saying, what is the present value of inflow I get? 563.68. Am I right, guys? So which means my total cost can be at max this figure for me to get a net NPV of 0. This is the maximum cost I will be willing to pay. Am I right, guys? Now, what is the maximum amount you will be willing to pay? 563. Once again, don't write anything. 563.68. This can be my maximum cost. Now, when I say maximum cost, that cost is nothing but my share price plus this 5% brokerage put together has to be equal to this 563.68. Am I right, guys? Only then my total cost will be equal to my total benefit. Net gain will be 0. Now they're asking you what should be the share price, which means can I say the MPS I'm willing to pay into 1.05 is equal to this number. So this divided by 1.05 will be the share price. They want to know the share price alone before incurring this incidental expenses. Is everyone clear with this? They're asking what is the maximum price that I can pay, price of the share. But the price plus brokerage can be at max 563.68, which means without the brokerage, tell me what is the MPS that I will be willing to pay. Is everybody able to get this? So here, write down here. Once again, I'll frame this as an equation. Write down 563.38 is equal to maximum price into 1.05. Am I right? Maximum price I'm willing to pay into 1.05. Am I right, guys? Is everyone clear with this? Which means, so maximum price will be how much? Maximum price will be 563.68 divided by 1.05. How much is this? Rupees 536.84. Am I right, guys? Yes. So basically, only if the share price is 536.84. After this, anyways, I have to pay a brokerage of 5%. Overall, after that, my overall cost becomes 563.68. Right? Am I right? And only then, no, that total cost will be equal to my total benefit. Net off, it will be 0. This is the maximum price I can pay. Suppose the price itself was this amount, 563.68. On top of it, I need to pay 5% brokerage. My cost will be more. Benefit will only be 563.68. Now I'll have a loss. The maximum cost has to be this. Hence, reverse work and calculate the maximum price. Is everyone getting this? This is what has been asked. Beautiful question. A very beautiful question. Look at the, catches that are there in this question. Right, guys? Please go and update your library for adjustments. Right on. That's all. The sum is over. Right on. I'll put it under an exceptional category. It's not any concept related, but yes, please put it under an exceptional tag. Give it an exceptional tag. Write down. Calculation of maximum price an investor can pay on a share. When bonus is issued, and incidental expenses on buy/sell are given. On buy/sell are given. Are we done, guys? Put it under an exceptional category. Are we done? Perfect. Okay, guys. Now we will do one more sum, and with that we'll wind up. Yes, for the day. No problem. Yes, shall we do, guys? What a smile on your face, huh? Okay, biggest motivation in life. Huh? Break and break. Okay, guys, shall we? Okay, now guys, a very interesting question. No concept as such, but a very interesting thing. Yes. Now guys, please focus here. Now read this fun fact. What does this fun fact tagline say? Hello, what does it say? You can print your own dividends. What is this, sir? You can print your own dividends? Yes. There's something called homemade dividends. So what is that, sir? Wait, I'll tell you. There is a numerical problem on this. There is a numerical problem. We're going to do a TYK question only, not MRP also. Right? I will tell you what it means. A very interesting concept, but yes, this is popularly called homemade. This is popularly called homemade dividends. So, but this word and all is not given in the study material, but it's actually a very good fun fact. That's why I've just mentioned here. So, you guys know Modigliani Miller? Yes, you have seen in your inter days. He's known for his irrelevance theory. So, this guy you would have seen in your capital structure decisions as well as in dividend policy. Capital structure decisions, he says, whether you raise money from debt or equity or any proportion of debt, it will not affect the value of the company. Irrelevance theory. Your capital structure decisions are irrelevant. Similarly, he says dividend policy. Whether you pay 0% dividend, 100% dividend, 20% dividend, 30% dividend, 90% dividend, it will not affect the value of the company. Right? That is what he is given, and he has given one model also to calculate all these things. So basically he says capital structure decisions or basically dividend decisions are irrelevant. Am I right? So according to the famous Modigliani Miller's theory, a company's dividend policy is mathematically irrelevant to an investor's true wealth. If a company stops paying cash dividends and retain the profits for growth, the stock's market price will naturally increase to reflect that internal cash accumulation. Guys, correct? Huh? If the company is not paying dividend, instead they are using this money and they are reinvesting it back in the business and they are growing, obviously your share price will increase. Is that clear? So now an investor who needs immediate cash can simply sell a tiny fraction of their newly appreciated shares to create their very own homemade dividend. Is that clear? Now let's say I have 100 shares, right? Let's say I have 100 shares. Now initially the share price was only 100. Example. Or let's say it was 10. Okay. Now the company didn't pay any dividend. They started reinvesting it. They are doing a very good job. Because of that, slowly the market price became 13. Now what will I do? I want dividends, sir. The company will not pay. What will you do? Maybe, how much dividend you want? Let us say I want 5 rupees. Now what will you do? So maybe you can sell 2 shares. You have 100 shares. Tilt 2 shares. If you sell 2 shares, each share will give you how much? 3 rupees. I mean, you'll get 13 rupees basically. And maybe fraction, whatever it is, depending on the amount that you want, you can sell a portion of your holdings and see that's your dividend. Is that clear? Is that clear? Homemade dividends. Guys, getting it? There is a sum in your study material regarding this. There is a sum. We will see TYK question number 16. 16. And guys, is this tagline good? Yeah, if you see this tagline somewhere, please inform me. All these are my own taglines, guys. Okay, actually, I mean, I've seen these things happening around even in my intermediate. Some portions, some people are taking and putting it. But anyways, guys, but ideally, that's not quite correct. See, if something is there in the study material, if you're doing, I mean, everyone, study materials are base. But all these things are, a person's own creativity. So that is something that is definitely not acceptable. But anyways, guys, so this tagline actually gives you, it's a catchy tagline, right? And actually this concept is called homemade dividend, right? In finance, we have this concept. But that's why I just gave this here, not as a separate concept, but I just gave it here. But we will show this with the help of a numerical problem. Take TYK question number 16. TYK question number 16, yes. Look at this. Look at the trend here. Study material, MTP, RTP, multiple times. And even it was a past exam question. Look what they have done. Shall we get started? Okay, I'll also take this question. Shall we begin, guys? Yes, let's do this sum. A good question. Once again, put it under an exceptional tag. A good concept. Now, guys, I'm reading out the question for you. Sam Limited has just paid a dividend of 2 rupees per share and it is expected to grow at the rate of 6% per annum. After paying dividend, the board declared to take up a project by retaining the next 3 annual dividends. So now, guys, one second. Now, a company wants to actually expand. When they are expanding, generally at that point of time, they will not pay dividends. Am I right? Because they need to save up some money for the future expansion. Am I right, guys? Now, in this case, it makes sense for them to not actually pay dividend because they are saving up. Don't worry. Once they grow, now after that growth, every year you will be able to get more dividends. Example, Jio. Reliance did that. Yes, the Reliance group of companies, they did that, right? Guys, you're aware of Jio. Revolution. What they did was a revolution, nothing short of a revolution. In the year 2015, I suppose. No, 2016. Yes, in the year 2015 or 16? 16 only, I think. Yes, 17, now you bought the SIM. They came in 2016 itself. Okay, 2016, I still remember. At that point of time, they announced free SIM cards and free plans also. Everyone thought cheap. If you give something free of cost, it generally loses its value. But this guy had a very good marketing strategy. He spent a lot of money on this. So you need to have an infrastructure, right? You need to have an infrastructure for building all these towers and all these things. All these were leased, but that is by the way. But he gave that experience to the users. 4G. 4G was a big deal. 3G was evolving into 4G. This guy directly said, I'll give you 4G. And slowly, it was too good to be true, right? And people started thinking it is all just like that. But when people started pouring in numbers, even I initially felt whenever you get something free of cost, it is always, just an eyewash. But this guy, he created a revolution. After maybe around a year only, I bought a Jio SIM. Thought, okay, something is there here. Am I really overpaying? So, see, I'm generally a person, I never go based on freebies. Because I believe in this saying, if something is given free of cost, remember you are the product. Right? There's a very good documentary series, something called a Social Dilemma. A very good web series, not a web series, a documentary film which every one of you should see. How WhatsApp, Facebook, Meta, basically your Instagram, why do they think they are providing free of cost? they really know much more about you than what you think you know about yourself. And even this entire class that I'm taking right now, though I've put my phone on silent, Google must be actually taking notes. Guys, really, you should see that and you will be shocked. You will be shocked. And that documentary film, they had interviewed all the people who were working with all these giants. Google, Microsoft, all these top, Instagram. You know, one of the guys, he said, me and my wife, we have an agreement. We will never take our mobile phones, smartphones to our bedroom. Because every single thing has been heard. These were the guys who created the program. They know what it means, what actually privacy means. Privacy is a myth. Why? When you have anything, allow, we just want to use the app. What you are allowing, you don't even know. You are allowing them to enter into your house, into your personal life. If something is given free of cost, you are the product. Why do you think Instagram is making a lot of money? Oh, he gets pleasure in giving back to the society, is it? Whatever you guys are, whatever we all, I use, Instagram is a very, very effective tool for a businessman. Because, look, simple. Let's say I'm running a business, I want to put an ad. I'm running a business, I want to put an ad. This ad should reach the right customer, the person who is looking for my product. How will I know? Well, reach Meta. He has a database of all the people with their Aadhaar card. Okay. Now, not maybe Aadhaar. Okay, that is for Jio. Okay. Now that's why they have tie-ups. Jio, Aadhaar is required, no? For your SIM. Actually, you can't. No one can insist. No private company can insist on your Aadhaar. Right? Anyways, coming back here. No, they have a tie-up here. Clearly, I will define who is my target audience. So these are my target audience. And it will only reach them. And based on the number of clicks, they will charge me. Well, I'm a businessman. I'm really happy to pay these guys loads of money. If I pay them 5,000, they give me 5,000 rupees for running this ad. They give me 50,000 rupees worth of business. I'm happy. They are also happy. You are also happy. Because you are getting the right product. That is different. But at what cost? At the cost of your privacy. Remember that. So I'm not saying don't use it. Know what you're signing up for. You know what I do generally? I have multiple, I'm not talking about this, especially YouTube. In YouTube, if you open nowadays, automatically it starts with shorts only. It knows your thought process. You don't even, how many times you tell me honestly, touch your heart and tell me, have you went to the search bar, typed for a video that you want to look at? Automatically it comes in start. That's how we do, right? That's how we do. They monitor to the extent of how long you stay in that video and you swipe. Even on your Instagram page, how long you stay there, that's called an impression. In the back end, when we are running ads, they give you so many impressions, which means someone is scrolling the feed, they stopped on your ad, which means the person has some interest in it. Similar ads will automatically pop up. Have you ever wondered why you get similar ads? Nothing. I'll tell you one more thing. Just take your phone. Let us say some random product. Let's say you're talking about iPhone. Now, if you use this word iPhone 16 Pro Max 5-6 times over a phone call conversation, the next time the chances of getting this ad is much more. You know that? They are hearing eavesdropping. They are actually, why not eavesdropping? Eavesdropping means OTK. No, you allowed. It's your mistake. You allowed. So this is how it happens. So guys, coming back to the discussion here, I started with Jio. So Jio, when they are expanding, now they started, Reliance had this Jio concept here. Now when Jio came in, these guys required a lot of investment. Now that was a very disruptive move. If you notice, back then there were multiple players in the market. You guys know? There were Aircel was gone. Docomo. Yes, you had Docomo. Vodafone and Idea merged. No other option. Airtel was still in the game, but they suffered a lot of market share was gone off. Right? Somehow Airtel was into this core business. Somehow they have survived, but their target audience is elite audience. So always Airtel has a slightly premium cost. But guys, they were literally looting us. Honestly, they were looting. There has to be check and balance in place. Now, what happened earlier, I still remember during my articleship when I was in PwC, they have this post-paid plan for all the people. So I know that guy used to come to our office. He said, 1 month postpaid plan. Now hardly any of us, we don't use postpaid. 1 month are privileges. You can talk for 500 minutes. Beyond that only you will charge and all these things. Per month we will give you 750 MB. MB. 750 MB. That is gone in like just 5 minutes now. Right? So that used to be a privilege the year before this guy came. He said 1 GB I'll give you free of cost. What MB? And guys, it was a disruptive model. And today, look, is Jio free of cost? He created a beautiful model, and now he weeded out the competitors. And now it's you call this as an oligopoly. Monopoly means one guy. Oligopoly means very few players. And I'm telling you again, this is not very good. Now, if he's trying to kill away Vodafone and Airtel as well and enjoy a monopoly, now this guy is going to rule the show. Now tomorrow you will say, for 750 MB, you pay what? Some 1,000 rupees. You have to listen no other player. Now you can't say at that point of time, we should not have gone. So there has to be check and balance in place. But I'm telling you, be very, very clear. Don't just go based on freebies. I'm telling you again, guys, if you are getting something free, of course, you are the product. Remember that. But this guy wanted to create this kind of a thing. I never give my Aadhaar. I never give my Aadhaar anywhere. Anywhere I go, I only give my driving license. I never give my PAN and Aadhaar. Legally, no private agency can ask you for, insist on your PAN and Aadhaar, except for opening a demat account or anything that is legally required. You can't. You need not give. Your Aadhaar has everything. You think Aadhaar is just, it has your retina. It has your fingerprint, everything. If someone wants to misuse, literally you're gone for a toss. Right? So have that in your mind. So now guys, when a company is planning for expansion, now when Reliance was doing that, maybe they might not have paid dividends because it required a lot of cost for them. Right? They would have set aside this money, and based on this money, they are planning for a future expansion. Am I right, guys? Now, maybe for the initial few years, there was no dividend or a lesser dividend. But after that, with a grown business, now they can pay much more dividends. Am I right, guys? Now, coming back to this example, I deviated a bit, but all these are actually real life examples. In fact, in mergers and acquisitions also, we'll be seeing much more examples. Now, coming back here, so what happened, guys? This company decided to take up a project. Hence, for the next 3 years, they stopped paying dividends. Am I right? It is expected that this project is of the same risk as the existing projects. Okay. The result of this project will start coming from the 4th year onwards from now. Right? The dividends will then be 2.5 rupees per share and will grow at the rate of 7% per annum. Are you guys clear with this? So now they are saying, instead of 3 years I will not pay. Beyond that, I'll be paying 2.5. That is also going to grow at the rate of 7%. Now you are an investor. You had 1,000 shares in SAM Limited. And you are saying, I want a receipt of at least 2,000 rupees per annum from my investment. So I made an investment and I need at least 2,000 rupees as dividend. Can you force the company to pay dividend? No. Board recommends, you only approve. If the board is not recommending, there is no question of approval. There is no question of dividend only. Right? Homemade dividends. Is that clear? The word is not used, but that's what it means. Show that the market, now, what are they asking? Show that the market value of the shares is affected by the decision of the board. Also show as to how an investor can maintain his target receipt from investment for the first 3 years and improved income thereafter, given that the cost of capital of the firm is 8%. This is exactly the concept of homemade dividend. How can I ensure that I receive this 2,000 rupees even when the company is not paying me any dividend? And they're asking you to show that, the market value of the share is affected by the decision. And also they're asking how I can maintain this target receipt for the first 3 years and how is it going to improve after those 3 years, assuming that the cost of capital is 8%. Now, guys, what I would suggest you to do is take a couple of minutes time. Like online folks, you can pause the video, read the question, understand, digest the facts. Don't look at the solution, please. Try to frame an approach. Attempt something. I told you the concept. I gave you the background. Attempt something. And then we will discuss and do this. Fine, guys? Right? And with this question, we will wind up for the day. We'll wind up the session. Is that clear, guys? Right? Online folks, pause the video now. Right? Please read the question and then continue watching the lecture. Now, guys, Now, what do you need to do in this question? You need to show that the market value of the share is affected by the decision of the board. Which means what? Before this expansion project, what would have been my market price? After the expansion project, what will be my market price? Compare the two and tell them this is the difference. Number one. Number two, we need to show how this investor can still earn this target receipt of at least 2000, if not exactly, minimum is 2000. Is that clear? How will he do? By selling some portion of his shares. Is that clear? Right. And not just that, after 3 years, so each of these 3 years he would have sold some shares to get the 2000 rupees receipt. After 3 years, on the balance shares, he will be receiving dividend. Guys, getting it? So, will it improve or not? Is also something that you need to show. Look at how many hidden adjustments there in this question. Sir, how do we do it? Let's get started. Shall we, guys? Yes, come on. Write this. This is what? TYK question number 16. TYK question number 16. A very good sum. A very good sum on homemade dividends. Now, guys, what have they given? 3 years data is given. Am I right, guys? Yes. I mean, they are saying that this particular project is only for retaining 3 years dividend. After that, they will be paying dividends and all. Am I right? So basically, they are saying here, for the next 3 years, we will not pay any dividend. Post 3 years, we will pay dividend that comes with a higher amount. Am I right? Currently, the company said they are paying 2 rupees dividend. And the growth rate was how much? 6% per annum. Now, this is without or before expansion program. Suppose if they are going for expansion program, what are they saying here? So, they are saying for the next 3 years, 0 dividend. Post that, from the 4th year onwards, they will pay a dividend of how much? Rupees 2.5, and from then on the growth rate is going to be 7%. This is what they have given. This is the given data. Am I right? Everybody able to understand? Is there any issue here? No. Now, write down first. Value of share at present. Within bracket, this is before the project. Write down before project. Now, guys, you tell me, had the project not been accepted, now the company just paid a dividend of 2 rupees and it will be growing at the rate of 6% up to perpetuity. Direct Gordon's model. So now tell me, guys, can I say P0 is equal to, what is D1? 2 into 1.06. Am I right? Divided by, what's my KE? The cost of capital of the firm is given. Basically, we are assuming that it's going to be the same expectation of return. Capital is given. Let's assume it's all equity. Nothing is given, which means that's what you can assume. So KE is how much? 8%. So 0.08 minus 0.06. KE minus D. How much is this coming out to? Going to be rupees 106. So if they are not taking up the project, the value of the company, value per share is going to be how much, guys? 106. Now, if the board actually approves for this project, what happens? 3 years, no dividend. Post that, they will start paying what? From the 4th year onwards, 2.5 rupees of dividend. Am I right, guys? Right? And that's going to grow up to the perpetuity at how much? 7% growth rate. Am I right, guys? Now, if the company is going to take up the project, now, guys, the first 3 years, that's going to be 0 dividend. Guys, so even if I discount the dividends, it's going to be 0. Now, at the end of 3rd year, can I calculate the terminal value? Yes, I can say D4, right, divided by KE minus D. Guys, correct? D4 is how much? 2.5 directly. Divided by, what is KE? 8%, 0.08, minus what is G? 7%. Am I right, guys? If I do this, I will arrive at the value at the end of 3rd year. Once again, discount it and bring it to today's value. I will arrive at the today's value of the share. Am I clear with this? Is everybody able to understand? So now write down value of share within bracket after project write down, please write down. In this case, please write down, in this case, no dividend will be payable for 3 years. In this case, no dividend will be payable for 3 years. No dividend will be payable for 3 years, and from the 4th year onwards, a dividend of 2.5 rupees, growing at 7% per annum will be paid. Growing at 7% per annum will be paid. Therefore, P0 in this case can be calculated as follows. Therefore, P0 in this case can be calculated as follows. Right now. Now guys, P0 is equal to. Now guys, I can discount the first 3 years cash flows, which is 0 anyways. So directly I can say it is nothing but the present value of the terminal value. So can I say here it is going to be T4 divided by KE minus G. This is the value at the end of 3rd year, terminal value. Next year cash flow, D4 divided by KE minus G. Now this is the value at the end of 3rd year. Bring it to present value. How will you do that? Divided by 1 plus KE to the power 3. Is this clear, guys? Is everybody getting this? Is everybody getting this? Right? Now tell me, what is D4? Directly it's 2.5. What's my KE? 0.08. What's my growth? 0.07 into 1 divided by 1.08. Yes, the power 3. Can anyone tell me what's the final answer for this? How much, guys? Rupees 198.46. Is that clear? Is that clear? So now look at this. If the company is accepting the project, what happens? In today's value, the intrinsic value becomes 198.46 as compared to just 106. Is everyone able to understand? This is the impact of accepting this project. Now you might see 3 years no dividend, sir, but later on they're going to pay much more dividend, and that is growing at a different growth rate. And if you arrive at the present value of that, it is actually much more than your current P0. Are you guys able to understand? Write down. Write down. The price of the share is expected to increase from. The price of the share is expected to increase from rupees 106 to rupees 198.46 to rupees 198.46 after the announcement of the project. After the announcement of the project. After the announcement of the project. Is that clear? So this is what they ask. Show that the market value of the share is affected by the decision. This is what it is. Now once again, guys, practically, if a company is going for an expansion or a new product line, you notice immediately the market price increases. Why? Because an announcement is enough. You calculate the intrinsic value and you see it's much more. Guys, getting this? The actual project need not have undertaken. It need not have been undertaken. The moment an announcement is made today, immediately the share price goes up. Why? People know that this is how it is going to become. They do all this back end discounted cash flows and they discount it in today's value and see the intrinsic value itself increases, which means the current market price also increases. Is everybody able to understand? This is how market functions. Are you getting it? Are you getting it? Guys, everybody able to understand? Everybody able to understand? Is there any issues here? No. Now, one second. An extra point. This is required very much for your exam. This is covered in security analysis chapter. The moment an announcement is made, Immediately the price increases. Why? Because in the back end, investors would have done this back end calculation and they would have seen, yes, this is the intrinsic value is more. Immediately, announcement only is made. Expansion is yet to be made. Announcement is made. It reflects in the share price. This is actually an indication of an efficient market. Efficient market means the market factors into account whatever is this back end. If there is a news, immediately the market factors into account. Now, if the market is inefficient, which means the market has not factored this into account, it is still quoting at the old price, but you know that it will go up, immediately you can buy. So which means in an inefficient market you can make more money, but in an efficient market the potential of making money is quite less. Is that clear? So when I say a market is efficient, it factors into account all these things. Is that clear, guys? We will be seeing a concept called efficient market hypothesis. Right? There you have efficient, inefficient market. Under inefficient, you have weak form inefficient, semi-strong form inefficient, strong form efficient. So under each of these things, what are the differences? Where can you make money? And all these things, we will be seeing it later, but I'm just connecting the dots right now. All these things are very much required from an examination perspective. In one full-fledged problem, one word they had given. It is a semi-strong form efficient market. That's all they are given. You should know that this gets factored into account. Is that clear, guys? Is that clear? So India generally is more towards the weak form efficient to semi-strong form. I'll get into there. Is that clear, guys? Fine, we will do it later on. African countries are generally, in African, they have markets, they are inefficient markets, which means even if there is a public information, people, maybe it's, they don't factor that into account, you can easily make money there. That's why you have a global diversification, but there are also pros and cons in doing that. But coming again here, are you guys able to understand this concept? Yes. Now this part we have done. So clearly there is a change in the market price. Is everybody able to understand? Now, guys, you tell me. In this case, we calculated the terminal value. How much was that? The terminal value is this amount, right? This figure. This is the terminal value. Am I right, guys? Yes, what is the terminal value? 2.5 divided by 0.02. How much is that? Oh, sorry, 0.01. 2.5 divided by 0.01. How much was that? So can I say 250 rupees is the value at the end of year 3? The value at the end of, value as on today is what? The present value of 250. Am I right, guys? Guys, everybody able to understand? Is everybody able to understand? Now, please write down here. Expected market price, MPS, expected market price per share after 3 years. How much is it? Can I say this is nothing but 2.5 divided by 0.08 minus 0.07. Am I right, guys? How much is it? 250 terminal value basically. This is the expected market price. May not be actual, but expected market price P0. Guys, everybody able to understand? Now, the next 3 years, he's not going to pay any dividend. But I am going to create homemade dividends. How will I do that? Year 1, I'll sell some shares. Year 2, I'll sell some shares. Year 3, I'll sell some shares. Am I right? Now, when I'm selling, I will have to sell at the market price. No? Is the market price for the first 3 years given? No. But can you calculate it? Yes. How? 250 is the market price at the end of 3 years. To arrive at P0, what did you do? You arrived at the present value of 250 by discounting it for 3 years. Suppose I want to find the market price at the end of only 2 years. I will say this 250 into 1 year discount I will do. If you want to find the market price of the share at the end of 1 year, 250, 2 years discount. P0, 3 years discount. Is that clear, guys? Now, based on this, you can actually do this question. Guys, are you getting the point here? So, if I want to calculate the market price at the end of second year, assume you are standing at the end of second year now. But this value is 1 year from now. Bring it to present value. Present value means at the end of second year. I'm standing at the end of year 2. Which means, can I say it's 250 divided by 1 plus K to the power 1. Am I right, guys? Guys, this is the value at the end of year 2. Are you all able to understand? So let's do this here. Write down. Expected market price per share, MPS, after 2 years. we can put this formula only. 2.5 divided by 0.08 minus 0.07. This is the terminal value. Hello, guys, getting it? But this is the value at the end of third year, but I want the value at the end of second year, which means let's assume I'm standing at year 2. 1 year from now, this is the value, arrive at the present value. So can I say into 1 divided by 1.08 to the power 1? Guys, are you getting y to the power 1? I want to find the value at the end of year 2. So I'm standing here. 250 is the value at the end of year 3, 1 year from now. The present value of this is going to be only for 1 year discount factor. Is everybody getting this? So tell me, guys, how much is it? So it's basically 250 divided by 1.08. That's all. How much you get? 231 rupees 231.48. Is everybody getting this? Similarly, expected market price per share after 1 year. After 1 year, it's going to be the same. 2.5 divided by 0.08 minus 0.07 into, now I will discount it for 2 years. So into 1 divided by 1.08 to the power 2. Tell me, guys, how much is it? So 1 divided by 1.08 is equal to into 250, yeah? 214.33 rupees. 214.33. Is this clear, guys? Is everybody able to understand? Is there any issue here? Please tell me, guys. Are you guys able to understand this? Yes. Now they have mentioned I want to maintain what? A receipt of at least 2,000 rupees, guys, for the first 3 years. Am I right? So write down. Please write down here. In order to maintain, please write down. In order to maintain his receipt of at least rupees 2,000. In order to maintain his receipt of at least 2,000 in each of the first 3 years. In each of the first 3 years. In each of the first 3 years. Come on. The investor name is not. The investor will have to sell. The investor will have to sell. Come down and write. Come. Yes. So come down and write. Come down and write. Now, guys, first, year 1. Now, 1 second, guys. 1 second. What is the amount that I want to receive? I want to receive 2,000. But every share, if I sell, it gives me how much rupees? 214. So 2,000 divided by 214.33. You tell me how much it comes out to? How much? 9.33. Can I sell fractional shares? No. Round up. So sell 10 shares. Write down here. Write down here. Sell 10 shares at the rate of how much, guys? Rupees 214.33. How much will you receive? How much will you receive in cash? Not 2,000. How will you receive 2,000? 2143.30. Am I right? You have to get at least 2,000 rupees. You're getting more than that. Is that clear? You will not exactly get 2,000. Guys, are you getting this? Are you getting this? Yes. Now, how about year 2? How about year 2? Now, what is the year 2 share price? 231.48. How much you want? 2,000. So 2,000 divided by 231.48. How much is it? 8.6. You can't sell 8.6. Sell more. 9 shares. Write down. Sell 9 shares at the rate of rupees 231.48. How much is the amount? How much will you receive? Come on, tell me. How much is the amount you will receive, guys? Rupees 2083.32. Am I right? And how about the third year? Year 3. Now what is the per share value? 250. So 2,000 divided by 250. How much is it? Exactly 8. So write down. Sell 8 shares at the rate of how much? Rupees 250. You get how much? 2,000. So now, in each of these 3 years, did the company pay any dividend? No. But you could sell and get this amount, cash flow for yourself. Are you guys able to understand? And guys, every year, the share price was also increasing. Why? The company has taken up this expansion. Because of that, indirectly, what happened? You got the benefit. How? The share price increased and you sold and realized the money. Is that clear, guys? Is that clear? Everybody able to understand? Now, come down and write. The story is not over yet. Read the question. How many shares do I have? I'm an investor. How many shares do I have? 1,000 shares. At the end of third year, how many shares will I be having? Now I sold 10, I sold 9, and then I sold 8. Totally how many shares have we sold? You've sold how many shares? 27 shares, which means at the end of third year you will hold how much? 973. So write down. At the end of, it has to be written. Guys, in this question they have asked, show how this is possible. You have to write and explain. So at the end of third year, the investor will be having how many shares? 973 shares within bracket 1000 minus 10 minus 9 minus 8. Am I right, guys? Hello? Yes. At the rate of each share is valued at how much? I'm sitting at the end of third year. 250. Write down at the rate of rupees 250 each. Is that clear, guys? So which comes out to how much? What is the value? So valued at the rate of, what is the amount? 973 into 250. How much is that? 243 250. Am I right, guys? Yes. Guys, getting it? Now come down. Next line. Write down. On these 973 shares, his dividend for year 4 will be how much, guys? 973 into fourth year dividend is going to be 2.5. How much is it? 2432.50, which means now he is able to achieve the target of 2000 after after 3 years also. Now don't worry, fourth year he is getting this, fifth year it will only be much more. It will grow by 7%. Are you guys able to understand? Which means he is able to always achieve his target of 2000 rupees. 3 years homemade dividend. Fourth year onwards, company will pay you. Is that clear, guys? Right, getting it? So write down. Therefore, please write down final conclusion. Therefore, if the project is taken up by the company, comma, the investor would be, if the project is taken up by the company, comma, the investor would be able to maintain his receipt. The investor would be able to maintain his receipt of at least rupees 2000, for the first 3 years, within bracket, what is the concept called? Homemade dividends. Write down homemade dividend, bracket close, continue writing, and would be getting increased income thereafter. Is that clear, guys? A beautiful sum, isn't it? Right? Look at the beauty of the finance concepts hidden in this question. Right? For that purpose only, this was not separately explained in the study material. For that only, I actually kept this fun fact and I put this here. Guys, getting it? So that even when you're revising, you should know that there is a sum regarding your homemade dividend concept. Please, guys, underline this or highlight this concept of homemade dividend. It is not something that I've shared just like that. It is based on analyzing all the problems in the study material only. Yes, guys, trust me, a lot of work went into creating this book. After analyzing every single thing, we had to do this because in business valuation chapter and all, if you see the study material, will run into theory pages. It will be like a theory book. But while solving numerical problems, they have a lot of formulas. So literally, after going through every single study material question as well as MRP question based on what is required, we actually designed this book. So that's how it is. I mean, a lot of work went into it. I'm saying this not to say that I've done a great job, just to give you guys the confidence that this is super sufficient. Because having done this also, many students will have this question every time. They always, sir, is this sufficient? More than this, what should I do? This is super sufficient. First you do this. Then I told you again, I will ask you to do this again. Beyond this, there's nothing more that is required. Okay? Fine, guys. So please go and update your library of adjustments. Mark it as an exceptional question. Write down. Please write down. Write down. Homemade dividend. That will do. Homemade dividend. That's about it. Put it under an exceptional tag. A very good question. A very good question. Look, this was tested quite some time back, but this has been even in your November 25 MTP. It has come. Guys, I'm expecting sums like this to come anytime in your exam. If they want to make one attempt a little tricky, this is the study material only, right? Out of all the concepts, they can actually touch this area and they can ask you as well. So watch out for this. Okay, guys, are we done? Great, perfect. So with this, I'm concluding this session. Please revise and practice all the sums you've covered till now, and I'll see you all in the next one. Thank you all so much. Bye-bye.